Hey, what's up, everyone? All right, there's not going to be any good time to finish this, so I just need to do it. This is going to take way longer than I initially thought it would, but let's get started. And just a few notes on the counters in the bottom right of the screen. These are counting up how many times we see battery and electric. I'll keep going. Initially, the idea was to donate to TeamTrees based on how many we counted, but we already did that in the last video, so I'm just sort of counting for fun. And up here on the top left, if I need to say anything, I'll just leave a message there if I have to leave for any reason quickly, and then come back. Let's get started.
Did you think I need to pack this in?
Never.
Why not?
I don't ever give up. I mean, I'd have to be dead or completely incapacitated.
All right, starting on page 70. Tesla Inc. notes to consolidate financial statements. Note 1 overview. Tesla Inc., Tesla, the company, we, us, or our, was incorporated in the state of Delaware on July 3rd, 2003. We design, develop, manufacture, and sell high performance, fully electric vehicles, and design, manufacture, install, and sell solar energy generation and energy storage products. Our chief executive officer, as the chief operating decision maker, CODM, organizes the company, manages resource allocations, and measures performance among two operating and reportable segments, one automotive and two energy generation and storage. Note 2, summary of significant accounting policies. Principles of consolidation. The accompanying consolidated financial statements have been prepared in conformity with U.S. generally accepted accounting principles, GAAP, and reflect our accounts and operations and those of our subsidiaries in which we have a controlling financial interest in accordance with the provisions of accounting standards, codification ASC 810 consolidation. We consolidate any variable interest entity VIE of which we are the primary beneficiary. We form VIEs with financing fund investors in the ordinary course of business in order to facilitate the funding and monetization of certain attributes associated with solar energy systems and leases under our direct vehicle leasing programs. The typical condition for a controlling financial interest ownership is holding majority of the voting interests of an entity. However, a controlling financial interest may also exist in entities such as VIEs through arrangements that do not involve controlling voting interests. ASC 810 requires a variable interest holder to consolidate a VIE if that party has the power to direct the activities of the VIE that most significantly impact the VIE's economic performance and the obligation to absorb losses of the VIE that could potentially be significant to the VIE, or the right to receive benefits from the VIE that could potentially be significant to the VIE. We do not consolidate a VIE in which we have a majority ownership interest when we are not considered the primary beneficiary. We have determined that we are the primary beneficiary of all VIEs. Note 17, variable interest entity arrangements. We evaluate our relationships with all the VIEs on an ongoing basis to ensure that we continue to be the primary beneficiary. All intercompany transactions and balances have been eliminated upon consolidation. Bottom of page 70 if you're following along. Use of estimates. The preparation of financial statements in conformity with GAAP requires management to make estimates and assumptions that affect the reported amounts of assets, liabilities, and disclosures in the accompanying notes. Estimates are used for, but not limited to, determining the transaction price of products and services and arrangements with multiple performance obligations and determining the amortization period of these obligations. Significant economic incentive for residual value guarantee arrangements, sales, return reserves, the collectability of accounts receivable, inventory valuation, fair value of long-lived assets, goodwill, fair value of financial instruments, residual value of operating lease vehicles, depreciable lives of property and equipment, and solar energy systems, fair value and residual value of solar energy systems, subject to leases, warranty liabilities, income taxes, contingencies, determining lease pass-through, financing obligations, the valuation of build-to-suit lease assets, fair value of interest rate swaps and inputs used to value stock-based compensation. In addition, estimates and assumptions are used for the accounting for business combinations, including the fair values and useful lives of acquired assets, assumed liabilities, and non-controlling interests. Management bases its estimates on historical experience and on various other assumptions believed to be reasonable, the results of which form the basis for making judgments about the carrying values of assets and liabilities. Actual results could differ from those estimates. Okay. Done page 70. And we've been going for 5 minutes. Revenue recognition, adoption of new accounting standards, ASU 2014-09, revenue from contracts with customers. On January 1st, 2018, we adopted the new accounting standard ASC 606, revenue from the contracts with customers, and all the related amendments. New revenue standard using the modified retrospective method as policy election. The new revenue standard was applied only to contracts that were not substantially completed as of. I really wish this thing didn't do that. I don't know how to stop it from doing that. Makes it hard to follow along. That's all right. Man. Were not substantially completed as of the date of adoption. We recognize the cumulative effect of initially applying the new revenue standard as an adjustment on the January 1st, 2018 opening balance of accumulated deficit. The prior period consolidated financial statements have not been retrospectively adjusted and continue to be reported under the accounting standards in effect for those periods. A majority of our automotive sales revenue is recognized when control transfers upon delivery to customers for certain vehicle sales, where revenue is previously deferred as an in-substance operating lease, such as certain vehicle sales to customers or leasing partners with a resale value guarantee. We recognize revenue when the vehicle is delivered as a sale with the right of return. As a result, the corresponding operating lease asset deferred revenue and resale value guarantee balance as of December 31st, 2017 were reclassified to accumulated deficit as part of our adoption entry. Furthermore, the warranty liability related to such vehicles has been accrued as a result of the change from in-substance operating leases to vehicle sales. Prepayments on contracts that can be canceled without significant penalties, such as vehicle maintenance plans, have been reclassified from deferred revenue to customer deposits. Refer to the automotive sales revenue and automotive leasing revenue sections below for further discussion of the impact on various categories of vehicle sales. Automotive segment. Automotive sales revenue, automotive sales without resale value guarantee. Automotive sales revenue includes revenues related to deliveries of new vehicles and pay per use charges and specific other features and services that meet the definition of performance obligation under the new revenue standard, including access to our supercharger network, internet connectivity, autopilot, full self-driving, FSD features, and over-the-air software updates. We recognize revenue on automotive sales upon delivery to the customer, which is when the control of a vehicle transfers. Payments are typically received at the point control transfer or in accordance with payment terms customary to the business. Other features and services such as access to our supercharger network, internet connectivity, and over-the-air software updates are provisioned upon control transfer of a vehicle, recognized over time on a straight line basis, as we have a stand-ready obligation to deliver such services to the customer. We recognize revenue related to these other features and services over the performance period, which is generally the expected ownership life of the vehicle or the 8-year life of the vehicle. Revenue related to autopilot and FSD features is recognized when functionality is delivered to the customer. For our obligations related to automotive sales, we estimate standalone selling price by considering costs used to develop and deliver the service, third-party pricing of similar options, and other information that may be available. Sorry for coughing. It'll get better as I go. I wonder if anybody's listening to this. At the time of revenue recognition, we reduce the transaction price and record a sales return reserve against revenue for estimated variable consideration related to future product returns. Such estimates are based on historical experience and are immaterial in all periods presented. In addition, any fees that are paid or payable by us to a customer's lender when we arrange the financing are recognized as an offset against automotive sales revenue. Costs to obtain a contract mainly relate to commissions paid to our sales personnel for the sale of vehicles. Commissions are not paid on other obligations such as access to our supercharger network, internet connectivity, autopilot, FSD features, and over-the-air software updates. As our contract costs related to automotive sales are typically fulfilled within 1 year, the cost to obtain a contract are expensed as incurred. Amounts billed to customers related to shipping and handling are classified as automotive revenue, and we have elected to recognize the cost for freight and shipping when control over vehicles, parts, or accessories are transferred to the customer as an expense in cost of revenues. Our policy is to exclude taxes collected from a customer from the transaction price of automotive contracts. Done with page 71, and that took us 5 minutes. So let me just take a quick pause here because we're at page 72. There's 156 pages. So 156 minus 72. If we do everything in 5 minutes, that's 420 minutes, which is 7 hours. Wait a minute. That didn't make sense. No, it does. Okay. Gotta go faster then. Automotive sales with resale value guarantee or a buyback option. We offer resale value guarantees or similar buyback terms to certain international customers who purchase vehicles and who finance their vehicles through one of our specified commercial banking partners. We also offer resale value guarantees in connection with automotive sales to certain leasing partners. Under these terms, we reserve full payment for the vehicle sales price at the time of delivery, and our counterparty has the option of selling their vehicle back to us during the guarantee period, which currently is generally at the end of the term of the applicable loan or financing program for a predetermined resale value. Excuse me, with the exception of 2 programs which are discussed within the automotive leasing section, we recognize revenue when control transfers upon delivery to customers in accordance with the new revenue standard as a sale with a right of return, as we do not believe the customer has a significant economic incentive to exercise the resale value guarantee provided to them. The process to determine whether there is a significant economic incentive includes a comparison of a vehicle's estimated market value at the time the option is exercisable with the guaranteed resale value to determine the customer's economic incentive to exercise the performance obligations in the pattern of recognizing automotive sales with the resale value guarantees are consistent with automotive sales without resale value guarantees, with the exception of our estimate for the sales return reserve. Sales return reserve for automotive sales with resale value guarantees are estimated based on historical experience plus consideration for expected future market values. On a quarterly basis, we assess the estimated market values of vehicles under our buyback options program to determine whether there have been changes to the likelihood of future product returns as we accumulate more data related to the buyback values of our vehicles, or as market conditions change. There may be material changes to their estimated values due to price adjustments we made to our vehicle offerings during 2019. We estimate that there is greater likelihood that customers will exercise their buyback options that were provided prior to such adjustments. As a result, along with the estimated variable consideration related to normal future product returns for vehicles sold under buyback options program, we adjusted our sales return reserve on vehicles previously sold under our buyback options program, resulting in a reduction of automotive sales revenues of $555 million for the year ended December 31st, 2019. If customers elect to exercise the buyback option, we expect to be able to subsequently resell the returned vehicles, which resulted in a corresponding reduction in cost of automotive sales of $451 million for the year ended December 31st, 2019. The net impact was $104 million reduction in gross profit for the year ended December 31st, 2019. The total sales return reserve on vehicles previously sold under our buyback options program was $639 million as of December 31st, 2019, of which $93 million was short term. The 2 programs that are still being recorded as operating leases are discussed in further detail below in vehicle sales to leasing partners with a resale value guarantee and a buyback option, and vehicle sales to customers with a resale value guarantee where exercise is probable. Prior to the adoption of the new revenue standard, all transactions with resale value guarantees were recorded as operating leases. The amount of sale proceeds equal to resale value guarantee was deferred until the guarantee expired or was exercised. For certain transactions that were considered interest-bearing collateralized borrowings are required under ASC 840 leases prior to January 1st, 2019. We also accrued interest expense based on our borrowing rate. The remaining sale proceeds were deferred and recognized on a straight line basis over the stated guarantee period to automotive leasing revenue. The guarantee period expired at the earlier of the end of the guarantee period or the payoff of the initial loan. We capitalized the cost of these vehicles on the consolidated balance sheet as operating lease vehicles net and depreciated their value less estimated residual value to cost of automotive leasing revenue over the same period. In cases where our counterparty retained ownership of the vehicle at the end of the guarantee period, the resale value, guarantee liability, and any remaining deferred revenue balances related to the vehicle were settled to automotive leasing revenue, and the net book value of the leased vehicle was expensed to cost of automotive leasing revenue. If our counterparty returned the vehicle to us during the guarantee period, we purchased the vehicle from our counterparty in an amount equal to the resale value guarantee and settled any remaining deferred balances to automotive leasing revenue, and we reclassified the net book value of the vehicle on the consolidated balance sheet to used vehicle inventory. Okay, still on the 5-minute track. Lost a little bit of time. Deferred revenue activity related to the access of our supercharger network, internet connectivity, autopilot, FSD features, and over-the-air software updates on automotive sales with and without resale value guarantee consists of the following: year ended December 31st, 2019-2018, deferred revenue on automotive sales with and without resale value guarantees beginning of period $883 million, $476 million. Additions, $880 million, $532 million. Net changes in liability for pre-existing contracts, $9 million, negative $13 million. Revenue recognized, negative $300 million, negative $112 million. Deferred revenue on automotive sales with and without resale value guarantee. End of period, $1.472 billion, $883 million. Deferred revenue is equivalent to the total transaction price allocated to the performance obligations that are unsatisfied or partially unsatisfied as of December 31st, 2019. From the deferred revenue balance as of December 31st, 2018, revenue recognized during the year ended December 31st, 2019 was $220 million. From the deferred revenue balance as of January 1st, 2018, revenue recognized during the year ended December 31st, 2018 was $81 million. Of the total deferred revenue on automotive sales with and without resale value guarantees as of December 31st, 2019, we expect to recognize $751 million of revenue in the next 12 months. The remaining balance will be recognized over the performance period as discussed above in automotive sales without resale value guarantee. Automotive regulatory credits in connection with the production and delivery of our zero-emission vehicles in global markets. We have earned and will continue to earn various tradable automotive regulatory credits. We have sold these credits and will continue to sell future credits to automotive companies and other regulated entities who can use the credits to comply with emission standards and other regulatory requirements. For example, under California's zero-emission vehicle regulation and those of states that have adopted California standard, vehicle manufacturers are required to earn or purchase credits referred to as ZEV credits for compliance with their annual regulatory requirements. These laws provide that automakers may bank or sell to other regulated parties their excess credits if they earn more credits than the minimum quantity required by those laws. We also earn other types of saleable regulatory credits in the United States and abroad, including greenhouse gas, fuel economy, and clean fuels credits. Payments for regulatory credits are typically received at the point control transfers to the customer or in accordance with payment terms customary to the business. We recognize revenue on the sale of automotive regulatory credits at the time control of the regulatory credits is transferred to the purchasing party as automotive revenue is the consolidated statements. In the consolidated statements of operations, revenue from the sale of automotive regulatory credits totaled $594 million, $419 million, $360 million for the years ended December 31st, 2019, 2018, 2017, respectively. Deferred revenue related to sales of automotive regulatory credits was $140 million and zero as of December 31st, 2019 and 2018, respectively. We expect to recognize the deferred revenue as of December 31st, 2019 in the next 12 months. Automotive leasing revenue. Automotive leasing revenue includes revenue recognized under lease accounting guidance for our direct leasing programs, as well as the two programs with resale value guarantees, which continue to qualify for operating lease treatment prior to the adoption of the new revenue standard. All programs with resale value guarantees were accounted for as operating leases. Okay, we're doing a little bit better. We picked up a minute. I think rather than celebrate, let's just keep going. This looks like a dense page. direct vehicle leasing program. We have outstanding leases under our direct vehicle leasing programs in the U.S., Canada, and in certain countries in Europe. As of December 31st, 2019, the direct vehicle leasing program is offered for all new Model S, Model X, and Model 3 vehicles in the U.S. and for new Model S and Model X vehicles in Canada. Qualifying customers are permitted to lease a vehicle directly from Tesla for up to 48 months. At the end of the lease term, customers are required to return the vehicles to us for Model S and Model X leases, and Model X leases may opt to purchase the vehicles for a predetermined residual value. We account for these leasing transactions as operating leases. We record leasing revenues to automotive leasing revenue on a straight line basis over the contractual term. We record the depreciation of these vehicles to cost of automotive leasing revenue. For the years ended December 31st, 2019, 2018, and 2017, we recognize $532 million, $393 million, $221 million of direct vehicle leasing revenue, respectively. As of December 31, 2019 and 2018, we had deferred $218 million and $110 million, respectively, of lease-related upfront payments, which will be recognized on a straight-line basis over the contractual terms of the individual leases. We capitalize shipping costs and initial direct costs, such as incremental costs of referral fees and sales commissions from the origination of automotive lease agreements as an element of operating lease vehicles net, and subsequently amortize these costs over the term of the related lease agreement. Our policy is to exclude taxes collected from a customer from the transaction price of automotive contracts. Total capitalized costs were immaterial as of December 31st, 2019 and 2018. Vehicle sales to leasing partners with a resale value guarantee and a buyback option. We offer buyback options in connection with automotive sales with resale value guarantees with certain, I really wish you wouldn't do that, I don't know, with certain leasing partner sales in the United States. These transactions entail a transfer of leases which we have originated with an end customer to our leasing partner. As control of the vehicles has not been transferred in accordance with the new revenue standard, these transactions were accounted for as interest-bearing collateralized borrowings in accordance with ASC 840 leases prior to January 1st, 2019. Under this program, cash received for the full price of the vehicle and the collateralized borrowing value is generally recorded within resale value guarantees, and the customer upfront down payment is recorded within deferred revenue. We amortize the deferred revenue amount to automotive leasing revenue on a straight line basis over the option period and accrue interest expense based on our borrowing rate. The option period expires at the earlier of the end of the contractual option period or the payoff of the initial loan. We capitalize vehicles under this program to operating lease vehicles net on the consolidated balance sheets, and we record depreciation from these vehicles to cost of automotive leasing revenue during the period the vehicle is under a lease arrangement. Cash received for these vehicles net of revenue recognized during the period is classified as collateralized lease repayments, borrowings within cash flows from financing activities in the consolidated statements of cash flows following the adoption of ASC 842 on January 1st, 2019. All new agreements under this program are accounted for as operating leases, and there was no material change in the timing and amount of revenue recognized over the term. Consequently, any cash flows for new agreements are classified as operating cash activities on the consolidated statements of cash flows. At the end of the lease term, we settle our liability in cash by either purchasing the vehicle from the leasing partner for the buyback option amount or paying a shortfall to the option amount the leasing partner may realize on the sale of the vehicle. I was just checking the time. Any remaining balances within deferred revenue and resale value guarantee will be settled to automotive leasing revenue. The end customers can extend the lease for a period of up to 6 months in cases where the leasing partner retains ownership of the vehicle. After the end of our option period, we expense the net value of the leased vehicle to cost of automotive leasing revenue. The maximum amount we could be required to pay under this program, should we decide to repurchase all vehicles, was $214 million and $480 million as of December 31st, 2019 and 2018, respectively, including $178 million within a 12-month period from December 31st, 2019. As of December 31st, 2019 and 2018, we had $238 million and $558 million, respectively. Such borrowings recorded in resale value guarantees and $29 million and $93 million, respectively, recorded in deferred revenue liability For the year ended December 31st, 2019 and 2018, we recognized $186 million and $332 million, respectively, of leasing revenue related to this program. The net carrying amount of operating lease vehicles on this program was $190 million and $469 million, respectively, as of December 31, 2019 and 2018. Okay, done with page 74 with like 10 seconds to spare if we're just keeping our 5-minute pace. Vehicle sales to customers with a resale value guarantee where exercise is probable for certain international programs where we have offered resale value guarantees to certain customers who purchase vehicles and where we expect the customer has a significant economic incentive to exercise the resale value guarantee provided to them. We continue to recognize these transactions as operating leases. The process to determine whether there is a significant economic incentive includes a comparison of a vehicle's estimated market value at the time the option is exercisable with the guaranteed resale value to determine the customer's economic incentive to exercise. We have not sold any vehicles under this program since the first half of 2017, and all current period activity relates to the exercise or cancellation of active transactions. The amount of sale proceeds equal to the resale value guarantee is deferred until the guarantee expires or is exercised. The remaining sale proceeds are deferred and recognized on a straight line basis over the stated guarantee period to automotive leasing revenue. The guarantee period expires at the earlier of the end of the guarantee period or the payoff of the initial term loan. We capitalized the cost of these vehicles on the consolidated balance sheet as operating lease vehicles net and depreciate their value less salvage value to cost of automotive leasing revenue over the period. In cases where a customer retains ownership of a vehicle at the end of the guarantee period, the resale value guarantee liability and any remaining deferred revenue balances related to the vehicle are settled to automotive leasing revenue, and the net book value of the leased vehicle is expensed to cost of automotive leasing revenue. If a customer returns the vehicle to us during the guarantee period, we purchase the vehicle from the customer in an amount equal to the resale value guarantee and settle any remaining deferred balances to automotive leasing revenue, and we reclassify the net book value of the vehicle on the consolidated balance sheets to used vehicle inventory. As of December 31st, 2019 and 2018, $115 million and $150 million respectively of the guarantees were exercisable by customers within the next 12 months. For the year ended December 31, 2019 and 2018, we recognized $150 million and $158 million respectively of leasing revenue related to this program. The net carrying amount of operating lease vehicles under this program was $83 million and $212 million respectively as of December 31, 2019 and 2018. Services and other revenue. Services and other revenue consists of a non-warranty after-sales vehicle services, sales of used vehicles, retail merchandise sales by our acquired subsidiaries to our third-party customers, and vehicle insurance revenue. There was no significant changes to the timing or amount of revenue recognition as a result of our adoption of the new revenue standard. Revenues related to repair and maintenance services are recognized over time. As services are provided in extended service plans are recognized over the performance period of the service contract as the obligation represents a stand-ready obligation to the customer. We sell used vehicle services, service plans, vehicle components, and merchandise separately and thus use standalone selling prices as the basis for revenue allocation to the extent that these items are sold in transactions with other performance obligations. Payment for used vehicles, services, and merchandise are typically received at the point when control transfers to the customer in accordance with payment terms customary to the business. Payments received for prepaid plans are refundable upon customer cancellation of the related contracts and are included within customer deposits on the consolidated balance sheet. Deferred revenue related to services and other revenue was immaterial as of December 31, 2019 and 2018. Done with page 75. And we're about a minute ahead because we're at 29 minutes. We should be at 30. But you want to hear the 10K. I'm going to keep going. And thanks for listening. If anybody's listening to this right now, leave a comment. Just leave a comment if you're listening right now. We're on page 76. Who knows if anybody will ever listen to this. Energy generation and storage segment. Energy generation and storage sales. Energy generation and storage sales revenue consists of the sale of solar energy systems and energy storage systems to residential, small commercial, and large commercial and utility grade customers. Upon adoption of the new lease standard, refer to leases section below for details. Energy generation and storage sales revenue includes agreements for solar energy systems and power purchase agreements, PPAs, that commence after January 1st, 2019. As these are now accounted for under the new revenue standard. Sales of solar energy systems to residential and small-scale commercial customers consist of the engineering, design, and installation of the system. Post-installation in residential and small-scale commercial customers receive a proprietary monitoring system that captures and displays historical energy generation data. Residential and small-scale commercial customers pay the full purchase price of the solar energy system up front. Revenue for the design and installation obligation is recognized when control transfers, which is when we install a solar energy system and the system passes inspection by the utility or the authority having jurisdiction. Revenue for the monitoring service is recognized ratably as a stand-ready obligation over the warranty period of the solar energy system. Sales of energy storage systems to residential and small-scale commercial customers consist of the installation of the energy storage system, and revenue is recognized when control transfers, which is when the product has been delivered, or if we are performing installation when installed and commission. Payment for such storage systems is made upon invoice or in accordance with payment terms customary to the business. I just thought of an idea for a video, so I'm going to write it down. I think we're right here. Sorry this is doing that. I don't know what nested facts are. This is really distracting. For large commercial and utility grade solar energy system and energy storage system sales, which consist of the engineering, design, and installation of the system, customers make milestone payments that are consistent with contract-specific phases of a project. Revenue from such contracts is recognized over time using the percentage of completion method based on cost incurred as a percentage of total estimated contract costs for energy storage system sales, and as a percentage of total estimated labor hours for solar energy system sales. Certain large-scale commercial and utility-grade solar energy system and energy storage system sales also include operations and maintenance service, which are negotiated with the design and installation contracts and are thus considered to be a combined contract with the design and installation service for certain large commercial and utility-grade solar energy systems and energy storage systems where the percentage of completion method does not apply. Revenue is recognized when control transfers, which is when the product has been delivered to the customer and commissioned for energy storage systems, and when the project has received permission to operate from the utility for solar energy systems. Operations and maintenance service revenue is recognized ratably over the respective contract term for solar energy system sales and upon delivery of the service. For energy storage system sales, customer payments for such services are usually paid annually or quarterly in advance. Got 2 minutes for these two paragraphs. In instances where there are multiple performance obligations in a single contract, we allocate the consideration to the various obligations in the contract based on the relative standalone selling price method. Standalone selling prices are estimated based on estimated cost plus margin or using market data for comparable products. Costs incurred on the sale of residential installations before the solar energy systems are completed are included as work in process within inventory in the consolidated balance sheets. However, any fees that are paid or are payable by us to a solar loan lender would be recognized as an offset against revenue. Costs to obtain a contract relate mainly to commissions paid to our sales personnel related to the sale of solar energy systems and energy storage systems, as our contract costs related to solar energy system and energy storage system sales are typically fulfilled within 1 year. The cost to obtain a contract or expenses incurred. Okay, 1 minute. As part of our energy system and energy storage system contracts, we may provide the customer with performance guarantees that warrant that the underlying system will meet or exceed the minimum energy generation or retention requirements specified in the contract. In certain instances, we may receive a bonus payment if the system performs above a specified level. Conversely, if a solar energy system or energy storage system does not meet the performance guarantee requirements, we may be required to pay liquidated damages. Other forms of variable considerations related to our large commercial and utility grade solar energy system and energy storage system contracts include variable customer payments that will be made based on our energy market participation activities. Such guarantees and variable customer payments represent a form of variable consideration and are estimated at contract inception at their most likely amount, updated at the end of each reporting period as additional performance data becomes available. Such estimates are included in the transaction price only to the extent that it is probable a significant reversal of revenue will not occur. Overshot by 11. We record as deferred revenue any non-refundable amounts that are collected from customers related to fees charged for prepayments and remote monitoring service and operations and maintenance service, which is recognized as revenue ratably over the respective customer contract term. As of December 31st, 2019 and 2018, deferred revenue related to such customer payments amounted to $156 million and $149 million, respectively. Revenue recognized from the deferred revenue balance as of December 31st, 2018 was $41 million for the year ended December 31, 2019. Revenue recognized from the deferred revenue balance as of January 1, 2018 was $41 million for the year ended December 31st, 2018. We have elected the practical expedient to omit disclosure of the amount of the transaction price allocated to remaining performance obligations for energy generation and storage sales with an original expected contract length of 1 year or less, and the amount that we have the right to invoice when that amount corresponds directly with the value of the performance to date. As of December 31, 2019, total transaction price allocated to performance obligations that were unsatisfied or partially unsatisfied for contracts with an original expected length of more than 1 year was $103 million. Of this amount, we expect to recognize $5 million in the next 12 months and the remaining over a period of up to 28 years. Energy generation and storage leasing for revenue arrangements where we are the lessor under operating lease agreements for energy generation and storage products. We record lease revenue from minimum lease payments, including upfront rebates and incentives earned from such systems on a straight line basis over the life of the lease term, assuming all other revenue recognition criteria have been met. The difference between the payments received and the revenue recognized is recorded as deferred revenue on the consolidated balance sheet. For anybody who just joined, the little note about where we are is right here, up in the upper left. For solar energy systems where customers, I can't remember where I was. I'm just going to go right here. Might cost me a little bit of time. For revenue arrangements where we're the lessor, no, I read that. For solar energy systems where customers purchase electricity from us under PPAs prior to January 1st, 2019, we have determined that these arrangements should be accounted for as operating leases pursuant to ASC 840. Revenue is recognized based on the amount of electricity delivered at rates specified under the contracts, assuming all of the revenue recognition criteria are met. Did I read that? Yeah. Just going to read it again because what if I'd missed it? Energy generation and storage leasing for revenue arrangements where we are the lessor under operating lease agreements for energy generation and storage products. We record lease revenue from the minimum lease payments, including upfront rebates and incentives earned from such payments on a straight line basis. I definitely read this over the life of the lease term, assuming all of the revenue recognition criteria have been met. The difference between the payments received and the revenue recognized is recorded as deferred revenue on the consolidated balance sheet. We record as deferred revenue any amounts that are collected from customers, including lease payments in excess of revenue recognized in operations and maintenance service, which is recognized as revenue ratably over the respective customer contract term. As of December 31, 2019 and 2018, deferred revenue related to such customer payments amounted to $226 million, $225 million, respectively. Deferred revenue also includes the portion of rebates and incentives received from utility companies and various local and state government agencies, which is recognized as revenue over the lease term. As of December 31, 2019 and December 31, 2018, deferred revenue from rebates and incentives amounted to $36 million and $37 million respectively. We capitalize initial direct costs from the execution of agreements for solar energy systems and PPAs, which include the referral fees and sales commissions as an element of solar energy systems net, and subsequently amortize these costs over the term of the related agreements. Done with page 77. A little bit of time to spare. Revenue by source. The following table disaggregates our revenue by major source in millions year ended December 31, 2019, 2018. Automotive. So somebody said last night, I mean, all these numbers are defined in millions already, so I'm not going to say million and billion. Unless I say something else, you should just assume that it's million or billion. Or sorry, unless I say something else, you should assume that the number is in millions, so tack on 6 zeros to it. So if I say 2, that's 2 million. If I say 19,212, that's 19 billion. Automotive sales without resale value. Guarantee 19,212, 15,810. Automotive sales with resale value guarantees 1,146, 1,403. Automotive regulatory credits 594, 419. Energy generation storage sales 2, 1,000, 1056. Services and other 2226, 1391. Total revenues and from sales and services 23, 178, 2079. Automotive leasing 869, 883. Energy generation storage leasing 2, 531, 499. Total revenues 24, 578, 21, 461. 1, we made pricing adjustments to our vehicle offerings in 2019, which result in a reduction of automotive sales with resale value guarantee revenues. Refer to automotive sales with resale value guarantee section above for details. The amount presented represents automotive sales with resale value guarantee in year ended. Oh, another typo. Should I? Oh, all right, I'll keep track of it. Footnote 1, page 78. In year ended December 31, 2019, net of such pricing adjustments impact under ASC 842 leases, solar energy systems sales, and PPAs that commence after January 1st, 2019, where we are the lessor and were previously accounted for as leases, no longer meet the definition of a lease and are instead accounted for in accordance with the new revenue standard. Refer to the leases section below for details. Cost of revenues, automotive segment, automotive sales. Cost of automotive sales revenue includes direct parts, material, and labor costs, manufacturing overhead, including depreciation costs of tooling and machinery, shipping and logistics costs, vehicle connectivity costs, allocations of electricity and infrastructure costs related to our supercharger network and reserves for estimated warranty expenses. Cost of automotive sales revenues also includes adjustments to warranty expense and charges to write down the carrying value of our inventory when it exceeds its estimated net realizable value and to provide for obsolete and on-hand inventory in excess of forecasted demand. Automotive leasing. Cost of automotive leasing revenue includes primarily the amortization of operating lease vehicles over the lease term as well as warranty expenses recognized as incurred. Cost of automotive leasing revenue also includes vehicle connectivity costs and allocations of electricity and infrastructure costs related to our supercharger network for vehicles under our leasing program. Services and other. Cost of services and other revenue includes costs associated with providing non-warranty after-sales services, costs to acquire and certify used vehicles, costs for retail merchandise, and costs to provide vehicle insurance. Costs of services and other revenue also includes direct parts, material, and labor costs, manufacturing overhead associated with the sales by our acquired subsidiaries to third-party customers. So that right there is exactly the halfway point. I'm pretty sure, 78 times 2 is like 156. So we just reached halfway. Energy generation and storage segment. Energy generation and storage. Energy generation and storage cost of revenue includes direct and indirect material and labor costs, warehouse rent, freight, warranty expense, and other overhead costs and amortization of certain acquired intangible assets. In addition, where arrangements are accounted for as operating leases, the cost of revenue is primarily comprised of depreciation of the cost of leased solar energy systems, maintenance costs associated with those systems, and amortization of any initial direct costs. Leases in February 2016, the FASB issued ASU number 2016-02, ASC 842, leases to require lessees to recognize all leases with certain exceptions on the balance sheet, while recognition on the statement of operations will remain similar to lease accounting under ASC 840. Subsequently, the FASB issued ASU number 2018-10, codification improvements to topic 842, leases, ASU number 2018-11, targeted improvements, ASU number 2018-20, narrow scope improvements for lessors, and ASU 2019-01, codification improvements to clarify and amend the guidance, and ASU number 2016-02, ASC 842 eliminates real estate specific provisions and modifies certain aspects of lessor accounting. We adopted ASC 842 as of January 1st, 2019, using the cumulative effect adjustment approach adoption of the new lease standard. In addition, we elected the package of practical expedients permitted under the transition guidance within the new standard, which allowed us to carry forward the historical determination of contracts as leases classification, and not reassess initial direct costs for historical lease arrangements. Accordingly, previously reported financial statements, including footnote disclosures, have not been recast to reflect the application of the new standard to all comparative periods presented. The finance lease classification under ASC 842 includes leases previously classified as capital leases under ASC 840. You can see why that's so annoying. Agreements for solar energy system leases and PPAs, solar leases that commence after January 1st, 2019, where we are the lessor and we were previously accounted for as operating leases, no longer meet the definition of a lease upon the adoption of ASC 842 and are instead accounted for in accordance with the revenue standard. Under these two types of arrangements, the customer is not responsible for the design of the energy system, but rather approved the energy system benefits in terms of energy capacity and production to be received over the term. Accordingly, the revenue from solar leases commencing after January 1st, 2019 are now recognized as earned based on the amount of capacity provided or electricity delivered at the contractual billing rates, assuming all of the revenue recognition criteria have been met. Under the practical expedient available under ASC 606 1055-18, we recognize revenue based on the value of the service, which is consistent with the billing amount. We have lease agreements with lease and non-lease components and have elected to utilize the practical expedient to account for lease and non-lease components together as a single combined lease component. From both a lease and lessee and lessor perspective, from a lessor perspective, the timing and pattern of transfer are the same for non-lease components and associated lease component, and the lease component, if accounted for separately, will be classified as an operating lease. Additionally, leases previously identified as build-to-suit leasing arrangements under legacy lease accounting ASC 840 were derecognized pursuant to the transition guidance provided for build-to-suit leases in ASC 842. Accordingly, these leases have been reassessed as operating leases as the adoption date under ASC 842 and are included on the consolidated balance sheet as of December 31, 2019. Operating lease assets are included within operating lease right of use assets, and the corresponding operating lease liabilities are included within accrued liabilities and other for the current portion, and within other long-term liabilities for the long-term portion on our consolidated balance sheet as of December 31, 2019. Finance lease assets are included within property, plant, and equipment net, and the corresponding finance lease liabilities are included within current portion of long-term debt, and finance leases for the current portion and within long-term debt and finance leases. So ridiculous. Net of current portion for the long-term portion on our consolidated balance sheet as of December 31, 2019. We're now at the top of page 80. We have elected not to present short-term leases on the consolidated balance sheet, as these leases have a lease term of 12 months or less at lease inception and do not contain purchase options or renewal terms that we are reasonably certain to exercise. All other lease assets and lease liabilities are recognized based on the present value of lease payments over the lease term at commencement date. Because most of our leases do not provide an implicit rate of return, we used our incremental borrowing rate based on the information available at adoption date in determining the present value of lease payments. Adoption of the new lease standard on January 1, 2019 had a material impact on our consolidated financial statements. The most significant impacts related to: 1, recognition of right of use assets of $1.29 billion and lease liabilities of $1.24 billion for operating leases on the consolidated balance sheet, and 2, derecognition of built-to-suit lease assets and liabilities of $1.62 billion and $1.74 billion respectively, with the net impact of $97 million recorded to accumulated deficit as of January 1, 2019. We also reclassified prepaid expenses and other current asset balances of $142 million and deferred rent balance, including tenant improvement allowances and other liability balances of $70 million relating to our existing lease arrangements as of December 31, 2018, into the ROU asset balance as of January 1st, 2019. ROU assets represent our right to use an underlying asset for the lease term, and lease liabilities represent our obligation to make lease payments arising from the lease. The standard did not materially impact our consolidated statement of operations and consolidated statement of cash flows. The cumulative effect of the changes made to our consolidated balance sheet as of January 1, 2019 for the adoption of the new lease standard was as follows. In millions, balances at December 31, 2018, adjustments from adoption of new lease standard, balances at January 1st, 2019, assets, prepaid expenses and other current assets, $366, property, plant, and equipment net, $11,330, negative $1617, $9713, operating lease right of use assets, $1286, other assets, $572, negative $141, $431, liabilities, accrued liabilities, and other, $2094, $118, $2212, current portion of long-term debt and finance leases, $2568, long-term debt and finance leases net of current portion, $9404, other long-term liabilities, $2710, negative $687, 2023, equity accumulated deficit, negative $5318, $97, $5221. Research and development costs. Research and development costs are expensed as incurred. Marketing, promotional, and advertising costs. Marketing, promotional, and advertising costs are expenses incurred and are included as an element of selling general administrative expense in the consolidated statement of operations. We incurred marketing, promotional, and advertising costs of $27 million, $32 million. I remember doing this for the Ford v Ferrari video. And $37 million in the years ended December 31, 2019, 2018, and 2017, respectively, of which the majority is related to promotional activities. Income taxes. Income taxes are computed using the asset and liability method, under which deferred tax assets and liabilities are determined based on the difference between the financial statement and tax bases of assets and liabilities, using enacted tax rates in effect for the year in which the differences are expected to affect taxable income. Valuation allowances are established when necessary to reduce deferred tax assets to the amount expected to be realized. Done with page 80. Thank you for listening and watching. We record liabilities related to uncertain tax positions when, despite our belief that our tax return positions are supportable, we believe it is more likely than not that those positions may not be fully sustained upon review by tax authorities. Accrued interest and penalties related to unrecognized tax benefits are classified as income tax expense. Comprehensive income loss. Comprehensive income loss is comprised of net income loss and other comprehensive income loss. Other comprehensive income loss consists of unrealized gains and losses on cash flow hedges and foreign currency translation adjustments that have been excluded from the determination of net income loss. Stock-based compensation. We recognize compensation expense for costs related to all share-based payments, including stock options, restricted stock units, and our employee stock purchase plan, the ESPP, the fair value of stock option awards with only service and or performance conditions, and the ESPP is estimated on the grant or offering date using the Black-Scholes option pricing model. The fair value of RSUs is measured on the grant date based on the closing fair market value of our common stock. Stock-based compensation expense is recognized on a straight line basis over the requisite service period, net of actual forfeitures in the period. For performance-based awards, stock-based compensation expense is recognized over the expected performance achievement period of individual performance milestones. When the achievement of each individual performance milestone becomes probable for performance-based awards with a vesting schedule based entirely on the attainment of both performance and market conditions, stock-based compensation expense associated with each tranche is recognized over the longer of one, the expected achievement period for the operational milestone for such tranche, and two, the expected achievement period for the related market capitalization milestone determined on the grant date beginning at the point in time when the relevant operational milestone is considered probable of being met. If such operational milestone becomes probable any time after the grant date, we will recognize a cumulative catch-up expense from the grant date to that point in time. If the related market capitalization milestone is achieved earlier than its expected achievement period and the achievement of the related operational milestone, then the stock-based compensation expense will be recognized over the expected achievement period for the operational milestone, which may accelerate the rate at which such expense is recognized in expected lives, which could materially impact the valuation of our stock-based awards and the stock-based compensation expense that we will recognize in future periods. Stock-based compensation expense is recorded in cost of revenues. Research and interest and redeemable non-controlling interests represent third-party interests in the net assets under certain funding arrangements or funds that we enter into to finance the costs of solar energy systems and vehicles under operating leases. We have determined that contractual provisions of the funds represent substantive profit sharing arrangements. We have further determined that the appropriate methodology for calculating the non-controlling interest and redeemable non-controlling interest balances that reflects the substantive profit sharing arrangements is a balance sheet approach using the hypothetical liquidation at book value HLBV method. We therefore determine the amount of the non-controlling interests and redeemable non-controlling interests in the net assets of the funds at each balance sheet date using the HLBV method, which is presented on the consolidated balance sheet as non-controlling interests in subsidiaries and redeemable non-controlling interests in subsidiaries under the HLBV method. The amounts reported as non-controlling interests and redeemable non-controlling interests in the consolidated balance sheets represent the amounts the third parties would hypothetically receive at each balance sheet date under the liquidation provisions of the funds, assuming the net assets of the funds were liquidated at the recorded amounts determined in accordance with GAAP and with tax laws effective at the balance sheet date and distributed to the third parties. The third party's interests in the results of operations of the funds are determined at the difference in the non-controlling interest and redeemable non-controlling interest balances in the consolidated balance sheets between the start and end of each reporting period after taking into account any capital transactions between the funds and the third parties. However, the redeemable non-controlling interest balance is at least equal to the redemption amount. The redeemable non-controlling interest balance is presented as temporary equity in the mezzanine section of the consolidated balance sheet, since these third parties have the right to redeem their interest in the funds for cash or other assets. Net income loss per share of common stock attributable to common stockholders. Basic net income loss per share of common stock attributable to common stockholders is calculated by dividing net income loss attributable to common stockholders by the weighted average shares of common stock outstanding for the period during the year ended December 31st, 2019. We increased net loss attributable to common stockholders by $8 million to arrive at the numerator used to calculate net loss per share. This adjustment represents the difference between the cash we paid to a financing fund investor for their non-controlling interest in one of our subsidiaries and the carrying amount of the non-controlling interest on our consolidated balance sheet. In accordance with ASC 260, earnings per share, potentially dilutive shares, which are based on on the weighted average shares of common stock underlying outstanding stock-based awards, warrants, and convertible senior notes using the treasury stock method or the if converted method as applicable are included when calculating diluted net income loss per share of common stock attributable to common stockholders when their effective is dilutive. Since we intend to settle or have settled in cash the principal outstanding under our 0.25 convertible senior notes in 2019, 1.25% convertible senior notes due in 2021, 2.375 convertible senior notes due in 2022, 2% convertible notes due in 2024, and 5.5 convertible senior notes due in 2022. Assumed in our Maxwell Technologies, Inc. acquisition, we use the treasury stock method when calculating their potential dilutive effect, if any. Furthermore, in connection with the offerings of our notes, we entered into convertible note hedges and warrants. See Note 12, debt. However, our convertible note hedges are not included when calculating potentially dilutive shares since their effect is always anti-dilutive. Makes sense. Warrants, which have a strike price above our share price, were out of the money and have not been included in the table below. The following table presents the potentially dilutive shares that were excluded from the computation of diluted net income loss per share of common stock attributable to common stockholders because their effect was anti-dilutive. Year-end December 31, 2019, 2018, 2017. Stock-based awards 10-10-10. Convertible senior notes 1-1-2. Warrants 1. And that's page 82. So we're at 1 hour. And we did a little intro. So even though we're at an hour and 2 minutes, the intro is probably 2 minutes. So we've done an hour and we've done 12 pages. So that is exactly 5 minutes a page. So $73 pages left. 5 minutes a page is 365 minutes. 60 minutes in an hour is 6 hours. All right. Business combinations. We account for business acquisitions under ASC 805. Business combinations. The total purchase consideration for an acquisition is measured as the fair value. So if I finished, I would be finishing around 8:24 a.m. The total purchase consideration for an acquisition is measured as the fair value of the assets given, equity instruments issued, and liabilities assumed at the acquisition date. Costs that are directly attributable to the acquisition are expenses incurred. Identifiable assets, including intangible assets, liabilities assumed, including contingent liabilities, and non-controlling interest in an acquisition, are measured initially at their fair values at the acquisition date. We recognize goodwill if the fair value of the total purchase consideration and any non-controlling interest is in excess of the net fair value of the identifiable assets acquired and the liabilities assumed. We recognize a bargain purchase gain within other income expense net on the consolidated statement of operations if the net fair value of the identifiable assets acquired and the liabilities assumed is in excess of the fair value of the total purchase consideration and any non-controlling interest. We include the results of operations of the acquired business in the consolidated financial statements beginning on the acquisition date. Cash and cash equivalents. All highly liquid investments with an original maturity of 3 months or less at the date of purchase are considered cash equivalents. Our cash equivalents are primarily comprised of money market funds, restricted cash. We maintain certain cash balances restricted as to withdrawal or use. Our restricted cash is comprised primarily of cash as collateral for our sales to lease partners with a resale value guarantee. Letters of credit, real estate leases, insurance policies, credit card borrowing facilities, and certain operating leases. In addition, restricted cash includes cash received from certain fund investors that have not been released for use by us, and cash held to service certain payments under various secured debt facilities. The following table totals cash and cash equivalents and restricted cash is reported on the consolidated balance sheets. The sums are presented in the consolidated statements of cash flow in millions. December 31, 2019, December 31, 2018, December 31, 2017, December 31, 2016. Cash and cash equivalents, 6268, 3686, 3368, 3393. Restricted cash current portion, 246, 193, 155, 106. Restricted cash net of current portion, 269, 398, 442, 268. Total is presented in the consolidated statement of cash flows: 6783, 4277, 3965, 3767. Accounts receivable and allowance for doubtful accounts. Accounts receivable primarily includes amounts related to receivables from financial institutions and leasing companies offering various financing products to our customers, sales of energy generation and storage products, sales of regulatory credits to other automotive manufacturers, and maintenance services on vehicles owned by leasing companies. We provide an allowance against accounts receivable to the amount we reasonably believe will be collected. We write off accounts receivable when they are deemed uncollectible. We typically do not carry significant accounts receivable related to our vehicle and related sales, as customer payments are due prior to vehicle delivery, except for amounts due from commercial financial institutions for approved financing arrangements between our customers and the financial institutions. Done with page 83, if you're following along. About a minute behind if we want to go back to the 5 minute. We're at 106. My Power customer notes receivable. We have customer notes receivable under the legacy My Power loan program. My Power was offered by Solar City to provide residential customers with the option to finance the purchase of a solar energy system through a 30-year loan. The outstanding balances net of any allowance for potentially uncollectible amounts are presented on the consolidated balance sheet as a component of prepaid expenses and other current assets for the current portion, and as My Power customer notes receivable net of current portion for the long-term portion. In determining the allowance and credit quality for customer notes receivable, we identify significant customers with known disputes or collection issues, and also consider our historical level of credit losses and current economic trends that might impact the level of future credit losses. Customer notes receivable that are individually impaired are charged off as a write-off of the allowance for losses since acquisition. There have been no new significant customers with known disputes or collection issues, and the amount of potentially uncollectible amounts has been insignificant. In addition, there were no material non-accrual or past due customer notes receivable as of December 31, 2019. Concentration of risk, credit risk, financial instruments that potentially subject us to a concentration of credit risk consist of cash, cash equivalents, restricted cash, accounts receivable, convertible note hedges, and interest rate swaps. Our cash balances are primarily invested in money market funds or on deposit at high credit quality financial institutions in the U.S. These deposits are typically in excess of insured limits. As of December 31, 2019 and 2018, no entity represent 10% or more of our total accounts receivable balance. The risk of concentration for our interest rate swaps is mitigated by transacting with several highly rated multinational banks. Hopefully. Supply risk. We are dependent on our suppliers, the majority of which are single source suppliers, and the inability of these suppliers to deliver necessary components of our products in a timely manner at prices, quality levels, and volume acceptable to us, or our inability to efficiently manage these components from these suppliers could have a material adverse impact on our business prospects, financial condition, and operating results. Inventory valuation. Inventories are stated at the lower of cost or net realizable value. Cost is computed using standard cost for vehicles and energy storage products, which approximates actual cost on a first in, first out basis. In addition, cost for solar energy systems is recorded using actual cost. We record inventory write-downs for excess or obsolete inventories based on assumptions about current and future demand forecasts. If our inventory on hand is in excess of future demand forecasts, the excess amounts are written off. We also review our inventory to determine whether its carrying value exceeds the net amount realizable upon the ultimate sale of the inventory. This requires us to determine the estimated selling price of our vehicles less the estimated cost to convert the inventory on hand into a finished product. Once inventory is written down, a new lower cost basis for that inventory is established, and subsequent changes in facts and circumstances do not result in the restoration or increase in the newly established cost basis. Should our estimates of future selling prices or production costs change. Additional and potentially material increases to this reserve may be required. A small change in our estimates may result in a material change to our reported financial results. Okay, we're back on time. Done with page 84. This is a long page. Operating lease vehicles. Vehicles that are leased as part of our direct vehicle leasing program. Vehicles delivered to leasing partners with a resale value guarantee and buyback option, and vehicles delivered to customers with resale value guarantee where exercise is probable are classified as operating lease vehicles as the related revenue transactions are treated as operating leases under ASC 842. Refer to the automotive leasing revenue section above for details. Operating lease vehicles are recorded at cost less accumulated depreciation. We generally depreciate their value less salvage value using the straight line method to cost of automotive leasing revenue over the contractual period. The cost of operating lease vehicles recorded on the consolidated balance sheets as of December 31, 2019 and 2018 was $2.85 billion and $2.55 billion respectively. Accumulated depreciation related to leased vehicles as of December 31, 2019 and 2018 was $406 million and $458 million respectively. Solar Energy Systems net. We're the lessor of Solar Energy Systems prior to January 1st, 2019. These leases were accounted for as operating leases in accordance with ASC 840. Under ASC 840, to determine lease classifications, we evaluated the lease terms to determine whether there was a transfer of ownership or bargain purchase option at the end of the lease, whether the lease term was greater than 75% of the useful life, or whether the present value of the minimum lease payments exceeded 90% of the fair value at lease inception. As discussed in the leases section above, agreements for solar energy system leases and PPAs that commence after January 1, 2019 no longer meet the definition of a lease upon the adoption of ASC 842 and are instead accounted for in accordance with the new revenue standard. We utilize periodic appraisals to estimate useful lives and fair values at lease inception and residual values at lease termination. Solar energy systems are stated at cost less accumulated depreciation. Depreciation and amortization is calculated using the straight line method over the estimated useful lives of the respective assets as follows. Solar energy systems in service 30 to 35 years. Initial direct costs related to customer solar energy system lease acquisition cost, lease term up to 25 years. Solar energy systems pending interconnection will be depreciated as solar energy systems in service when they have been interconnected and placed in service. Solar energy systems under construction represent systems that are under installation, which will be depreciated as solar energy systems in service when they are completed, interconnected, and placed in service. Initial direct costs related to customer solar energy system agreement acquisition costs are capitalized and amortized over the term of the related customer agreements. Property, plant, and equipment net. Property, plant, and equipment net, including leasehold improvements, are recognized at cost less accumulated depreciation. Depreciation is generally computed using the straight line method over the estimated useful lives of the respective assets as follows. Machinery, equipment, vehicles, and office furniture 2 to 12 years. Building improvements 15 to 30 years. Computer equipment and software 3 to 10 years. Leasehold improvements are depreciated on a straight line basis over the shorter of their estimated useful lives or the terms of their related leases. Upon the retirement or sale of our property, plant, and equipment, the costs and associated accumulated depreciation are removed from the consolidated balance sheet, and the resulting gain or loss is reflected on the consolidated statement of operations. Maintenance and repair expenditures are expensed as incurred, while major improvements that increase the functionality, output, or expected life of an asset are capitalized and depreciated ratably over the identified useful life. That makes sense. All right, done with page 85. A little bit ahead of schedule, about 30 seconds. Is that annoying? I don't know if it's annoying to keep saying that. Nobody's watching because I'm not doing a live stream. I'm just recording this so I can go straight through. Take a break for 1/2 a second. Okay. Interest expense on outstanding debt is capitalized during the period of significant capital asset construction. Capitalized interest on construction in progress is included within property, plant, and equipment and is amortized over the life of the related assets. Prior to the adoption of the new lease standard, we were deemed to be the owner for accounting purposes during the construction phase of certain long-lived assets under build-to-suit lease arrangements. Because of our involvement with the construction, of our exposure to any potential cost overruns, or our other commitments under the arrangements. In accordance with ASC 840, recognize build-to-suit lease assets under construction and corresponding build-to-suit lease liabilities on the consolidated balance sheet. Once construction was completed, if a lease met certain sale-leaseback criteria, we removed the asset and liability and accounted for the lease as an operating lease. Otherwise, the lease was accounted for as a capital lease. As a result of the adoption of the new lease standard on January 1, 2019, we have de-recognized all build-to-suit lease assets and have reassessed these leases to be operating lease right of use assets within the consolidated balance sheet as of December 31, 2019. Refer to leases section above for details. Long-lived assets, including acquired intangible assets. We review our property, plant, and equipment, long-term prepayments, and intangible assets for impairment whenever events or changes in circumstances indicate that the carrying amount of an asset or asset group may not be recoverable. We measure recoverability by comparing the carrying amount to the future undiscounted cash flows that the asset is expected to generate. If the asset is not recoverable, its carrying amount would be adjusted down to its fair value. For the years ended December 31, 2019 and 2018, we have recognized certain impairments of our long-lived assets. Refer to Note 4, Goodwill and Intangible Assets, and Note 22, Restructuring and Other. For further details, we will. For the year ended December 31, 2017, I'm not even talking to anybody, we have recognized no material impairments of our long-lived assets. Intangible assets with definite lives are amortized on a straight-line basis over their estimated useful lives, which range from 1 to 30 years. If you're listening right now, it'd be interesting to comment 86, which is the page we're on. And I guess it'll just be between me and you. It'll be cool to read that. Goodwill. We assess goodwill for impairment annually in the fourth quarter or more frequently if events or changes in circumstances indicate that it might be impaired by comparing its carrying value to the reporting unit's fair value. For the years ended December 31, 2019, 2018, and 2017, we had not recognized any impairment of goodwill. Capitalization of software costs. For costs incurred in development of internal use software, we capitalize costs incurred during the application of development stage. Costs related to preliminary project activities and post-implementation activities are expensed as incurred. Internal use of software is amortized on a straight line basis over its estimated useful life of 3 to 10 years. We evaluate the useful lives of these assets on an annual basis, and we test for impairment whenever events or changes in circumstances occur that could impact the recoverability of these assets. Foreign currency, we determine the functional and reporting currency of each of our international subsidiaries and their operating divisions based on the primary currency in which they operate. In cases where the functional currency is not the US dollar, we recognize a cumulative translation adjustment created by the different rates we apply to accumulated deficits, including current period income or loss in the balance sheet. For each subsidiary, we apply the monthly average functional exchange rate to its monthly income or loss and the month-end functional currency rate to translate the balance sheet. Foreign currency transaction gains and losses are a result of the effect of exchange rate changes on transactions denominated in currencies other than the functional currency. Transaction gains and losses are recognized in other income expense net in the consolidated statements of operations. For the years ended December 31, 2019, 2018, 2017, we recorded foreign currency transaction gains of $48 million, gains of $2 million, and losses of $52 million, respectively. This seems like it's going, I'm going to jinx myself, but it seems like it's going fast. Well, here's a big page. We're about 20 seconds ahead. Warranties. We provide a manufacturer's warranty on all new and used vehicles and production powertrain components and systems we sell. In addition, we also provide a warranty on the installation and components of the energy generation and storage systems we sell for periods typically between 10 to 25 years. We accrue a warranty reserve for the products sold by us, which includes our best estimate of the projected cost to repair or replace items under warranties and recalls when identified. These estimates are based on actual claims incurred to date and an estimate of the nature, frequency, and costs of future claims. These estimates are inherently uncertain given our relatively short history of sales, and changes to our historical or projected warranty experience may cause material changes to the warranty reserve in the future. The warranty reserve does not include projected warranty costs associated with our vehicles subject to lease accounting and our solar energy systems under the lease contracts or PPAs, as the cost to repair these warranty claims are expensed as incurred. The portion of the warranty reserve expected to be incurred within the next 12 months is included within accrued liabilities and other, while the remaining balance is included within other long-term liabilities. On the consolidated balance sheets, warranty expense is recorded as a component of cost of revenues in consolidated statements of operations. Due to the magnitude of our automotive business, accrued warranty balance as of December 31st, 2019 was primarily related to our automotive segment. Accrued warranty activity consisted of the following: in millions, year ended December 31, 2019, 2018, 2017, accrued warranty beginning of period 748, 402, 267, assumed warranty liability from acquisition 5, warranty costs incurred negative 250, negative 209, negative 123, net changes in liability for pre-existing warranties, including expirations and foreign exchange impact 36, negative 26, 4, additional warranty accrued from adoption of the new revenue standard 37, provision for warranty 555, 544, 249, accrued warranty end of period 1089, 748, 402. For the years ended December 31, 2019 and 2018 and 2017, warranty costs incurred for vehicles accounting for as operating leases were $20 million and $22 million and $36 million respectively. Solar renewable energy credits. We account for solar renewable energy credits, SRECs, when they are purchased by us or sold to third parties. For SRECs generated by solar energy systems owned by us and minted by government agencies, we do not recognize any specifically identifiable costs, as there are no specific incremental costs incurred to generate SRECs. We recognize revenue within the energy generation and storage segment from the sale of an SREC when the SREC is transferred to the buyer, and the cost of the SREC, if any, is then recorded to energy generation and storage cost of revenue. Deferred investment tax credit revenue. We have solar energy systems that are eligible for ITCs that accrue to eligible property under the Internal Revenue Code IRC under Section 50D5 of the IRC and the related regulations. A lessor of qualifying property may elect to treat the lessee as the owner of such property for the purposes of claiming the ITCs associated with such property. These regulations enable the ITCs to be separated from the ownership of the property and allow the transfer of the ITCs. Excuse me. Under our lease pass-through fund arrangements, we can make a tax election to pass through the ITCs to the investors who are the legal lessee of the property. Therefore, we are able to monetize these ITCs to the investors who can utilize them. In return for cash payments, we consider the monetization of ITCs to constitute one of the key elements of realizing the value associated with solar energy systems. Consequently, we consider the proceeds from the monetization of ITCs to be a component of revenue generated from solar energy systems. Done with 87. Okay, we're about still 20 seconds ahead. Under the new revenue standard, we recognize revenue upon the delivery of ITCs to investors under our lease pass-through fund arrangements, as this is the point in time that control of ITC is transferred. We indemnify the investors for any recapture of ITCs due to our non-compliance. We have concluded that the likelihood of a recapture event is remote, and consequently, we have not recognized a liability for this indemnification on the consolidated balance sheets. Sorry. Nevada tax incentives, we had entered into agreements with the state of Nevada and Story County in Nevada that provide abatements for sales, use, real property and personal property, and employer excise taxes, discounts to the base tariff, energy rates, and transferable tax credits. These incentives are available for the applicable periods beginning on October 17, 2014 and ending on either June 30, 2024 or June 30, 2034, depending on the incentive. Under these agreements, we were eligible for a maximum of $195 million of transferable tax credits, subject to capital investments by us and our partners for Gigafactory Nevada of at least $3.5 billion, which we exceeded during 2017, and specified hiring targets for Gigafactory Nevada, which we exceeded during 2018. We recorded these credits as earned when we had evidence there was a market for their sale. Credits were applied as a cost offset to either employee expense or to capital assets, depending on the source of the credits. Credits earned from employee hires or capital spending by our partners at Gigafactory Nevada were recorded as a reduction to operating expenses. As of December 31, 2019 and 2018, we had earned the maximum $195 million of transferable tax credits under these agreements. Recently issued accounting pronouncements not yet adopted. In June 2016, the FASB issued ASU number 2016-13, Measurement of Credit Losses on Financial Instruments, to require financial assets carried at amortized cost to be presented at the net amount expected to be collected based on historical experience, current conditions, and forecasts. Subsequently, the FASB issued ASU number 2018-19, Codification Improvements to Topic 326, to clarify that receivables arising from operating leases are within the scope of lease accounting standards. Further, the FASB issued ASU number 2019-04, ASU number 2019-05, ASU 2019-10, and ASU 2019-11 to provide additional guidance on the credit losses standard. The ASUs are effective for interim and annual periods beginning after December 15, 2019, with early adoption permitted. Adoption of the ASUs is on a modified retrospective basis. We plan to adopt the ASUs on January 1st, 2020. The ASUs are currently not expected to have a material impact on our consolidated financial statements. In January 2017, the FASB issued ASU number 2017-04, simplifying the test for goodwill impairment. To simplify the test for goodwill impairment by removing step 2, an entity will therefore perform the goodwill impairment test by comparing the fair value of a reporting unit with its carrying amount and recognizing an impairment charge for the amount by which the carrying amount exceeds the fair value, not to exceed the total amount of goodwill allocated to the reporting unit. An entity still has the option to perform a qualitative assessment to determine if the quantitative impairment test is necessary. The ASU is effective for interim and annual periods beginning after December 15, 2019, with early adoption permitted. Adoption of the ASU is prospective. We plan to adopt the ASU prospectively on January 1st, 2020. The ASU is currently not expected to have a material impact on our consolidated financial statements. In August 2018, the FASB issued ASU number 2018-15, Customers Accounting for Implementation Costs Incurred in a Cloud Computing Arrangement that is a service contract. The ASU aligns the requirements for capitalizing implementation costs incurred in a hosting arrangement that is a service contract with the requirements for capitalizing implementation costs incurred to develop or obtain internal use software and hosting arrangements that include an internal use software license. The ASU is effective for interim and annual periods beginning after December 15th, 2019, with early adoption permitted. Adoption of the ASU is either retrospective or prospective. We plan to adopt the ASU prospectively on January 1st, 2020. The ASU is currently not expected to have a material impact on our consolidated financial statements. Done with 88. We're still about 20 seconds. We're riding that line. On December 2019, the FASB issued ASU number 2019-12, simplifying the accounting for income taxes as part of its initiative to reduce complexity in accounting standards. The amendments in the ASU are effective for fiscal years beginning after December 15, 2020, including interim periods therein. Early adoption of the standards permitted, including adoption in interim or annual periods for which financial statements have not yet been issued. We have not early adopted this ASU for 2019. The ASU is currently not expected to have a material impact on our consolidated financial statements. Recently adopted accounting pronouncements. In February 2016, the FASB issued ASU number 2016-02, leases to require lessees to recognize all leases with limited exceptions on the balance sheet, while recognition on the statement of operations will remain similar to legacy lease accounting ASC 840. The ASU also eliminates real estate specific provisions and modifies certain aspects of lessor accounting. Subsequently, the FASB issued ASU number 2018-10, codification improvements to topic 842, ASU number 2018-11, targeted improvements, ASU number 2018-20, narrow scope improvements for lessors, and ASU 2019-01, codification improvements to clarify and amend the guidance in ASU number 2016-02. We adopted the ASUs on January 1st, 2019 on a modified retrospective basis through a cumulative adjustment to our beginning accumulated deficit balance. Prior comparative periods have not been recast under this method, and we adopted all available practical expedients as applicable. Further, solar leases that commence on or after January 1st, 2019, where we are the lessor and which were accounted for as leases under ASC 840, will no longer meet the definition of a lease. Instead, solar leases commencing on or after January 1st, 2019 will be accounted for under the new revenue standard, in addition to recognizing operating leases that were previously not recognized on the consolidated balance sheet. Our build-to-suit leases were also derecognized with a net decrease of approximately $97 million to our beginning accumulated deficit. This is some paragraph. After income tax effects, as our build-to-suit leases no longer qualify for build-to-suit accounting and are instead recognized as operating leases under adoption, our consolidated balance sheet include upon adoption, our consolidated balance sheet. It's another typo. Include an overall reduction in assets of $473 million and a reduction in liabilities of $570 million. The adoption of the ASUs did not have a material impact on the consolidated statement of operations or the consolidated statement of cash flows. In August 2017, the FASB issued ASU number 2017-12, targeted improvements to accounting for hedging activities to simplify the application of current hedge accounting guidance. The ASU expands and refines hedge accounting for both non-financial and financial risk components, and aligns the recognition and presentation of the effects of the hedging instrument and the hedged item in the financial statements. We adopted the ASU prospectively on January 1st, 2019, and the ASU did not have a material impact on the consolidated financial statements. In January 2018, the FASB issued ASU number 2018-01, Land Easement Practical Expedient Transition to Topic 842, to permit an entity to elect a practical expedient to not reevaluate land lease easements that existed or expired before the entity's adoption of ASU number 2016-02 leases and that were not accounted for as leases. The ASU did not have a material impact on the consolidated financial statements. 50 seconds to do this. Note 3, business combinations, Maxwell acquisition. On May 16, 2019, the acquisition date, we completed our strategic acquisition of Maxwell Technologies, Inc., Maxwell, an energy storage and power delivery products companies for its complementary technology and workforce. Pursuant to the related agreement and plan of merger, the merger agreement, each issued outstanding share of Maxwell common stock was converted into 193, the exchange ratio shares of our common stock. In addition, Maxwell stock option awards and restricted stock units were assumed by us and converted into corresponding equity awards in respect of our common stock based on the exchange ratio, with the awards retaining the same vesting and other terms and conditions as in effect immediately prior to the acquisition. Fair value of purchase consideration, the acquisition date fair value of the purchase consideration was 207,902,968 shares issued at $229.49 per share, the opening price of our common stock on the acquisition date. And that's page 89. Ran a little bit over, so I'm just going to keep going. This should be a decent one. Sorry for all the sighing. I'm trying to just keep my breath. Fair value of assets acquired and liabilities assumed. We accounted for the acquisition using the purchase method of accounting for business combinations under ASC 805 business combinations. The total purchase price is allocated to the tangible and identifiable intangible assets acquired and liabilities based on their estimated fair values as of the acquisition date. Fair value estimates are based on a complex series of judgments about the future events and uncertainties and rely heavily on estimates and assumptions. The judgments used to determine the estimated fair value assigned to each class of assets acquired and liabilities assumed, as well as asset lives and the expected future cash flows and related discount rates, can materially impact our consolidated financial statements. Significant inputs used for the model included the amount of cash flows, the expected period of the cash flows, and the discount rates. In 2019, we finalized our estimate of the acquisition date, fair values of the assets acquired and liabilities assumed, and there were no changes to the fair values of the assets acquired and liabilities assumed. The allocation of the purchase price is based on management's estimate of the acquisition date, fair values of the assets acquired and liabilities assumed as follows in millions. And again, I'm just reading everything in millions or assuming everything's in millions. So 32 million is just 32. Assets acquired, cash equivalents 32, accounts receivable 24, inventory 32, property, plant, and equipment net. This is where I get into trouble not being able to use this thing. 27, operating lease right of use assets 10, intangible assets 105, prepaid expenses and other assets, current and non-current 3, total assets acquired 233, liabilities and equity assumed, accounts payable -10, accrued liabilities and other -28, debt and finance leases current and non-current -44, deferred revenue current -1, other long-term liabilities -14, additional paid-in capital -8, total liabilities and equity assumed -105, net assets acquired 128, goodwill 79, total purchase price 207. Goodwill represented the excess of the purchase price over the fair value of the net assets acquired and was primarily attributable to the expected synergies from integrating Maxwell's technology into our automotive segment, as well as the acquired talent. Goodwill is not deductible for U.S. income tax purposes and it's not amortized. Actually, did I know that? I'm not sure if I knew that. I guess I knew that. You can have a goodwill write-down, though. Identifiable intangible assets acquired, the determination of the fair value of identified intangible assets and their respective useful lives are as follows in millions, except for estimated useful life. Fair value, useful life in years. Developed technology 102.9, customer relations 2.9, trade name 110, total intangible assets. And that's page 90. And I am keeping track of the page number right up there in the upper left. And we're about a minute and 15 seconds ahead. So I think I'll use the opportunity to keep going. Maxwell's results of operations since the acquisition date have been included within the automotive segment. Standalone and pro forma results of operations have not been presented because they were not material to the consolidated financial statements. Other acquisitions during the year ended December 31, 2019, we completed various other acquisitions generally for the related technology and workforce. Total consideration for these acquisitions was $96 million, of which $80 million was paid in cash. In aggregate, $36 million was attributed to intangible assets. $51 million was attributed attributed to goodwill within the automotive segment, and $9 million was attributed to net assets assumed. Goodwill is not deductible for U.S. income tax purposes. The identifiable intangible assets are related to purchase technology with estimated useful lives of 1 to 9 years. Standalone and pro forma results of the operations have not been presented because they were not material to the consolidated financial statements, either individually or in aggregate. Note 4, goodwill and intangible assets. Goodwill increased $130 million from $68 million as of December 31, 2018 to $198 million as of December 31st, 2019, primarily due to completed business combinations during the year ended December 31, 2019. See Note 3, business combinations. There were no accumulated impairment losses. I guess that's what I was talking about, but I should look that up. As of December 31, 2019 and 2018, information regarding our intangible assets, including assets recognized from our acquisitions, was as follows: in millions, December 31, 2019, December 31, 2018. Finite lived intangible assets. Developed technology, 291, negative 72, 220, 152, negative 40, 113. I should have done this yesterday. It would have been easier. Trade names, 3, negative 1, 1, 3, 45, negative 44, 1. Favorable contracts and leases, net 113, negative 2489, 113, negative 1796, other 38, negative 16, 22, 36, negative 12, 125. Total finite lived intangible assets, 445, negative 113, 2, 334, 346, negative 113, 2, 235. Indefinite lived intangible assets, Gigafactory Nevada, water rights, 5 in process research and development, IPR&D, 60, negative 60, 60, negative 13, 47. Total indefinite lived intangible assets, 65, negative 60, 60, negative 13, 47. Total intangible assets, 510, negative 113, negative 58, 339, 406, negative 113, negative 11. 282. During 2019, the company determined to abandon further development efforts on the IPR&D and therefore impaired the remaining $47 million in restructuring and other expenses in the consolidated statement of operations. Amortization expense during the years ended December 31, 2019, 2018, and 2017 was $44 million, $66 million, and $40 million respectively. I'm not sure. I think we ran over there. I think we ran 2 minutes over. Let's see if we... Yeah, we probably... Maybe. I don't know, actually. Is anybody keeping track? Total future amortization expense for finite-lived intangible assets, I shouldn't be talking to myself, was estimated as follows in millions: 2020, 50, 2021, 49, 2022, 48, 2023, 42, 2024, 27, thereafter, 118, total 334. Fair value of financial instruments. I'm feeling really good. Famous last words, but we're going through this at an okay rate. It seems a lot easier than yesterday, even though we're going to have to do a lot more than we did yesterday in order to finish this. But we're doing it, everyone. Note 5, fair value of financial instruments. ASC 820 fair value measurement states that fair value is an exit price representing the amount that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants. As such, fair value is a fair value is a market-based measurement that should be determined based on assumptions that market participants would use in pricing an asset or a liability. The three-tiered fair value hierarchy, which prioritizes which inputs should be used in measuring fair value, which is comprised of level 1, observable inputs such as quoted prices in active markets. Level 2, inputs other than quoted prices in active markets that are observable either directly or indirectly. And level 3, unobservable inputs for which there is little or no market data. The fair value hierarchy requires the use of observable market data when available in determining fair value. Our assets and liabilities that were measured at fair value on a recurring basis were as follows in millions. December 31, 2019, December 31, 2018, fair value level 1, level 2, level 3, fair value level 1, level 2, level 3, money market funds, cash and cash equivalents, and restricted cash, 1632, 1632, 1813, 1813, interest rate swap asset 1, 1, 12, 12, interest rate swap liability negative 27, negative 27, negative 1, negative 1, total 1606, 1632, negative 26, 1824, 1813, 11. And we just passed. So I am blowing through a couple of these times because we just passed the 5-minute mark. All of our money market funds were classified within level 1 of the fair value hierarchy because they were valued using quoted prices in active markets. Our interest rate swaps were classified within level 2 of the fair value hierarchy because they were valued using alternative pricing sources or models that utilize market or observable inputs, including current and forward interest rates. During the year ended December 31, 2019, there were no transfers between the levels of fair value hierarchy. Interest rate swaps, we enter into fixed for floating interest rate swap agreements to swap variable interest payments on certain debt or fixed interest payments as required by certain of our lenders. We do not designate our interest rate swaps as hedging instruments. Accordingly, our interest rate swaps are recorded at fair value on the consolidated balance sheets within other assets or other long-term liabilities, with any changes in their fair values recognized as other income expense net in the consolidated statements of operations, and with any cash flows recognized as investing activities in the consolidated statements of cash flows. Our interest rate swaps outstanding were as follows in millions. And if you're listening to this, it's just a table. December 31, 2019, December 31, 2018, aggregate notional amount, gross asset at fair value, gross liability at fair value, aggregate notional amount, gross asset at fair value, gross liability at fair value, interest rate swaps, 821, 127, 800, 12, 1. And that is page 92. I think we're about a minute, 2 minutes behind. Our interest rate swaps activity was as follows in millions. Year ended December 31, 2019, 2018, 2017. Gross gains 11.22.7. Gross losses 51.12.13. Disclosure of fair values. Our financial instruments that are not remeasured at fair value include accounts receivable, MyPower, customer notes receivable, rebates receivable, accounts payable, accrued liabilities, and customer deposits, participation, interest, and debt. The carrying values of these financial instruments other than our 1.25% convertible senior notes due in 2021, 2.375 convertible senior notes due in 2022, and 2% convertible notes due in 2024, and our subsidiary zero coupon convertible senior notes due in 2020, collectively referred to as convertible senior notes below, 5.3% senior notes due in 2025. Solar asset-backed notes and solar loan-backed notes approximate their fair values. We estimate the fair value of the convertible senior notes and the 5.3% senior notes due in 2025 using commonly accepted valuation methodologies and market-based risk measurements that are indirectly observable, such as credit risk level 2. In addition, we estimate the fair values of our solar asset-backed notes and solar loan-backed notes based on rates currently offered for instruments with similar maturities and terms. Level 3, the following table presents the estimated fair values and the carrying values in millions. December 31, 2019, December 31, 2018, carrying value, fair value, fair value, convertible senior notes, 3686, 6067, 3661, 4347, 5.3% senior notes due in 2025, 1782, 1748, 1779, 1575, solar asset-backed notes, 1155, 1211, 1183, 1207, solar loan-backed notes, 175, 189, 203, 212. Long page. Note 6, inventory. Our inventory consisted of the following in millions: December 31, 2019, December 31, 2018, raw materials 1428, 932, work in process 362, 297, finished goods 1356, 1581, service parts 406, 303, total 3552, 3113. 1. Finished goods inventory includes vehicles in transit to fulfill customer orders, new vehicles available for sale, and used vehicles and energy storage products for solar energy systems. We commence transferring component parts from inventory to construction in progress, a component of solar energy systems. Once a lease or PPA contract with the customer has been executed and installation has been initiated, additional costs incurred on the leased solar energy systems, including labor and overhead, are recorded within construction in progress. We write down inventory for any excess or obsolete inventories, or when we believe that the net realizable value of inventories is less than the carrying value. During the years ended December 31, 2019, 2018, and 2017, we recorded write-downs of $138 million, $78 million, and $124 million, respectively, in cost of revenues. That's 93. And it just crossed my mind that I forgot to read 1X on the very first page because I was just rewatching the earlier video that I did yesterday to make sure it worked. And I watched the very beginning of it. And I read this little part here that says Mark 1. And then I just went to annual report pursuant. But I didn't read the X. So I'm just going to do it now. Mark 1, X. Annual report pursuant to Section 13 or 15D of the Securities Exchange Act of 1934. Okay. And I know we're done with page 93. So I'll just go back down there. Wait a minute. Okay, yeah. Following in millions: December 31, 2019, December 31, 2018. Solar energy systems in service 6682, 6431. Initial direct costs related to customer amortization expense during the years ended December 31, 2019, 2018, and 2017 was $227 million, $276 million, and $213 million, respectively. That was 1, 2. As of December 31, 2019 and 2018, solar energy systems net included $36 million of gross finance leased assets with accumulated depreciation and amortization of $6 million and $4 million, respectively. I didn't have coffee last night. I should have done that. Note 8, property, plant, and equipment net. Our property, plant, and equipment net consisted of the following in millions: December 31, 2019, December 31, 2018, machinery, equipment, vehicle, and office furniture 7167.60, 329, tooling 1493, 1398, leasehold improvements 1087, 961, land and buildings 3024, 4047, computer equipment, hardware, and software 595, 487, construction in progress 764, 807, 14130, 14029, less accumulated depreciation 3734, 2699, total 10396, 11330. As of December 31, 2018, the table above included $1.69 billion of gross build-to-suit lease assets as a result of the adoption of the new lease standard. On January 1st, 2019, we have de-recognized all build-to-suit lease assets and have reassessed these leases to be operating lease right of use assets within the consolidated balance sheet as of December 31, 2019. See Note 2, Summary of Significant Accounting Policies. Construction in progress is primarily comprised of tooling and equipment related to the manufacturing of our products and Gigafactory Shanghai construction. Completed assets are transferred. Please subscribe, by the way. This is really hard. This is like 100 times harder than I thought. Completed assets are transferred to their respective asset classes, and depreciation begins when an asset is ready for its intended use. Interest on outstanding debt is capitalized during periods of significant capital asset construction and amortized over the useful lives of the related assets. During the years ended December 31, 2019 and 2018, we capitalized $31 million and $55 million respectively of interest depreciation expense. During the years ended December 31, 2019, 2018, and 2017 was $1.37 billion, $1.11 billion, and $769 million respectively. Gross property, plant, and equipment under finance leases as of December 31, 2019 and 2018 was $2.08 billion and $1.52 billion respectively. Accumulated depreciation on property, plant, and equipment under finance leases as of these dates was $483 million and $232 million respectively. We're doing it, boys and girls, because I know there are women, there are girls that watch this too. Not as many. Okay, we're done with page 94. We're on page 95. 100, I don't want to jinx, but 100 is within sight. And these will probably be, these look like hard pages coming up. Panasonic has partnered with us on Gigafactory Nevada with investments in the production equipment that it uses to manufacture. And I haven't really been looking at we're almost coming up on 2 hours, so let me finish this quickly. Panasonic has partnered with us on Gigafactory Nevada with investments in the production equipment that it uses to manufacture and supplies with battery cells. Under our arrangement with Panasonic, we plan to purchase the full output from their production equipment at negotiated prices. As the terms of the arrangement convey a finance lease under ASC 842 leases, we account for their production equipment as leased assets when production commences. This results in us recording the cost of their production equipment within property, plant, and equipment net on the consolidated balance sheets, with the corresponding liability recorded to debt and finance leases. As of December 31, 2019 and 2018, we had cumulatively capitalized costs of $1.73 billion and $1.24 billion respectively on the consolidated balance sheets in relation to the production equipment under our Panasonic arrangement. We had cumulatively capitalized total costs for Gigafactory Nevada, including costs under our Panasonic arrangement, of $5.27 billion and $4.62 billion as of December 31, 2019 and 2018 respectively. In 2019, the Shanghai government agreed to provide $85 million of certain incentives in connection with us making certain manufacturing equipment investments at Gigafactory Shanghai, of which $46 million was received in cash and the remaining $39 million was in the form of assets and services contributed by the government. These incentives were taken as a reduction to property, plant, and equipment net on the consolidated balance sheet. Note 9. Accrued and other. As of December 31, 2019 and 2018, accrued liabilities and other current liabilities consisted of the following in millions: December 31, 2019, December 31, 2018, accrued purchases 1, 638, 394, payroll and related costs 466, 449, taxes payable 2, 611, 348, accrued interest 86, 78, financing obligation current portion 57, 62, accrued warranty current portion 344, 201, sales return reserve current portion 272, 108, build to suit lease liability current portion 82, operating lease right of use liabilities current portion 228, other current liabilities 203, 372, total 2905, 2094. 1. Accrued purchases primarily reflects receipts of goods and services that we had not been invoiced yet. As we are invoiced for these goods and services, this balance will reduce and accounts payable will increase. Taxes payable. 2. Taxes payable includes 1, in case I didn't say it, value-added tax, sales tax, property tax, use tax, income tax payables. Due to price adjustments we made to our vehicle offerings during 2019. Just got another idea for a video. I'm going to write it down real quick. Due to price adjustments we made, I hope that's where I'm at. Yeah. We made to our vehicle offerings during 2019, we increased our sales return reserve significantly on vehicles previously sold under a buyback options program. See Note 2, summary of significant accounting policies for details. As of December 31, 2018, the table above included $82 million of current build-to-suit lease liabilities as a result of the adoption of the new lease standard on January 1st, 2019. We have derecognized all build-to-suit lease liabilities and have reassessed these leases to be operating lease right of use liabilities as of December 31, 2019. So we're done with 95, and we just crossed the 2-hour mark right there. So let's just see where we're at. We did 26 pages. That's 13 pages per hour. So we have exactly 66 pages left, right? Because we're on 96. We need to go to 56. So that's a lot. 66 pages left. 13 pages an hour. 5 hours left. God almighty. 5 hours left. Note 10, other long-term liabilities. As of December 31, 2019 and 2018, other long-term liabilities consisted of the following in millions. December 31, 2019, December 31, 2018, accrued warranty reserve 745. Maybe I should say that. Screw it. 547, build to suit lease liability 1662, 956, operating lease right of use liabilities 956, deferred rent expense 59, financing obligation 3750, sales return reserve 545.84, other non-current liabilities 372, 308. Don't lose. Keep going. Total other long-term liabilities 2655, 2710. As of December 31, 2018, the table above included $1.66 billion of non-current build-to-suit lease liabilities as a result of the adoption of the new lease standard on January 1st, 2019, and we have derecognized all build-to-suit lease liabilities and have reassessed these leases to be operating lease right-of-use liabilities as of December 31, 2019. Due to price adjustments we made to our vehicle offerings during 2019. They've talked about this a lot. We increased our sales return reserve significantly on vehicles previously sold under a buyback options program. Refer to Note 2, summary of significant accounting policies for details on these transactions. Note 11, customer deposits. Customer deposits primarily consisted of cash payments from customers at the time they place an order or reservation for a vehicle or an energy product, and any additional payments up to the point of delivery or the completion of installation, including the fair values of any customer trade-in vehicles that are applicable toward a new vehicle purchase. Customer deposits also include prepayments on contracts that can be canceled without, it's 3:26 in the morning right now, without significant penalties such as vehicle maintenance plans, customer deposit amounts, and I got probably 3 or 4 hours of sleep last night, and timing vary depending on the vehicle. Not that you care. Sorry for telling you that. The energy product and the country of delivery. In the case of a vehicle, customer deposits are fully refundable. In the case of an energy generation or storage product, customer deposits are fully refundable prior to the entry into a purchase agreement, or in certain cases for a limited time thereafter. In accordance with applicable laws, customer deposits are included in current liabilities until refunded or until they are applied towards the customer's purchase balance as of December 31, 2019 and December 31, 2018. We held $726 million and $793 million respectively in customer deposits. Done with page 96. Note 12, debt. The following is a summary of our debt as of December 31, 2019. In millions, unpaid principal balance, net carrying value, current long-term, unused committed amount, contractual interest rates, contractual maturity date, recourse debt, 1.25%, convertible senior notes due in 2021, 2021 notes 1380, 1304, 1.25%, March 2021, 2.375% convertible notes due in 2022, 2022 notes 978, 902, 2.375%, March 2022, 2% convertible notes due in 2024, 2024 notes 1840, 1383, 2%, May 2024, 5.3% senior notes due in 2025, 2025 notes 1800, 1782, 5.3%, August 2025, credit agreement 1727, 141, 1586, 499, 2.7, 4.8%, June 2020 to July 2023. Zero coupon convertible senior notes due in 2020, 103.97, 0 December 2020. Solar bonds and other loans 70, 15, 53, 3.6 to 5.8, March 2020, January 2031. Total recourse debt 78.98, 253, 70, 10, 499. Non-recourse debt, automotive asset-backed notes 1577, 573, 997, 2% 7.9%, February 2020 to May 2023. Solar asset-backed notes 1183, 32, 1123, 4%, 7.7%, September 2024 to February 2048. Sorry. China loan agreements 741, 444, 297, 1542, 3.7% to 4%, September 2020 to December 2024. Cash equity debt 454, 10, 430, 5.3% to 5.8%, July 2023 to January 2035. Solar backed notes 182, 11, 164, 4.8 to 7% to 7.5%, September 2048 to September 2049. Warehouse agreements 167.21, 146, 933, 3.1% to 3.6%, September 2021. Solar term loans 161, 8, 152, 5.4%, January 2021. Canada, credit facility 40, 24, 16, 4.2% to 5.9%, November 2022. Solar renewable energy credit. I knew I shouldn't have said that I had coffee. And other loans, famous last words 89, 23, 67, 6, 4.5 to 7.4.5% to 7.4%, March 2020 to June 2022. Total non-recourse debt 4954, 1146, 3392, 2481. Total debt 12492, 1399, 10402, 2980, and that is 97. That actually felt longer than it was. We finished about 40 seconds early. The following is a summary of our debt as of December 31, 2018, in millions, unpaid principal balance, net carrying value, current long-term, unused committed amount, 1, contractual interest rates, contractual maturity date, recourse debt, 0.25% convertible senior notes due in 2019, 2019 notes 920, 913, 0.25%, March 2019, 2021 notes 1380, 1244, 1.25%, March 2021. 2022 notes, 978, 871, 2.375%, March 2022. 2025 notes, 1800, 1779, 5.3%, August 2025. Credit agreement 1540, 1540, 231, 1% plus LIBOR, June 2020. 1.65% convertible senior notes due in 2019, 566, 541, 1.65% November 2019. Zero coupon convertible senior notes due in 2020, 103, 92, 0, December 2020. Vehicle, solar bonds, and other loans, 101. I was hoping that wouldn't happen. 100, 1.8% to 7.6%, January 2019 to January 2031. Total recourse debt 7388, 1455, 5626, 231. Total recourse debt, solar asset-backed notes 12, 14, 28. This is probably a better way to do it. $11.55, 4% to 7.7%, September 2024 to February 2048. Automotive asset-backed notes 1178, 468, 704, 2.3% to 7.9%, December 2019 to June 2022. Cash equity debt 467.11, 442, 5.3% to 5.8%, July 2033, January 2035. Solar term loans 350, 188, 162, 6% to 6.1%, January 2019 to January 2021. Solar loan backed notes 210, 10, 193, 4.8%, 7.5%, September 2048 to September 2049. Warehouse agreements 92, 1478, 1008, 3.9% to 4.2%, September 2020. Canada credit facility 73, 32, 41, 3.6% to 5.9%, November 2022. Solar renewable energy credit and other loans 27, 16, 10, 18, 5.1% to 7.9%, December 2019 to July 2021. Total non-recourse debt 3611, 767, 2785, 1026, 10,999, 222, 8411. So sorry. 1257. Have a little more coffee soon. 1. Unused committed amounts under some of our credit facilities and financing funds are subject to satisfying specified conditions prior to drawdown, such as pledging to our lenders sufficient amounts of qualified receivables, inventories, lease vehicles, and our interests in those leases, solar energy systems, and the associated customer contracts, our interests in financing funds or other various assets. Upon drawdown of any unused committed amounts, there are no restrictions on the use of available funds for general corporate purposes. Recourse debt refers to debt that is recourse to our general assets. Non-recourse debt refers to debt that is only recourse to assets of our subsidiaries. The difference between these unpaid principal balances and the net carrying values are due to convertible senior note conversion features, debt discounts, or deferred financing costs. As of December 31, 2019, we are in material compliance with all financial debt covenants, which include minimum liquidity and expense coverage, balance, and ratios. I was just listening to this to see if the microphone's annoying. Maybe I can make it like, I wonder if that's better. Maybe not. Maybe it doesn't matter. Is that better? If you're listening, let me know. 2019 and 2021 notes, bond hedges, and warrant transactions in March 2014, we issued $800 million in aggregate principal amount of 0.25% convertible senior notes due in March 2019 and $1.2 billion in aggregate principal amount of 1.25% convertible senior notes due in March 2021 in a public offering. In April 2014, we issued an additional $120 million in aggregate principal amount of the 2019 notes and $180 million in aggregate principal amount of the 2021 notes pursuant to the exercise in full of the over-allotment options by the underwriters. The total net proceeds from the issuances after deducting transaction costs were $906 million for the 2019 notes and $1.36 billion for the 2021 notes. So that's page 98. This is sort of what last night was like, only the pages were longer. It was crazy. I think when I get to page 100 or after I finish it, I'll measure the number of words, because I measured the number of words when I started, and I think it was around, I know the total document had like something like 82,000 words, which I don't know why I thought this was going to take me a few hours, because it takes people like 24 hours to count to 100,000. And you can read faster in some instances, but anyway, this had 84,000 words. I thought I was going to finish it in a few hours. That was wrong. Anyway, when I looked today, it was to what we had left, it was about 41 or 42,000. So I guess I did do about half yesterday, even though in page count it was lower. But the early pages of this document were really long on a single page and really dense with words like this. So maybe that's why. But anyway, maybe after page 100, I'll just copy and paste this into a Word document and see what our word count is and see how much progress we've made that direction. Because maybe things are better than we think. Maybe we'll get through this more quickly. I'm going to shut up and get right back to it. Okay, each 1,000 principal of these notes is initially convertible into 2.7788 shares of our common stock, which is equivalent to an initial conversion price of $359.87 per share, subject to adjustment upon the occurrence of specified events. Holders of these notes had the option to convert on or after December 1, 2018 for the 2019 notes, and may elect to convert on or after December. I'm also going to have some coffee when I take the first break. On or after December 1st, 2020 for the 2021 notes. The settlement of such an election to convert the 2019 notes was in cash and or shares of our common stock, which we settled in cash on the maturity date. The settlement of such an election to convert the 2021 notes would be in cash for the principal amount, and if applicable, cash and or shares of our common stock for any conversion premium at our election. Further, holders of these notes may convert at their option prior to the respective dates above only under the following circumstances. This is what last night was like. 1, during a quarter in which the closing price of our common stock for at least 20 trading days, whether or not consecutive during the last 30 consecutive trading days immediately preceding the quarter, is greater than or equal to 130% of the conversion price. 2, for the 5 business days during the business day period following any 5 consecutive trading day period in which the trading price of these notes is less than 98% of the product of the closing price of our common stock and the applicable conversion rate for each day during such 5 consecutive trading day period. Or 3, if we make specified distributions to holders of our common stock, or if specified corporate transactions occur upon a conversion of the 2019 notes, we would pay or deliver as applicable cash, shares of our common stock, or a combination thereof at our election. Upon such a conversion of the 2021 notes, we would pay cash for the principal amount and, if applicable, deliver shares of our common stock, subject to our right to deliver cash in lieu of or all or a portion of such shares of our common stock based on it require us to repurchase all or a portion of their notes for cash at a repurchase price equal to 100% of the principal amount plus any accrued and unpaid interest. In addition, if the specified corporate events occur prior to the applicable maturity date, we would increase the conversion rate for a holder who elects to convert their notes in connection with such an event. In certain circumstances, as of December 31, 2019, none of the conditions permitting the holders of 2021 to early convert had been met. Therefore, the 2021 notes are classified as long-term. In accordance with GAAP relating to embedded conversion features, we initially valued and bifurcated the conversion features associated with these notes. We recorded the stockholders' equity, $188 million for the 2019 notes. I wish I had timed this page. This is what happened last night. Conversion feature, and $369 million for the 2021 notes. Conversion feature, the resulting debt discounts are being amortized to interest expense at an effective interest rate of 4.89% and 5.96%, respectively. In connection with the offering of there's no way I'm not finishing this today. Got to get this done, and you want to hear it. Otherwise, you wouldn't be listening right now. In March, the offering of these notes in March and April 2014, we entered into convertible note hedge transactions whereby we had the option to purchase 2.6 million shares of our common stock for the 2019 notes and have the option to purchase, initially subject to adjustment for certain specified events, 3.8 million shares of our common stock for the 2021 notes at a price of $359.87 per share. Curious to see how much those are worth. I kind of am. Not going to do it, though. I'm going to resist the temptation because we got to keep going. The total cost of the convertible note hedge transactions was $604 million. In addition, we sold warrants by the holders of the warrants had the option to purchase 2.6 million shares of our common stock at a price of $512.66 per share for the 2019 notes, and have the option to purchase, initially subject to adjustment for certain specified events, 3.8 million shares of our common stock at a price of $560.64 per share for the 2021 notes. We received $389 million in total cash proceeds from the sale of these warrants. Taken together, the purchases of the convertible note hedges and the sale of the warrants are intended to reduce potential dilution and or cash payments from the conversion of these notes, and to effectively increase the overall conversion price from $359.87 to $512.66 per share for the 2019 notes, and from $359.87 to $560.64 per share for the 2021 notes. As these transactions meet certain accounting criteria, the convertible note hedges and warrants are recorded in stockholders' equity and are not accounted for as derivatives. The net cost incurred in connection with the convertible note hedge and warrant transactions was recorded as a reduction to additional paid-in capital on the balance sheet. During the first quarter of 2019, we repaid the $920 million aggregate principal amount of the 2019 notes. As of December 31, 2019, the convertible note hedges and warrants associated with the 2019 notes have expired. Sorry. As of December 31, 2019, the if converted value of the 2021 notes exceeds the outstanding principal amount by $224 million. 2022 notes, bond hedges, and warrant transactions in March 2017, we issued $978 million in aggregate principal amount of 2.375% convertible senior notes due in March 2022 in a public offering. The net proceeds from the issuance after deducting transaction costs was $966 million. That was page 99. All right, page 100 looks a little bit better. Why was page 99 so bad? It wasn't. That's the problem. It was actually... Let's see. Top to bottom, it goes to right here. It's a little bit worse. But this is going to be bad too. But it's page 100. I think they wanted to stack this area. Oh. It's going to be bad till about 105. Oh, no. It's going to be bad till 104. People last night were scouting ahead and telling us and telling me where the bad pages were or the good pages. I really don't know why I'm doing this. I don't think anybody's going to watch it. Also, in case you just tuned in, the little counters right there are going to be hit in theory if I see the words battery or electric, and the numbers and colors are how many total hits, how many total potential hits there are. The number below that is how many we've seen so far. I'm really tired. I got about 3 hours of sleep last night. There may be some wisdom in taking a nap now, like a 20-minute, 15, 20-minute nap, and then getting up and doing the coffee thing, and then continuing to go. But let's get through 100. 100 is an awesome milestone. That's crazy. Each 1,000 of principal of the 2022 notes is initially convertible into 3.0534 shares of our common stock, which is equivalent to an initial conversion price of $327.50 per share, subject to adjustment upon the occurrence of specified events. Holders of the 2022 notes may convert at their option on or after December 15th, 2021. Further, holders of the 2022 notes may convert at their option prior to December 15th, 2021, only under the following circumstances: during any quarter beginning after June 30th, 2017, the closing price of our common stock for at least 20 trading days, whether or not consecutive trading days during the last 30 consecutive trading days immediately preceding the quarter is greater than or equal to 130% of the conversion price. 2, during the 5 business day period following any 5 consecutive trading day period in which the trading price of the 2022 notes is less than 98% of the product of the closing price of our common stock and the applicable conversion rate for each day during such 5 consecutive trading day period, or 3, if we make specified distributions to holders of our common stock or if specified corporate transactions occur upon a conversion, we would pay cash for the principal amount and, if applicable, deliver shares of our common stock. Subject to our right to deliver cash in lieu of all or a portion of such shares of our common stock based on the daily conversion value. If a fundamental change occurs prior to the maturity date, holders of the 2022 notes may require us to repurchase all or a portion of their 2022 notes for cash at a repurchase price equal to 100% of the principal amount plus any accrued and unpaid interest. In addition, if specified corporate events occur before the maturity date, we would increase the conversion rate for a holder who elects to convert its 2022 notes in connection with such an event in certain circumstances. As of December 31, 2019, none of the conditions permitting the holders of the 2022 notes to early convert had been met. Therefore, the 2022 notes are classified as long-term. In accordance with GAAP and relating to embedded conversion features, We initially valued and bifurcated the conversion feature associated with the 2022 notes. We recorded to stockholders' equity $146 million for the conversion feature. The resulting debt discount is being amortized to interest expense at an effective interest rate of 6%. Almost to 100. In connection with the offering of the 2022 notes, we entered into convertible note hedge transactions whereby we have the option to purchase, initially subject to adjustment for certain specified events, 3 million of our common stock at a price of $327.50 per share. The cost of the convertible note hedge transactions was $204 million. In addition, we sold warrants whereby the holders of the warrants have the option to purchase, initially subject to adjustment for certain specified events, 3 million shares of our common stock at a price of $6.55 per share. We received $533 million in cash proceeds from the sale of these warrants. Taken together, the purchase of these convertible note hedges and the sale of the warrants are intended to reduce potential dilution from the conversion of the 2022 notes and to effectively increase the overall conversion price from $327.50 to $6.55 per share, as these transactions meet certain accounting criteria. The convertible note hedges and warrants are recorded in stockholders' equity and are not accounted for as derivatives. The net cost incurred in connection with the convertible note hedge and warrant transactions was recorded as a reduction to additional paid-in capital on the consolidated balance sheet as of December 31, 2019. The if converted value of the notes exceeds the outstanding principal by $271 million. 2024 notes, bond hedges, and warrant transactions. In May 2019, we issued $1.84 billion in aggregate principal amount of 2% convertible senior notes due in May 2024 in a public offering. The net proceeds from the issuance after deducting transaction costs were $1.82 billion. Done with page 100, triple digits, and that's it. 232.40. No, 232.37. Let me see if I can do a new text thing. Yeah. Hit 100 at 232.37. And this is very meta because I guess when people go there, they'll just be watching me do this, which is kind of a waste of their time. Sorry about that. But I'll try to make it quick. Okay, where is it? Oh. Should probably say page 100. Okay, also, I was going to do a word count from here to the end because when we started today, starting from page 69, it was about 42,000 words. And when we started yesterday, it was about 82,000 words. So it'll be interesting to see how much we've gone through or gotten through today and how much we have left. We've been going for 2.5 hours. When we started, it looked like this would take about 7 hours, roughly. And then we were going a little bit faster, but not enough to really change the pace. So we are done with page 100, which means these are the number of words, and I'm just going to go, you can't see it, I guess, but I'm going to open up a new document and paste. And it's taking a minute. It's a lot of words. It's got to think. That would be funny if I crashed the computer Oh man, not a good answer. 23,777 words. So we, again, that's what's left. And on that basis, it would be about 47 and a half thousand words or something like that. But we started with like 42 or 43. So we're about halfway done plus 5,000 words at 100. And we've been going for 232. Or 2.5 hours. I'll probably take a break in a little bit. Maybe after. I'm going to try to get through page 102. There's a lot of words here. All right, sorry for all the talking. Do a little more coffee. All right. Sorry for the dead air. I was just getting a little coffee and looking at my phone for 1 second, which I shouldn't be doing. Okay. I told you to come here, and then I typed that in, and now I've just been dead air. I just got a little bit of coffee. I was just looking at my phone for 1 second. I'm actually shocked at how much we have left to do. I thought we were making good progress, but I think that's just because we weren't reading that many words. So all right. Well, the only thing to do is keep going. Each 1,000 in principal of the 2024 notes is initially convertible into 3.2276 shares. Oh, let me see where we're at. 238. 3.2276 shares of our common stock, which is equivalent to an initial conversion price of 309.83 per share, subject to adjustment upon the occurrence of specified events. Holders of the 2024 notes may convert at their option on or after February 15, 2024. Further, holders of the 2024 notes may convert at their option prior to February 15, 2024 only under the following circumstances. 1. During any calendar quarter commencing after September 30th, 2019, and only during such calendar quarter if the last reported sale price of our common stock for at least 20 trading days, whether or not consecutive, during a period of 30 consecutive trading days, ending on the last trading day of immediately preceding. God, these are crazy. Calendar quarter is greater than or equal to 130% of the conversion price on each trading day. 2. During the 5 business days prior. I think this is just because they don't want the stock spiking up and then having a weird conversion kick in. I'm going to withhold my commentary, though. I commented too much on what was going on last night, and it cost us a lot of time. During the 5 business day period after, but I also slept, and I'm going to try not to sleep tonight. I slept for, I think, 20 or 30 minutes last night, and I'm going to try not to do that today. So hopefully, even on a net basis, I'll be saving you time if you're watching this. During the 5 business day period, after any 5 consecutive trading day period in which the trading price per 1,000 principal amount of 2024 notes for each trading day of such period is less than 90% of the product of the last reported sale price of our common stock, and the conversion rate on each such trading day, or 3 if specified corporate events occur. Upon conversion, the 2024 notes will be settled in cash, shares of our common stock, or a combination thereof at our re-election. If a fundamental change occurs prior to the maturity date, holders of the 2024 notes may require us to repurchase all or a portion of their 2024 notes for cash at a repurchase price equal to 100% of the principal amount plus any accrued unpaid interest. In addition, if specific corporate events occur prior to the maturity date, we would increase the conversion rate for a holder who elects to convert its 2024 notes in connection with such an event. In certain circumstances, as of December 31, 2019, none of the conditions permitting the holders of the 2024 notes to early convert have been met. Therefore, the 2024 notes are classified as long-term in accordance with GAAP relating to embedded conversion features. We initially valued and bifurcated the conversion feature associated with the 2024 notes. We recorded to stockholders' equity $491 million for the conversion feature. The resulting debt discount is being amortized to interest expense at an effective rate of 8.68%. In connection with the offering of the 2024 notes, we entered into convertible note hedge transactions whereby we have the option to purchase initially, subject to adjustment for certain specific events, 5.9 million shares of our common stock at a price of $309.83. The cost of the convertible note hedge transactions was $476 million. Can I just do that real quick to see what they made on that? So they paid $476 million for the right to buy 5.9 million shares at $309. So if they closed at $850 today, $850 a share minus 309 is 541, which makes sense, times 5.9 is $3 billion. Interesting. But I guess you got to net out. The cost of the convertible note hedge transaction was $476 million. In addition, we sold warrants. Well, they sold warrants too. That's one of the problems. Whereby the holders of the warrants have the option to purchase initially, subject to adjustment for certain specified events, 5.9 million shares of our common stock at a price of $607.50 per share. That's weird. We received $174 million in cash proceeds from the sale of those warrants. So they're capped. Taken together, the purchase of the convertible note hedges and the sale of the warrants are intended to reduce potential dilution from the conversion of the 2024 notes and to effectively increase the overall conversion price from $309.83 to $607.50 per share. As these transactions meet certain accounting criteria, the convertible note hedges and warrants are recorded in stockholders' equity and are not accounted for as derivatives. The net cost incurred in connection with the convertible note hedge and warrant transactions was recorded as a reduction to additional paid in capital on the consolidated balance sheet. As of December 31, 2019, the if converted value of the notes exceeds the outstanding principal amount by $644 million. 2025 notes. In August 2017, we issued $1.8 billion in aggregate principal amount of unsecured 5.3% senior notes due in August 2025 pursuant to Rule 144A and Regulation S under the Securities Act. The net proceeds from the issuance after deducting transaction costs were $1.77 billion. Credit agreement. In June 2015, we entered into a senior asset-backed revolving credit agreement as amended from time to time. The credit agreement with a syndicate of banks borrowed funds bear interest at our option at an annual rate of A, 1% plus LIBOR, or 2, the highest of the federal funds rate plus 50 basis points, or 2, the lender's prime rate, or 3, 1% plus LIBOR. The fee, did they say that twice? The fee for undrawn amounts is 0.25% per annum. The credit agreement is secured by certain of our accounts receivable, inventory, and equipment. Availability under the credit agreement is based on the value of such assets as reduced by certain reserves. In March 2019, we amended and restated the credit agreement to increase the total lender commitments by $500 million to $2.425 billion and extend the term of substantially all of the total commitments to July 2023. And now we're done with 101. So I have 55 pages. We have 55 pages left, and we just did about 31 or 32 pages. So yeah, that's the problem. But in total, we've done 101 pages, and we have 55 left. So we're about 2/3 done, I think. I'd like to do the word count again soon, but not yet. 1.625% convertible senior notes due in 2019. I want to get through these and then maybe take a break, if that's all right with you. This page, maybe. In 2014, Solar City issued $566 million aggregate principal amount of 1.625% convertible senior notes due on November 1st, 2019 in a private placement. Each 1,000 of principal of the convertible senior notes is convertible into 1.3169 shares of our common stock, which is equivalent to a conversion price of $759.36 per share, subject to adjustment upon the occurrence of specified events related to dividends, tender offers, or exchange offers. The maximum conversion rate was capped at 1.7449 shares for each 1,000 of principal of the convertible senior notes, which is equivalent to a minimum conversion price of $573.10 per share. The convertible senior notes did not have a cash conversion option, and the convertible senior note holders could require us to repurchase their convertible senior notes for cash only under certain defined fundamental changes. In November 2019, we fully repaid $566 million in aggregate principal amount of the notes, zero coupon convertible senior notes due in 2020. In December 2015, Solar City issued $113 million in aggregate principal amount of zero coupon convertible senior notes due on December 1st, 2020 in a private placement. $13 million of the convertible senior notes were issued to related parties. See Note 20, related party transactions. That'll be fun. Each 1,000 of principal of the convertible, $1,000 of the principal of the convertible senior notes is now convertible into 3.3333 shares of our common stock, which is equivalent to a conversion price of $300 per share, subject to adjustment upon the occurrence of the specified events related to dividends, tender offers, or exchange offers. The maximum conversion rate is capped at 4.2308 shares for each 1,000 of principal of the convertible senior notes, which is equivalent to a minimum conversion price of $236.36 per share. The convertible senior notes do not have a cash conversion option. The convertible senior note holders may require us to repurchase their convertible senior notes for cash only under certain defined fundamental changes on or after June 30th, 2017. The convertible senior notes are redeemable by us in the event that the closing price of our common stock exceeds 200% of the conversion price for 45 consecutive trading days ending within 3 trading days of such redemption notice at a redemption price equal to 100% of the principal amount plus any accrued and unpaid interest. As of December 31, 2019, the if converted value of the notes exceeds the outstanding principal amount by $41 million. I know people don't like scrolling. Sorry about that. Solar bonds and other loans. Solar bonds are senior unsecured obligations that are structurally subordinate to the indebtedness and other liabilities of our subsidiaries. Solar bonds were issued under multiple series with various terms and interest rates. Additionally, we have assumed the 5.5% convertible note senior notes due in 2022 issued by Maxwell, which are convertible into shares of our common stock as a result of our acquisition of Maxwell Automotive asset-backed notes. From time to time, we transfer receivables or beneficial interest related to certain lease vehicles into SPs and issue automotive asset-backed notes backed by these automotive assets to investors. The SPEs are consolidated in the financial statements. The cash flows generated by these automotive assets are used to service the principal and interest payments on the automotive asset-backed notes and satisfy the SPE's expenses, and any remaining cash is distributed to the owners of the SPEs. We recognize revenue earned from the associated customer lease contracts in accordance with our revenue recognition policy. The SPEs assets and cash flows are not available to our other creditors. Other creditors of the SPEs, including the automotive asset-backed note holders, have no recourse to our other assets. A third party contracted with us to provide administrative and collection services for these automotive assets. In November 2019, we issued $861 million in aggregate principal amount of automotive asset-backed notes. The proceeds from the issuance, net of discount and fees, were $857 million. We're done with 102. I have to say the risk factors and the debt sections, they're not the worst, they're just the most dense, for sure. And we still have a lot of, and then we get to interest expense. All right. So we got to do page 103. I feel like we were flying when we started, and we've slowed down a little bit, but that's all right. Still going. I'm actually pausing to look at my phone, which I shouldn't. But yeah. So it's 4:15 a.m. We're 2 hours and 53 minutes in, which actually is not terrible compared to last night, which went for 7 hours, but we also might be here for 4 more hours. In fact, we will, because we've only done 30 pages, and we have 55 pages to go. Solar asset-backed notes. From time to time, our subsidiaries pool and transfer either qualifying solar energy systems and the associated customers' contracts or our interest in certain financing funds into special purpose entities, SPEs, and issue solar asset-backed notes backed by these solar assets or interests to investors. The SPEs are wholly owned by us and are consolidated in the financial statements. The cash flows generated by these solar assets or distributed by the underlying financing funds to certain SPEs are used to service the principal and interest payments on the solar asset-backed notes and satisfy the SPE's expenses, and any remaining cash is distributed to us. We recognize revenue earned from the associated customer contracts in accordance with our revenue recognition policy. The SPE's assets and cash flows are not available to our other creditors, and the creditors of the SPEs, including the solar asset-backed note holders, have no recourse to our other assets. We contracted with the SPEs to provide operations and maintenance and administrative services for the solar energy systems as of December 31, 2019, solar assets pledged as collateral for solar asset-backed notes had a carrying value of $690 million and are included within Solar Energy Systems net on the consolidated balance sheets. China loan agreements. In March 2019, one of our subsidiaries entered into a loan agreement with a syndicate of lenders in China for a bridge loan to be used for expenditures related to the construction of and production at our Gigafactory Shanghai. The loan agreement was terminated in December 2019. In September 2019, one of our subsidiaries entered into a loan agreement with a lender in China for an unsecured 12-month revolving credit facility of up to RMB 5 billion or the equivalent drawn in US dollars to finance vehicles in transit to China. Borrowed funds bear interest at an annual rate no greater than 90% of the 1-year published rate by People's Bank of China. The loan facility is non-recourse to our assets. In December 2018, one of our subsidiaries entered into a loan agreement with a syndicate of lenders in China for a secured term loan facility of up to RMB 9 billion or the equivalent amount drawn in US dollars, the fixed asset facility, and 2, an unsecured revolving loan facility of up to RMB 2.25 billion or the equivalent amount drawn in US dollars, the working capital facility in each case to be used in connection with our construction of and production at our Gigafactory Shanghai. Outstanding borrowings pursuant to the fixed asset facility accrue interest at a rate equal to 1 for RMB denominated loans. The market quoted interest rate published by People's Bank minus 0.765%, and 2 for US dollar denominated loans, the sum of 1-year LIBOR. Plus 1.3%. Outstanding borrowings pursuant to the working capital facility accrue interest at a rate equal to 1 for RMB denominated loans, the market quoted interest rate published by the People's Bank of China minus 0.4525%, and 2 for the US dollar denominated loans, the sum of 1-year LIBOR plus 0.8%. The fixed asset facility is secured by land and buildings at Gigafactory Shanghai, and both facilities are non-recourse to our other assets. Cash equity debt. In connection with the cash equity financing deals closed in 2016, our subsidiaries issued $502 million in aggregate principal amount of debt that bears interest at fixed rates. This debt is secured by, among other things, our interests in certain financing funds and is non-recourse to our other assets. Solar loan-backed notes. In January 2016 and January 2017, our subsidiaries pooled and transferred certain MyPower customer notes receivable into 2 SPEs and issued $330 million in aggregate principal amount of solar loan-backed notes. Backed by these notes receivable to investors, accordingly, we would not recognize a gain or loss on the transfer of these notes receivable. The SPEs are wholly owned by us and are consolidated in the financial statements. The payments received by SPEs from these notes receivable are used to service the semi-annual principal and interest payments on the solar loan-backed notes and satisfy the SPE's expenses, and any remaining cash is distributed to us. The SPE's assets and cash flows are not available to our other creditors, and the creditors of the SPEs, including the solar loan-backed note holders, have no recourse to our other assets. So that's 103. I'm going to try to kill this page just because it's, I think, the last debt page. Warehouse agreements. In August 2016, our subsidiaries entered into a loan and security agreement. The 2016 warehouse agreement for borrowings secured by the future cash flows arising from certain leases and the associated leased vehicles. On August 17, 2017, the 2016 warehouse agreement was amended to modify the interest rates and extend the availability period and the maturity date, and our subsidiaries entered into another loan and security agreement. The 2017 warehouse agreement was substantially the same terms as, and that shares the same, substantially with the same term as, and that. Is that another typo? Well, I'm giving up on the typo. There are too many typos. As and that shares the same committed amount with the 2016 warehouse agreement. In August 2016, on August 16, 2018, the 2016 warehouse agreement and the 2017 warehouse agreement were amended to extend the availability period from August 17, 2018 to August 16, 2019 and extend the maturity date from September 2019 to September 2020. On December 28, 2018, our subsidiaries terminated the 2017 warehouse agreement after having fully repaid all obligations thereunder and entered into a third loan and security agreement with substantially the same terms as, and that shares the same committed amount with the 2016 warehouse agreement. That was terrible. Super unprofessional. We refer to these agreements together as the warehouse agreements. Amounts drawn under the warehouse agreements generally bear interest at a fixed margin above 1 LIBOR or 2 the commercial paper rate. The warehouse agreements are non-recourse to our other assets. Pursuant to the warehouse agreements, an undivided beneficial interest in the future cash flows arising from certain leases and the related leased vehicles have been sold for legal purposes but continue to be reported in the consolidated financial statements. The interest in the future cash flows arising from these leases and the related vehicles is not available to pay the claims of our creditors other than pursuant to obligations to the lenders under the warehouse agreements. Any excess cash flows not required to pay obligations under the warehouse agreements are available for distributions. In August 2019, our subsidiaries amended the warehouse agreements to extend the availability period from August 16, 2019 to August 14, 2020 and extend the maturity date from September 2020 to September 2021. In November 2019, we repaid $723 million of the principal outstanding under the warehouse agreements. Solar term loans, our subsidiaries have entered into agreements for term loans with various financial institutions. The term loans are secured by substantially all of the assets of the subsidiaries, including its interest in certain financing funds, and are non-recourse to our other assets. During the fourth quarter of 2019, we fully repaid the $159 million in aggregate principal of one term loan. Yes, this is awesome. This feels good. Making some progress. Canada Credit Facility in December 2016. One of our subsidiaries entered into a credit agreement, the Canada Credit Facility, with a bank for borrowing secured by our interests in certain vehicle leases in December 2017 and December 2018. The Canada Credit Facility was amended to add our interests in additional vehicle leases as collateral, allowing us to draw additional funds. Amount drawn under the Canada Credit Facility bear interest at fixed rates. The Canada Credit Facility is non-recourse to our other assets. I shouldn't have given up so easily because we just did that page at about 5 minutes a page, and I was thinking we were going way slower, so I shouldn't be so discouraged by our progress. Solar renewable and energy credit and other loans. We have entered into various solar renewable energy credit and other loan agreements with various financial institutions, including a solar revolving credit facility. The solar renewable energy credit loan facility is secured by substantially all of the assets of one of our wholly facilities, secured by certain assets of the subsidiary, and is non-recourse to our other assets, and that's 104. right on schedule. I'm gonna try to go for this too. Not that we're on a roll, but we're sort of on a roll. Man, I wish I could do something about this. I don't know what these things are. Oops, I don't want to do that. Interest expense. The following table presents the interest expense related to the contractual interest coupon, the amortization of debt issuance costs, and the amortization of debt discounts on our convertible senior notes with cash conversion features, which include the 1.5% convertible senior notes due in 2018 and the 2019 notes, the 2021 notes, the 2022 notes, and the 2024 notes in millions. Year ended December 31, 2019, 2018, 2017. Contractual interest coupon 65, 43, 39. Amortization of debt issuance costs 777. Amortization of debt discounts 148, 123, 114. Total 220, 173, 160. Pledged assets as of December 13th, 2019 and 2018. We had pledged or restricted 5.72 billion and 5.23 billion of our assets consisted principally of restricted cash, receivables, inventory, SREC, solar energy systems, operating lease vehicles, land use rights, property and equipment, and equity interest in certain SPs as collateral for our outstanding debt. Schedule of the principal maturities of debt. The future scheduled principal maturities of debt as of December 31, 2019 were as follows in millions: recourse debt, non-recourse debt total 2020 259, 1155, 1414, 2021 1382, 909, 2291, 2022 1024, 1013, 2037, 2023 1586, 199, 1785, 2024, 1840, 558, 2398. The reason why I'm slowing down is because I can't use my cursor to keep track, and I just want to make sure I'm not missing anything. Thereafter, 1807, 760, 2567, total 7898, 4594, 12492. Making good time. We're about 2.5 minutes in on this page. No 13 leases. We have entered into various non-cancelable operating and finance lease agreements for certain of our offices, manufacturing, warehouse facilities, retail and service locations, equipment, vehicles, and solar energy systems worldwide. We determine if an arrangement is a lease or contains a lease at inception and record the lease in our financial statements upon lease commencement, which is the date when the underlying asset is made available for use by the lessor. Our leases where we are the lessee often include options to extend the lease term for up to 10 years. Some of our leases also include options to terminate the lease prior to the end of the agreed upon lease term. For purposes of calculating lease liabilities, terms include options to extend or terminate the lease when it is reasonably certain that we will exercise such options. That sounds reasonable. Not that they're asking for my opinion or care, or you. Lease expense for operating lease payments is recognized on a straight line basis over the lease term. Certain operating leases provide for annual increases to lease payments based on an index or rate. We calculate the present value of future lease payments based on the index or rate at the lease commencement date for new leases commencing after January 1st, 2019. For historical leases, we use the indexed or rate as of the adoption date. Differences between the calculated lease payment and the actual payment are expensed as incurred. Lease expense for finance lease payments is recognized as amortization expense of the finance lease ROU, asset and interest expense of the finance lease liability over the lease term. 105 is in the books. 106 looks like a fun one, so I'll do that, and then we'll have 50 pages left exactly, I think. The balances for the operating and finance leases were where we are the lessee are presented as follows in millions within our consolidated balance sheet. December 31, 2019, operating leases, operating lease right of use assets 1218, accrued liabilities and other 228, other long-term liabilities 956, total operating lease liabilities 1184. Solar energy systems net 30, property plant and equipment net 1600, total finance lease assets 1630, current portion of long-term debt and finance leases 386, long-term debt and finance leases net of current portion 1232, total finance lease liabilities 1618. The components of lease expenses are as follows in millions with our consolidated statements of operations year ended December 31, 2019. Please subscribe if you're listening to this. This is operating lease expense. Operating lease expense 1, 426. Finance lease expense. Amortization of leased assets 299. Interest on lease liabilities 104. And hit the bell. Total finance lease expense 403 for notifications. Total lease expense 829. 1. Include short-term leases and variable lease costs, which are immaterial. Other information related to leases where we are the lessee is as follows: December 31, 2019. Did I say that above? Year ended December 31, 2019. Weighted average remaining lease term 6.2 years. Operating leases 6.2 years. Finance leases 3.9 years. Weighted average discount rate. Operating leases 6.5%. Finance leases 6.5%. Done. With 106 pages. And actually, this page 107 doesn't look too bad either. I'm going to take a quick break. I'm just going to type right up here. Hey, what's up? Thanks for sticking with me. Just grabbed a tiny bit of food and a little coffee. I'm running out of coffee. Have a lot left. We got through a lot of words there. Can we see what we have left? So I think we had around 23,500 or something like that words. Under 20 would be really nice. I just pasted the words left and it's counting. All right. We have 20,304 words left. And when we started way at the beginning, yesterday, we had, I think about 82.5. So we're under 25%. We got under 25% to go. Is that right? Yeah. Yeah, so we've completed 75% of the words. And as far as the pages, we have 56 minus 107, which means we have 49 pages. And 31 pages left, which is also awesome because that means we'll be going through some of the pages more quickly. They have less words, obviously. Or not obviously, I don't really know what I'm talking about, but I think. We'll find out. So I guess what I'm saying is hopefully the rest of this goes a little bit faster. And we're on page 107, which is where we're picking up. And I'll wait till I get to 3 hours and 1 minute, which is in 20 seconds, just so I can. You know what? Actually, I should start now so I can be equal on the fives. Oh, too late. Sorry for wasting your time. But if you're here, I'm assuming you're enjoying this. I don't know why you would be, but this is kind of awesome. Here we go, page 107. Because most of our leases do not provide an implicit rate of return, we used our incremental borrowing rate based on the information available at lease commencement date in determining the present value of lease payments. Supplemental cash flow information related to these leases where we are the lessee is as follows in millions. Year-end December 31, 2019. Cash paid for amounts included in the measurement of lease liabilities. Operating cash outflows from operating leases 396. Operating cash outflows from finance leases interest payments 104. Financing cash outflows from finance leases 321. Leased assets obtained in exchange for finance lease liabilities 616. Leased assets obtained in exchange for operating lease liabilities 202. As of December 31, 2019, the maturities of our operating and finance lease liabilities excluded short-term leases are as follows in millions. Operating leases, finance leases 2020 296 474, 2021 262 478, 2022 210 600, 2023 174, 224, 2024, 146, 5. Thereafter, 372, 13. Total minimum lease payments, 1460, 1794. Less interest, 276, 176. Present value of lease obligations, 1184, 1618. Less current portion, 228, 386. Long-term portion of lease obligations, 956, 1232. Under legacy lease accounting, ASC 840, future minimum lease payments under non-cancelable leases as of December 31, 2018 are as follows in millions. Operating leases, finance leases, 2019, 276, 417, 2020, 257, 503, 2021, 230, 506, 2022, 183, 24, 2023, 158, 5, thereafter 524, 6. Total minimum lease payment 1628, 1461, less interest 122, present value of lease obligations 1339, less current portion 346, long-term portion of lease obligations 993. And that was a fast one. That was only about 2.5 minutes. Non-cancelable operating lease receivables. Under the new lease standard, we are the lessor of certain vehicle arrangements as described in Note 2, Summary of Significant Accounting Policies following the adoption of the new lease standard solar energy system leases and PPAs that commenced after January 1st, 2019, where we are the lessor and we were previously accounted for as leases, no longer meet the definition of a lease and are therefore not included in the table as of December 31, 2019. Refer to Note 2, Summary of Significant Accounting Policies as of December 31, 2019, maturities of our operating lease receivables from customers for each of the next 5 years and thereafter were as follows in millions. 2020, 644, 2021, 494, 2022, 317, 2023, 190, 2024, 191, thereafter 2294, total 4130. Under legacy lease accounting, ASC 840, future minimum lease payments to be received from customers under non-cancelable leases as of December 31, 2018 are as follows in millions. 2019, 502, 2020, 418, 2021, 271, 2022, 187, 2023, 189, thereafter 2469. Total 4036. The above tables do not include vehicle sales to customers or leasing partners with a resale value guarantee, as the cash payments were received up front. For our solar PPA arrangements, customers are charged solely based on actual power produced by the installed solar energy system at a predefined rate per kilowatt hour of power produced. The future payments from such arrangements are not included in the above table, as they are a function of the power grid generated by related solar energy systems in the future. Interesting. I haven't really seen battery or electric. Otherwise, I would have hit the counter, maybe. Note 14, Equity Incentive Plans. In June 2019, we adopted the 2019 Equity Incentive Plan, the 2019 Plan, and simultaneously terminated the 2010 Equity Incentive Plan, the 2010 Plan. No new awards have been granted under the 2010 Plan following the adoption of the 2019 Plan, but such termination did not affect outstanding awards under the 2010 Plan. The 2019 Plan has similar terms as the 2010 Plan and provides for the granting of stock options, restricted stock, RSUs, stock appreciation rights, performance units, and performance shares to our employees, directors, and consultants. Stock options granted under the 2019 Plan may be either incentive stock options or non-statutory stock options. Incentive stock options may only be granted to our employees. Non-statutory stock options may be granted to our employees, directors, and consultants. Generally, our stock options and RSUs vest over 4 years, and our stock options are exercisable over a maximum period of 10 years from their grant dates. Vesting typically terminates when the employment or consulting relationship ends. As of December 31, 2019, 11 million shares were reserved and available for issuance under the 2019 Plan, and that's 108. The following table summarizes our stock option and RSU activity. Stock options, RSUs, number of options in thousands, weighted average exercise price, weighted average remaining contractual life years, aggregate intrinsic value in billions, number of RSUs in thousands, weighted average grant date, fair value. Seems like per share. Balance December 31, 2018, 31,208, 273.40, 46.59. Granted 1473, 265.26, 37.52, 282.74. Exercised or released 1441, 106.68, 1949, 277.13. Canceled 1245, 310.57, 1656, 295.05. Balance 29. 995, 279.49, 689, 417, 4806, 290, 106. Vested and expected to vest December 31, 2019, 15,860, 228.29, 605, 302, 4804, 291.05. Exercisable invested December 31, 2019, 70, 25, 9407, 339, 228. The weighted average grant date fair value of RSUs in the years ended December 31, 2019, 2018, 2017 was 282.74 and 316.46 and 308.71 respectively. The aggregate release date fair value to write down. The aggregate release date fair value of RSUs in the years ended December 31, 2019, 2018, 2017 was 502 billion, 546 million, and 491 million respectively. The aggregate intrinsic value of options exercised in the years ended December 31, 2019, 2018, and 2017 was 237 million, 293 million, 544 million respectively. Fair value assumptions. We use the fair value method in recognizing stock-based compensation expense. Under the fair value method, we estimate the fair value of each stock option award with service and performance conditions and the ESPP on the grant date, generally using the Black-Scholes option pricing model and the weighted average assumptions in the following table. Year ended December 31, 2019, 2018, 2017, risk-free rate. Stock options 2.4%, 2.5%, 1.8%, ESPP 2.2%, 2%, 1.1%, expected term in years, stock options 4.5, 4.7, 5.1, ESPP 0.5, 0.5, 0.5, expected volatility, stock options 48, 42, 42, ESPP 53, 43, 35, dividend yield, stock options 0, 0, 0, ESPP 0, 0, 0, grant date fair value per share 111.59, 121.92, 122.25, ESPP 78.25, 84.37, 75.05. They're doing great. That's really good. I bet the employees are happy. There's a lot of volatility in the options right now, though. I hope the sound is recording. So based on the estimate when we started that this would take 7 hours, we just hit the halfway point in terms of time. Also, I just tried to eat something without you noticing. Sorry. That didn't work at all. A Hershey's bar. I don't even eat Hershey's bars. I don't know why I'm eating this. It's the only thing I have. So we're done with 109. And that means we've done 40 pages. And we have about 47 left. But I think some of the later pages are, they'll be quicker. I can see the light at the end of the tunnel. This was so much harder than I thought it would be. I know this seems stupid. I know it doesn't seem like a big deal and like I'm making way too much out of it. And I put that intro in at the front. I get that. I'm sure some people will be annoyed by this, but the people that get it, like the people that were on the live stream last night and the people that commented on the first round of this, I think they really get it and they like it and they're entertained by it and they just get it. And that's great. So if you're listening to this and you get this, you understand what this is all about, then I appreciate it. And I'm sure there are a lot of people that don't get it, but that's okay. Because now we're almost done and I can go to bed. It's 5 a.m. It's 4:56. The fair value of RSUs with service or service and performance conditions is measured on the grant date based on the closing fair market value of our common stock. The risk-free interest rate is based on the U.S. Treasury yield for zero coupon U.S. Treasury notes with maturities approximating each grant's expected life. Prior to the fourth quarter of 2017, given our then limited history with employee grants, we used the simplified method in estimating the expected term of our employee grants. The simplified method utilizes the average of the time to vesting and the contractual life of the employee's grant, beginning with the fourth quarter of 2017. We use our historical data in estimating the expected term of our employee grants. The expected volatility is based on the average of the implied volatility of publicly traded options for our common stock and the historical volatility of our common stock. 2018 CEO Performance Award. This has been covered a little bit. In March 2018, our stockholder approved the board of directors grant of 20,264,042 stock option awards to our CEO. The 2018 CEO Performance Award. The 2018 CEO Performance Award consists of 12 vesting tranches with a vesting schedule based entirely on the attainment of both operational milestones, performance conditions, and market conditions, assuming continued employment either as the CEO or as both executive chairman and chief product officer and service through each vesting date. Each of the 12 vesting tranches of the 2018 CEO Performance Award will vest upon certification by the board of directors that both, one, the market capitalization milestone for such tranche, which begins at 100 billion for the first tranche and increases by increments of 50 billion thereafter, and two, any one of the following 8 operational milestones focused on revenue or 8 operational milestones focused on adjusted EBITDA have been met for the previous 4 consecutive fiscal quarters on an annualized basis. Adjusted EBITDA is defined as net income loss attributable to common stockholders before interest expense, provision benefit for income taxes, depreciation, amortization, and stock-based compensation. Just thinking about something funny. Maybe I'll talk about it in a video one day. Remind me to talk about Christmas dinner at Italy. Total annualized, now I'm focused, total annualized revenue in billions, total annualized adjusted EBITDA in billions, 20, 35, 55, 75, 100, 125, 150, 175, 1.53, 4.56, 80, 10, 12, 14. I'm not exactly happy with those EBITDA targets. Sorry to also editorialize, but like if they're making 175 billion in revenue, they're only hitting 14 in EBITDA. It's just sort of weird to match those two things up. I mean, that's way under a 10% margin, which is fine. But for example, in the their very last tranche, where they go from 50 billion to 75 billion, they're earning an incremental 25 billion of revenue and only 2 billion of EBITDA, so an under 10% margin. As of December 31st, 2019, 2 operational milestones have been achieved. 1, 20 billion total annualized revenue, and 2, 1.5 billion annualized adjusted EBITDA, each subject to the formal certification by our board of directors. While no market capitalization milestones have been achieved, consequently, no shares subject to the 2018 CEO Performance Award have vested as of the date of this filing. That's amazing. As of December 31, 2019, the following operational milestones were considered probable of achievement: adjusted EBITDA of 3 billion, total revenue of 35 billion. Stock-based compensation expense associated with each tranche under the 2018 CEO Performance Award is recognized over the longer of 1, the expected achievement period for the operational milestone for such tranche, and 2, the expected achievement period for the related market capitalization milestone determined on the grant date, beginning at the point in time when the relevant operational milestone is considered probable of being met. If such operational milestone becomes probable anytime after the grant date, we will recognize a cumulative catch-up expense from the grant date to that point in time. If the related market capitalization milestone is achieved earlier than his expected achievement period and the achievement of the related operational milestone, then the stock-based compensation expense will be recognized over the expected achievement period for the operational milestone, which may accelerate the rate at which the expense is recognized. 110. The market capitalization milestone period and the valuation of each tranche are determined using a Monte Carlo simulation and is used as the basis for determining the expected achievement period. The probability of meeting an operational milestone is based on a subjective assessment of our future financial projections. No tranches of the 2018 CEO Performance Award will vest unless a market capitalization and a matching operational milestone are both achieved. The first tranche of the 2018 CEO Performance Award will not vest unless our market capitalization were to approximately double from the initial level at the time the award was approved, based on both a 6 calendar month trailing average and a 30 calendar day trailing average, counting only 5 trading days. Upon vesting of a tranche, all unamortized expense for the tranche will be recognized immediately. Additionally, stock-based compensation represents a non-cash expense and is recorded as a selling, general, and administrative operating expense in our consolidated statement of operations. As of December 31, 2019, we had 527 million of total unrecognized stock-based compensation expense for the operational milestones that were considered probable of achievement, which will be recognized over a weighted average period of 2.72 years. As of December 31, 2019, we had unrecognized stock-based compensation of 1.29 billion for the operational milestones that were considered not probable of achievement. For the year ended December 31, 2019, we recorded stock-based compensation expense of 296 million related to the 2018 CEO Performance Award from March 21st, 2018, when the grant was approved by our stockholders, through December 31, 2018, recorded stock-based compensation expense of 175 million related to this award. The increase in stock-based compensation expense was primarily related to a $72 million cumulative catch-up expense for the service provided from the grant date, when an additional operational milestone was considered probable of being met in the fourth quarter of 2019, and a shorter expense period in the prior year. 2014 performance-based stock option awards in 2014 to create incentives for continued long-term success beyond the Model S program and to closely align executive pay with our stockholders' interest in the achievement of significant milestones by us. The compensation committee of our board of directors granted stock option awards to certain employees, excluding our CEO, to purchase an aggregate of 1,073,000,000 shares of our common stock. Each award consisted of the following four vesting tranches, with the vesting schedule based entirely on the attainment of the future performance milestones, assuming continued employment and service through each vesting date. 1/4 of each award vests upon completion of the first Model X production vehicle. 1/4 of each award vests upon achieving aggregate production of 100,000 vehicles in a trailing 12-month period. 1/4 of each award vests upon the completion of the first Model 3 production vehicle, and 1/4 of each award vests upon achieving an annualized gross margin of greater than 30% for any 3-year period. I don't think that has happened yet. As of December 31, 2019, the following performance milestones had been achieved: completion of the first Model X production vehicle, completion of the first Model 3 production vehicle, and aggregate production of 100,000 vehicles in a trailing 12-month period. We begin recognizing stock-based compensation expense as each performance milestone becomes probable of achievement. As of December 31st, 2019, we had unrecognized stock-based compensation expense of $5 million for the performance milestone that was considered not probable of achievement. For the years ended December 31, 2019 and 2018, we did not record any additional stock-based compensation related to these awards. For the year ended December 2017, we recorded stock-based compensation expense of $7 million related to these awards. Page 111 is done in the books. (2012) CEO Performance Award. In August 2012, our board of directors granted 5,274,901 stock option awards to our CEO. The 2012 CEO Performance Award. The 2012 CEO Performance Award consists of 10 vesting tranches with a vesting schedule based entirely on the attainment of both performance conditions and market conditions, assuming continued employment and service through each vesting date. Each vesting tranche requires a combination of predetermined performance milestone and an incremental. It's another typo if anybody cares. It should say predetermined milestones, I think. And an incremental increase in our market capitalization of $4 billion as compared to our initial market capitalization of $3.2 billion at the time of the grant. As of December 31, 2019, the market capitalization conditions for all of the vesting tranches and the following performance milestone had been achieved. Successful completion of the Model X Alpha prototype, successful completion of the Model X Beta prototypes, completion of the first Model X production vehicle, aggregate production of 100,000 vehicles, successful completion of the Model 3 Alpha prototype, successful completion of the Model 3 Beta prototype, completion of the first Model 3 production vehicle, aggregate production of 200,000 vehicles, and aggregate production of 300,000 vehicles. We begin recognizing stock-based compensation expense as each milestone becomes probable of achievement. As of December 31, 2019, we had unrecognized stock-based compensation expense of $6 million for the performance milestone that was considered not probable of achievement. For the year ended December 31, 2019, we recorded no stock-based compensation expense related to the 2012 CEO Performance Award. For the year ended December 31st, 2018, the stock-based compensation we recorded related to this award was immaterial. For the year ended December 31, 2017, we recorded stock-based compensation of $5 million related to this award. Our CEO earns is one of my favorite parts. Sorry to interject again. I know you just want to hear the facts, but it's one of my favorite parts. Our CEO, I didn't know this was coming up, earns a base salary that reflects the currently applicable minimum wage requirements under California law, and he is subject to income taxes based on such base salary. However, he has never accepted his salary. Commencing in May 2019 at our CEO's request, we eliminated altogether the earning and accrual of his base salary. Summary stock-based compensation information. The following table summarizes our stock-based compensation expense by line item in the consolidated statements of operations in millions. Year ended December 31, 2019, 2018, 2017. Cost of revenues 128, 109, 64. Research and development 285, 261, 218. Selling general and administrative 482, 375, 185. Restructuring and other 3, 4. Total 898, 749, 467. We realized no income tax benefit from stock option exercises in each of the periods presented due to cumulative losses and valuation allowances. As of December 31, 2019, we had $1.57 billion of total unrecognized stock-based compensation expense related to non-performance awards, which would be recognized over a weighted average period of 2.91 years. And that's page 112 in the books. 113 looks like a medium page. And I'll be excited when we get to the end of 116, because that'll mean that we have 50 pages left. But that'll only mean that we've done 47 pages. So we'll have more left. How's that even possible? I guess it is because, anyway, ESPP, our employees are eligible to purchase our common stock through payroll deductions of up to 15% of their eligible compensation, subject to any plan limitations. The purchase number would be 85% of the lower of the fair market value on the first and last trading days of each 6-month offering period. During the years ended December 31, 2019, 2018, 2017, we issued 0.5, 0.4, and 0.4 million shares under the ESPP with an associated expense of $40 million, $109 million, and $71 million, respectively. There were 7 million shares available for issuance under ESPP as of December 31st, 2019. Note 15, income taxes. A provision for income taxes of $110 million, $58 million, and $32 million has been recognized for the years ended December 31, 2019, 2018, and 2017, respectively, related primarily to our subsidiaries located outside of the U.S. Our loss before provision for income taxes for the years ended December 31, 2019, 2018, and 2017 was as follows in millions. Year ended December 31, 2019, 2018, 2017, domestic 287, 412, 993, non-controlling interest and redeemable non-controlling interest, negative 87, 87, 279, foreign 465, 506, 937, loss before income taxes 665, 1005, 2209. Also, I just miscalculated that. 116 would mean we'd have 40 pages left, not 50. So that's good. The components of the provision for income taxes for the years ended December 31, 2019, 2018, and 2017 consisted of the following in millions. Year ended December 31, 2019, 2018, 2017. Current federal, -1, -10. State, 532. Foreign, 86, 24, 43. Total current, 91, 26, 35. Deferred federal, -4. State, foreign, 23, 32, -3. Total deferred, 19, 32, -3. Total provision for income taxes, 110, 58, 32. On December 22nd, 2017, the 2017 Tax Cuts and Jobs Act, Tax Act, was enacted into law, making significant changes to the Internal Revenue Code. Changes include, but are not limited to, federal corporate tax rate decreased from 35% to 21% for tax years beginning after December 31, 2017. The transition of U.S. international taxation from a worldwide tax system to a territorial system and a one-time transition tax on the mandatory deemed repatriation of foreign earnings, we were required to recognize the first effect of the tax law changes in the period of enactment, such as remeasuring our U.S. deferred tax assets and liabilities, as well as reassessing the net realizability of our deferred tax assets and liabilities. The Tax Act did not give rise to any material impact on the consolidated balance sheets and consolidated statements of operations due to our historical worldwide loss position and the full valuation allowance on our net U.S. deferred tax assets. 113 in the books. Creeping up on 116. Gotta hold on to the voice. Deferred tax assets liabilities as of December 31, 2019 and 2018 consisted of the following in millions. December 31, 2019, December 31, 2018, deferred tax assets, net operating loss carry forwards 1846, 1760, research and development credits 486, 377, other tax credits 126, 128, deferred revenue 301, 156, inventory and warranty reserves 243, 165, stock-based compensation 102, 102, operating lease right of use liabilities 290, accruals and others 1628, total deferred tax assets 3410, 2716, valuation allowance 1956, 1806, deferred tax assets net of valuation allowance 1454, 910, deferred tax liabilities, depreciation amortization negative 1185, negative 861, investment in certain financing funds negative 17, negative 33, operating lease right of use assets negative 263. Did I say that already? Negative 17, negative 33, just in case I missed it. Other negative 24, total deferred tax liabilities negative 1489, negative 918, deferred tax liabilities net of valuation allowance and deferred tax assets negative 35, negative 8. As of December 31st, 2019, we recorded a valuation allowance of $1.96 billion for the portion of the deferred tax asset that we do not expect to be realized. The valuation allowance on our net deferred taxes increased by $150 million, decreased by $38 million, and increased by $821 million during the years ended December 31st, 2019, 2018, and 2017, respectively. The changes in valuation allowance are primarily due to additional U.S. deferred tax assets and liabilities incurred in the respective year. We have net $151 million of deferred tax assets in foreign jurisdictions, which management believes are more likely than not to be fully realized given the expectation of future earnings in these jurisdictions. We continue to monitor the realizability of the U.S. deferred tax assets, taking into account multiple factors, including the results of operations and magnitude of excess tax deductions for stock-based compensation. We intend to continue maintaining a full valuation allowance on our U.S. deferred tax assets until there is sufficient evidence to support the reversal of all or some portion of these allowances. Release of all or a portion of the valuation allowance would result in the recognition of certain deferred tax assets and a decrease to income tax expense for the period the release is recorded. That's 114. The reconciliation of taxes at the federal statutory rate to our provision for income taxes for the years ended December 31, 2019, 2018, 2017 was as follows in millions. Year ended December 31, 2019, 2018, 2017. Tax at statutory federal rate, negative 139, negative 211, negative 773. State tax net of federal benefit, 532. Non-deductible expenses, 9465.30. Excess tax benefits related to stock-based compensation, 1, negative 7, negative 44, negative 1013. Did I say compensation 1? Foreign income rate differential 189, 161, 365. U.S. tax credits, 107, negative 107, negative 80, negative 110. Non-controlling interest and redeemable non-controlling interest adjustment, negative 29, 3266. Effective U.S. tax law change, 723. Bargain in purchase gain, 20. Convertible debt, negative 4. Unrecognized tax benefits, 1713. Change in valuation allowance, 91, 131, 719. Provision for income taxes, 110, 58, 32. This is a hard page to throw in the middle of this run. And we're just about to cross the 4-hour mark here. We have to take a break coming up when we pass 116. And we have 40 pages left. I mean, we got from 69 to 109. That was 40 pages. And that took a lot. So now we're going to have to do that again. After going for 4 hours. I mean, it's going to be a 7-hour thing for sure. It's 5:22 a.m. right now. 1. As of January 1st, 2017, upon the adoption of ASU number 2016-09, improvements to employee share-based payment accounting, excess tax benefits from share-based award activity incurred from the prior and current years are reflected as a reduction of the provision for income taxes. The excess tax benefits result in an increase to grow our U.S. deferred tax assets that is offset by a corresponding increase to our valuation allowance. As of December 31st, 2019, we had $7.51 billion of federal and $6.16 billion of state net operating loss. Carry forwards available to offset future taxable income, which will not begin to significantly expire until 2024 for federal and 2028 for state purposes. A portion of these losses were generated by Solar City prior to acquisition in 2016 and therefore are subject to change of control provisions which limit the amount of acquired tax attributes that can be utilized in a given tax year. We do not expect these change of control limitations to significantly impact our ability to utilize these attributes. As of December 31st, 2019, we had research and development tax credits of $320 million and $284 million for federal and state income tax purposes, respectively. If not utilized, the federal research and development tax credits will expire in various amounts beginning in 2024. However, the state research and development tax credits can be carried forward indefinitely. In addition, we have other general business tax credits of $125 million for federal income tax purposes, which will not begin to significantly expire until 2033. No deferred tax liabilities for foreign withholding taxes have been recorded relating to earnings of our foreign subsidiaries, since all such earnings are intended to be indefinitely reinvested. The amount of the unrecognized deferred tax liability associated with these earnings is immaterial. Federal and state laws can impose substantial restrictions on the utilization of net operating loss and tax credit carry forwards in the event of an ownership change as defined in Section 382 of the Internal Revenue Code. We have determined that no significant limitation would be placed on the utilization of our net operating loss and tax credit carry forwards due to their prior ownership changes. Due to prior ownership changes. And 115 is in the books. Oh. I mean, if we can just make it to 129, then I think we'll sort of be okay. $128's a good page. But these pages, not going to be great. That's all right. I'll check where we're at in terms of words after 116. I might need to take a break for a little bit. And it's not even because, I mean, this isn't, it's really just the fact that I've been going on no sleep for the past couple of days. If this were, if I was able to do this in the middle of the day, I think it would be no problem. At least I'm saying that. But, I wouldn't get tired after, it's really only been 4 hours. I mean, that's half of a normal work day for most people. And, yeah, I try to work way more than 8 hours in any given day. Way more than that. So it's not the hours, it's just the lack of sleep. I mean, if I were doing anything right, if I were watching TV right now, I'd be falling asleep. And I don't watch TV. On certain tax positions, the changes to our gross unrecognized tax benefits were as follows. In millions, December 31, 2016, 204 decreases in balances related to prior year tax positions, negative 31, increases in balances related to current year tax positions, 84, changes in balances related to the effect of U.S. tax law change, negative 58, December 31, 2017, 199, decreases in balances related to prior year tax positions, negative 6, increases in balances related to current year tax positions, 60, December 31, 2018, 253, decreases in balances related to prior year tax positions, negative 39, increases in balances related to current year tax positions, 59, December 31st, 2019, 273. As of December 31st, 2019, accrued interest and penalties related to unrecognized tax benefits are classified as income tax expense and were immaterial. Unrecognized tax benefits of $247 million, if recognized, would not affect our effective tax rate since the tax benefits would increase a deferred tax asset that is currently fully offset by a full valuation allowance. We file income tax returns in the U.S., California, and various state and foreign jurisdictions. We are currently under examination by the IRS for the years 2015 and 2016. Additional tax years within the period 2004 to 2018 remain subject to examination for federal income tax purposes, and tax years 2004 to 2018 remain subject to examination for California income tax purposes. All net operating losses and tax credits generated to date are subject to adjustment for federal and California income tax purposes. Tax years 2008 to 2018 remain subject to examination in other U.S. state and foreign jurisdictions, the potential outcome of the current examination could result in a change to unrecognized benefits within the next 12 months. However, we cannot reasonably estimate possible adjustments at this time. The U.S. Tax Court issued a decision in Altera Corp. Versus Commissioner related to the treatment of stock-based compensation expense in a cost-sharing arrangement. On June 7, 2019, the court reversed the tax court decision and upheld the validity of Treasury Regulation Section 1.482-78D2, requiring stock-based compensation costs to be included in the costs shared under a cost-sharing agreement. Forgot I couldn't highlight. Given that the current active decision can still be appealed because Altera has the option to, if and when the current tax court's decision is overturned, we will treat the amount previously shared as a prepayment to future cost-sharing agreement costs. Because we have a full valuation allowance in the U.S., any potential tax benefits would increase our U.S. deferred. Any potential tax benefits would increase our U.S. deferred tax asset and would not have a material impact to our financials. And that's 116 in the books. Note 16, commitments and contingencies. Operating lease arrangement in Buffalo, New York. We have an operating lease through the Research Foundation for the State University of New York, the SUNY Foundation for a manufacturing facility constructed on behalf of the SUNY Foundation and which was substantially completed in April 2018. We use this facility referred to as Gigafactory New York primarily for the development and production of our solar roof and other solar products and components, energy storage components and supercharging components, and for lesser approved functions under the lease and a related research and development agreement on behalf of the SUNY Foundation. We have and will continue to install certain utilities and other improvements and acquire certain equipment designed by us to be used in the manufacturing facility. The SUNY Foundation covered 1, construction costs relating to the manufacturing facility up to $350 million. 2, the acquisition and commissioning of the manufacturing equipment in an amount up to $275 million. And 3, $125 million for additional specified scope costs in cases 1 and 2 only. Subject to the maximum funding allocation from the state of New York, and we were responsible for any construction or equipment costs in excess of such amounts. The SUNY Foundation owns the manufacturing facility and the manufacturing equipment purchased by the SUNY Foundation. Following completion of the manufacturing facility, we have commenced leasing of the manufacturing facility and the manufacturing equipment owned by the SUNY Foundation for an initial period of 10 years with an option to renew for $2 per year. That's awesome. Plus utilities. Following the adoption of ASC 842, we no longer recognize the built-to-suit asset and related depreciation expense or the corresponding financing liability and related amortization for Gigafactory New York in our consolidated financial statements. So it actually isn't as bad as I thought. Under the terms of the operating lease agreement, we are required to achieve specific operational milestones during the initial lease term, which include employing a certain number of employees at the manufacturing facility within Western New York and within the state of New York within specified periods following the completion of the manufacturing facility. We are also required to spend or incur $5 billion in combined capital, operational expenses, and other costs in the state of New York within 10 years following the achievement of full production on an annual basis during the initial lease term as measured on each anniversary of the commissioning of the manufacturing facility. If we fail to meet these specified investment and job creation requirements, then we would be obligated to pay a $41 million program payment to the SUNY Foundation for each year that we fail to meet these requirements. Furthermore, if the arrangement is terminated due to a material breach by us, then additional amounts might become payable by us. As of December 31st, 2019, we have met the targets as of the applicable measurement dates and anticipate meeting the remaining obligations through our operations of this facility and other operations within the state of New York. It's a pretty long page. Operating lease arrangements in Shanghai, China. We have an operating lease arrangement for an initial term of 50 years with the local government of Shanghai for land use rights where we are constructing Gigafactory Shanghai. Under the terms of the arrangement, we are required to spend RMB 14.08 billion in capital expenditures and to generate RMB 2.23 billion of annual tax revenues starting at the end of 2023. If we are unwilling or unable to meet such target or obtain periodic project approvals in accordance with the Chinese government's standard terms and for such arrangements, we would be required to revert the site to the local government and receive compensation for the remaining value of the land lease, buildings, and fixtures. We believe the capital expenditure requirement and the tax revenue target will be attainable even if our actual vehicle production was far lower than the volumes we were forecasting. So that's 117. Oh. I hate to do this. I think I might need to take a break. A little 20-minute break or something. Just to take a quick nap. I hate to do it because I'm worried that I won't come back from this, but I will. And it'll be about 5:57 when I do, and after that, let's just see how many words we have. Man, it's looking good. It's looking a lot better than it was. Maybe not. If you're watching right now, please consider subscribing. I mean, if you're liking this, which isn't actually even that entertaining. All right, we're at 15,000 words, 15.2, so I think we did exactly 5,000. We have 3 more of those to go. All right, I'm just going to put in here 4/16/35 nap. Should probably do that. Say that. 4/16. Okay, I'll be back. Thanks so much for listening. And actually, let me go back to our proper place in line. Oh man, we're close. We are close. We are close. Maybe I shouldn't do this. Yeah, I think I'm just going to keep going. I just feel like we can finish. I mean, once we get to 129, I think like that's gonna be bad. That's gonna, yeah, that's gonna be a lot to get through. 17. All right. Okay, I'll stick with the original plan. I'll be back. Hey, what's up, everyone? I'm back. Okay, it took a little bit longer than I thought. 4:16. Now it's 5:23. So I guess over an hour. I only set my alarm for 20 minutes and then 25 in case I overslept. But it took me a little bit to get to bed. I made a little post on YouTube and then I had to hit snooze. It's hard to only sleep for like 20 minutes one night, but you don't care because we're here to finish this thing. And also, I have an update on Tesla stock. 5:23:48. Woke up. We're going to finish it. I was kind of calculating this like almost in my sleep because I was thinking we have about 40 pages left. And at 5 minutes a page, that is 200 minutes, which is like 3 hours, over 3 hours. So yeah, it's 6:46 a.m. right now. It would be really nice to finish this before the market opens. And I don't know when you'll be watching this or if ever, but today is February 19th, 2020. And after being up 7.3% yesterday, it's looking, and you never know with pre-market, but it's looking as though Tesla stock will open up maybe as high as 8%, up at 927, with 927 per share, which is around, it topped out at, we learned this in the 10K, 968.99 or something per share. A couple of trading days after their earnings in early February. So it's almost back there. Anyway, that's it. It's time to get going. I'm just gonna have a little coffee quickly and just hopefully rip right through the whole rest of this thing. If you've been sitting here waiting for me to come back, I really apologize for tying you up. I'm just trying to get through this as quickly as I can, believe me. Okay. So we're on page 118. Legal proceedings, securities litigation relating to the Solar City acquisition between September 1st, 2016 and October 5th, 2016. 7 lawsuits are filed in the Delaware Court of Chancery by purported stockholders of Tesla challenging our acquisition of Solar City following consolidation. The lawsuit names as defendants the members of Tesla's board of directors as then constituted and alleges, among other things, that board members breached their fiduciary duties in connection with the acquisition. The complaint asserts both derivative claims and direct claims on behalf of a purported class and seeks, among other relief, unspecified monetary damages, attorney's fees, and costs. On January 27, 2017, defendants filed a motion to dismiss the operative complaint. Rather than respond to the defendant's motion, the plaintiffs filed an amended complaint on March 17, 2017. Defendants filed a motion to dismiss the amended complaint on December 13, 2017. The court heard oral argument on the motion on March 8, 2018. The court denied defendants' motion to dismiss. The defendants filed a request for interlocutory, never heard that word before, appeal, but the Delaware Supreme Court denied that request without ruling on the merits, but electing not to hear an appeal at this early stage of the case. Defendants filed their answer on May 18, 2018, and mediations were held on June 10th, 2019. Plaintiffs and defendants filed respective motions for summary judgment on August 25th, 2019, and further mediations were held on October 3rd, 2019. The court held a hearing on the motions for summary judgment on November 4th, 2019. On January 22nd, 2020, all of the director defendants except Elon Musk reached a tentative settlement to resolve the lawsuit against them for an amount that would be paid entirely under the applicable insurance policy. The settlement does not involve an admission or of any wrongdoing by any party. Tesla will receive such amount, which would be recognized as a gain in its financial statements if the settlement is finally approved by the court on February 4th, 2020. the court issued a ruling that denied plaintiffs' previously filed motion and granted in part and denied in part defendants' previously filed motion. Fact and expert discovery is complete, and the case is set for trial in March 2020. These plaintiffs and others filed parallel actions in the U.S. District Court for the District of Delaware on or about April 21st, 2017. They include claims for violations of the federal securities laws and breach of fiduciary duties by Tesla's board of directors. Those actions have been consolidated and stayed pending the above referenced Chancery Court litigation. We believe that claims challenging the Solar City acquisition are without merit and intend to defend against them vigorously. We are unable to estimate the possible loss or range of loss, if any, associated with these claims. I hope everything's going all right with this recording. I don't want to re-record this if something's happening. Securities litigation relating to production of Model 3 vehicles. On October 10th, 2017, a purported stockholder class action was filed in U.S. District Court for the Northern District of California against Tesla, 2 of its current officers and a former officer. The complaint alleges violations of federal securities laws and seeks unspecified compensatory damages and other relief on behalf of a purported class of purchasers of Tesla securities from May 4, 2016 to October 6, 2017. The lawsuit claims that Tesla supposedly made materially false and misleading statements regarding the company's preparedness to produce Model 3 vehicles. Plaintiffs filed an amended complaint on March 23, 2018, and defendants filed a motion to dismiss on May 25th, 2018. The court granted defendants' motion to dismiss with leave to amend. Plaintiffs filed their amended complaint on September 28, 2018. And defendants filed a motion to dismiss the amended complaint on February 5th, 2019. The hearing on the motion to dismiss was held on March 22nd, 2019, and on March 25th, 2019, the court ruled in favor of defendants and dismissed the complaint with prejudice. On April 8th, 2019, plaintiffs filed a notice of appeal, and on July 17th, 2019, filed their opening brief. We filed our opposition on September 16, 2019. We continue to believe that the claims are without merit and intend to defend against this lawsuit vigorously. We are unable to estimate the possible loss or range of loss, if any, associated with the lawsuit. Done with page 118. On October 6, 2018, in a similar action, a purported stockholder class action was filed in the Superior Court of California in Santa Clara County against Tesla, Elon Musk, and 7 initial purchasers in an offering of debt securities by Tesla in August 2017. The complaint alleges misrepresentations made by Tesla regarding the number of Model 3 vehicles Tesla expected to produce by the end of 2017 in connection with such offering, and seeks unspecified compensatory damages and other relief on behalf of a purported class of purchasers of Tesla securities in such offering. Tesla thereafter removed the case to federal court on January 22nd, 2019. Plaintiff abandoned its effort to proceed in state court, instead filing an amended complaint against Tesla, Elon Musk, and 7 initial purchasers in debt offering before the same judge in the U.S. District Court for the Northern California District of California, who's hearing the above referenced earlier filed federal case. On February 5th, 2019, the court stayed this new case pending a ruling on the motion to dismiss the complaint in such earlier filed federal case. After such earlier filed federal case was dismissed, defendants filed a motion on July 2nd, 2019 to dismiss this case as well. This case is now stayed pending a ruling from the appellate court on such earlier filed federal case, with an agreement that if defendants prevail in any appeal in such case, the case will be dismissed. We believe that the claims are without merit and intend to defend against the lawsuit vigorously. We are unable to estimate the possible loss or range of loss, if any, associated with the lawsuit. Litigation relating to 2018 CEO Performance Award. On June 4th, 2018, a purported Tesla stockholder filed a putative class and derivative action in the Delaware Court of Chancery against Elon Musk and the members of Tesla's board of directors, as then constituted, alleging corporate waste, unjust enrichment, and that such board members breached their fiduciary duties by approving the stock-based compensation plan. The complaint seeks, among other things, monetary damages and rescission or reformation of the stock-based compensation plan. On October 31st, 2018, defendants filed a motion to dismiss the complaint. Plaintiff filed its opposition brief on November 1st, 2018, and defendants filed a reply brief on December 13th, 2018. The hearing on the motion to dismiss was held on May 9th, 2019. On September 20th, 2019, the court granted the motion to dismiss as to the corporate waste claim, but denied the motion as to the breach of fiduciary duty and unjust enrichment claims. Our answer was filed on December 3rd, 2019, and trial is set for June 2021. We believe the claims asserted in this lawsuit are without merit and intend to defend against them vigorously. Securities litigation relating to potential going private transaction between August 10th, 2018 and September 6, 2018, 9 purported stockholder class action lawsuits were filed against Tesla and Elon Musk in connection with Elon Musk's August 7th, 2018 Twitter post that he was considering taking Tesla private. All of the suits are now pending in the U.S. District Court for the Northern District Court of California. Although the complaints vary in certain respects, they each purport to assert claims for violations of federal securities laws related to Mr. Musk's statement and seek unspecified compensatory damages and other relief on behalf of a purported class of purchasers of Tesla's securities. Plaintiffs filed their consolidated complaint on January 16th, 2019, and added as defendants the members of Tesla's board of directors. The now consolidated purported stockholder class action was stayed while the issue of selection of lead counsel was briefed and argued before the U.S. Court of Appeals for the Ninth Circuit. The Ninth Circuit ruled regarding lead counsel. Defendants filed a motion to dismiss the complaint on November 22nd, 2019. The hearing on the motion is set for March 6th, 2020. We believe that the claims have no merit and intend to defend against them vigorously. We are unable to estimate the potential loss or range of loss associated with these claims. Between October 17th, 2018 and November 9th, 2018, 5 derivative lawsuits were filed in the Delaware Court of Chancery against Mr. Musk and the members of Tesla's board of directors as then constituted in relation to statements made and actions connected to a potential going private transaction. In addition to these cases, on October 5th, 2018, another derivative lawsuit was filed in the U.S. District Court for the District of Delaware against Mr. Musk and the members of the Tesla board of directors as then constituted. The courts in both the Delaware Federal Court and Delaware Court of Chancery actions have consolidated their respective actions and stayed each consolidated action pending resolution of the above referenced consolidated purported stockholder class action. We believe that the claims have no merit and intend to defend against them vigorously. We are unable to estimate the potential loss or range of loss associated with these claims. 119 is in the books, and we're at 5:37. I'm going to try to get back on the clock and see if I can knock these out in under 5 minutes. On March 7, 2019, various stockholders filed a derivative suit in the Delaware Court of Chancery, purportedly on behalf of the company, naming Elon Musk and Tesla's board of directors, also related to Mr. Musk's August 7th, 2018 Twitter post that is the basis of the above referenced consolidated purported stockholder class action, as well as Mr. Musk's February 19th, 2019 Twitter post regarding Tesla's vehicle production. The suit asserts claims for breach of fiduciary duty and seeks declaratory and injunctive relief on specified damages and other relief. Plaintiffs moved for expedited proceedings in connection with the declaratory and injunctive relief. Briefs were filed on March 13, 2019, and the hearing held on March 18th, 2019, defendants prevailed with the court denying plaintiffs' request for an expedited trial and granting defendants' request to stay this action pending the outcome of the above referenced consolidated reported stockholder class action. Settlement with SEC related to potential going private transaction. On October 16, 2018, the U.S. District Court for the Southern District of New York entered a final judgment approving the terms of a settlement filed with the court on September 29, 2018, in connection with the actions taken by the U.S. Securities and Exchange Commission, the SEC, relating to Elon Musk's prior statement that he was considering taking Tesla private, without admitting or denying any of the SEC's allegations, and with no restriction on Mr. Musk's ability to serve as an officer or director on the board, other than as its chair. Among other things, we and Mr. Musk paid civil penalties of $20 million each and agreed that an independent director will serve as chair of the board for at least 3 years, and we appointed such an independent chair of the board and 2 additional independent directors to the board, and further enhanced our disclosure controls and other corporate governance related matters. On October 26, 2019, the settlement was amended to modify certain of the previously agreed disclosure procedures to clarify the application of such procedures, which was subsequently approved by the court. All other terms of the prior settlement were reaffirmed without modification. Certain investigations and other matters, we receive requests for information from regulators and governmental authorities such as the National Highway Traffic Safety Administration, the National Transportation Safety Board, the SEC, the Department of Justice, DOJ, and various state, federal, and international agencies. We routinely cooperate with such regulatory and governmental requests. In particular, the SEC had issued subpoenas to Tesla in connection with A, Elon Musk's prior statement that he was considering taking Tesla private, and B, certain projections that we made for Model 3 production rates during 2017, and other public statements relating to Model 3 production. The take private investigation was resolved and closed with the settlement with the SEC described above on December 4th, 2019. The SEC 1 closed the investigation into the projections and other public statements regarding Model 3 production rates, and 2 issued a subpoena seeking information concerning certain financial data and contracts, including Tesla's regular financing arrangements. Man. Separately, the DOJ had also asked us to voluntarily provide it with information about the above matters related to taking Tesla private and Model 3 production rates. Aside from the settlement as amended with the SEC relating to Mr. Musk's statement that he was considering taking Tesla private, there have not been any developments in these matters that we deem to be material. Okay, and to our knowledge, no government agency in any ongoing investigation has concluded that any wrongdoing occurred. As is our normal practice, we have been cooperating and will continue to cooperate with government authorities. We cannot predict the outcome or impact financial position and brand. Oh, I just got a warning from YouTube. Okay, it says you are not receiving enough video to maintain smooth streaming. As such, viewers will experience buffering. Okay. I hope you can see this. It seems like everything's streaming okay. So we're done with page 120. We're moving into the 120s now. I'd say we're not on the home stretch yet, but we are definitely moving in that direction. Excuse me. Indemnification and guaranteed returns. We are contractually obligated to compensate certain fund investors for any losses that they may suffer in certain limited circumstances resulting from reductions in U.S. Treasury grants or investment tax credits, ITCs. Generally, such obligations would arise as a result of reductions to the value of the underlying solar energy systems as assessed by the U.S. Treasury Department for purposes of claiming U.S. Treasury grants, or as assessed by the IRS for purposes of claiming ITCs or U.S. Treasury grants. For each balance sheet date, we assess and recognize when applicable distribution payable for the potential exposure from this obligation based on all the information available at that time, including any guidelines issued by the U.S. Treasury Department on solar energy system valuations for purposes of claiming U.S. Treasury grants and any audits undertaken by the IRS. We believe that any payments to the fund investors in excess of the amounts already recognized by us for this obligation are not probable or material based on the facts known at the filing date. The maximum potential future payments that we could have to make under this obligation would depend on the difference between the fair values of the solar energy systems sold or transferred to the funds as determined by us and the values that the U.S. Treasury Department will determine as fair value for the systems for purposes of claiming U.S. Treasury grants, or the values of the IRS would determine as the fair value for the systems for purposes of claiming ITCs or U.S. Treasury grants. We claim U.S. Treasury grants based on guidelines provided by the U.S. Treasury Department and the statutory regulations from the IRS. We use fair values determined with the assistance of independent third-party appraisals commissioned by us as the basis for determining the ITCs that are passed through to and claimed by the fund investors. Since we cannot determine future revisions to U.S. Treasury Department guidelines governing solar energy system values, or how the IRS will evaluate system values used in claiming ITCs or U.S. Treasury grants, we are unable to reliably estimate the maximum potential future payments that it could have to make under this obligation as of each balance sheet date. We are eligible to receive certain state and local incentives that are associated with renewable energy generation. The amount of incentives that can be claimed is based on the projected or actual solar energy system size and or the amount of solar energy produced. We also currently participate in one state's incentive program that is based on either the fair market value or the tax basis of solar energy systems placed in service. State and local incentives received are allocated between us and fund investors in accordance with the contractual provisions of each fund. We are not contractually obligated to indemnify any fund investor for any losses they may incur due to a shortfall in the amount of state or local incentives actually received. Our lease pass-through financing funds have a one-time lease payment reset mechanism that occurs after the installation of all solar energy systems in a fund. As a result of this mechanism, we may be required to refund master lease prepayments previously received from investors. Any funds of master lease prepayments would reduce the lease pass-through financing obligation. Letters of credit. As of December 31st, 2019, we had $282 million of unused letters of credit outstanding. Note 17, variable interest entity arrangements. We have entered into various arrangements with investors to facilitate the funding and monetization of our solar energy systems and vehicles. In particular, our wholly owned subsidiaries and fund investors have formed and contributed cash and assets into various financing funds and entered into related agreements. We have determined that the funds are variable interest entities, VIEs, and we are the primary beneficiary of these VIEs by reference to the power and benefits criterion under ASC 810 consolidation. We have considered the provisions within the agreements which grant us the power to manage and make decisions that affect the operation of these VIEs, including determining the solar energy systems or vehicles and the associated customer contracts to be sold or contributed, granted to the fund investors under the agreements are more protective in nature rather than participating. Done with page 121. As the primary beneficiary of these VIEs, we consolidate in the financial statements the financial position, results of operations, and cash flows of these VIEs and all intercompany balances and transactions between us and these VIEs are eliminated in the consolidated financial statements. Cash distributions of income and other receipts by a fund, net of agreed upon expenses, estimated expenses, tax benefits, and determinants of income and loss and tax credits are allocated to the fund investor and other subsidiary as specified in the agreements. Generally, our subsidiary has the option to acquire the fund investor's interest in the fund for an amount based on the market value of the fund or the formula specified in the agreements. Upon the sale or liquidation of a fund, distributions would occur in the order and priority specified in the agreements pursuant to management services, maintenance, and warranty arrangements. We have been contracted to provide services to the fund, such as operations and maintenance support, accounting, lease servicing, and performance reporting. In some instances, we have guaranteed payments to the fund investors as specified in the agreements. A fund's creditors have no recourse to our general credit or to that of other funds. None of the assets of the funds had been pledged as collateral for their obligations. The aggregate carrying values of the VIE's assets and liabilities after elimination of any intercompany transactions and balances in the consolidated balance sheets were as follows in millions: December 31st, 2019, December 31st, 2018. Assets, current assets, cash and equivalents. What are these? The VAs. 106.75 restricted cash, 90.131 accounts receivable net, 27.19. Prepaid expenses and other current assets, 10.10. Total current assets, 233.235. Operating lease vehicles net, 1183.155. Solar energy systems net, 5030, 5117. Restricted cash net of current portion, 69.65. Other assets, 87.56. Total assets, 66.02, 56.28. Liabilities, current liabilities, accrued liabilities, and other, 81.33. Deferred revenue, 78.21. Customer deposits, 9. Current portion of long-term debt and finance leases, 608.663. Total current liabilities, 775.817. Deferred revenue net of current portion, 264.178. Long-term debt and finance leases net of current portion, 1516.1238. Other long-term liabilities, 2226. Total liabilities, 2577. 2259. Note 18, lease pass-through financing obligation. Through December 31, 2019, we had entered into 8 transactions referred to as lease pass-through fund arrangements. Under lease arrangements, our wholly owned subsidiaries finance the cost of solar energy systems with investors through arrangements contractually structured as master leases for an initial term ranging between 10 and 25 years. These solar energy systems are subject to lease or PPAs with customers with an initial term not exceeding 25 years. These solar energy systems are included within solar energy systems net on the consolidated balance sheets. And that is all she wrote for page 122. I seem to remember that once we get to page 29, we sort of hit a little bit of a stride in terms of the pages getting easier. The cost of solar energy systems under lease pass-through fund arrangements as of December 31st, 2019 and 2018 was $1.05 billion. The accumulated depreciation on these assets as of December 31st, 2019 and 2018 was $101 million and $66 million, respectively. The total lease pass-through financing obligation as of December 31st, 2019 was $94 million, of which $57 million is classified as a current liability. The total lease pass-through financing obligation as of December 31, 2018 was $112 million, of which $262 million was classified as a current liability. Lease pass-through financing obligation is included in accrued liabilities and other for the current portion, and other long-term liabilities for the long-term portion on the consolidated balance sheets. Under a lease pass-through fund arrangement, the investor makes a large upfront payment to the lessor, which is one of our subsidiaries, and in some cases, subsequent periodic payments. We allocate a portion of the aggregate investor payments to the fair value of the assigned ITCs, which is estimated by discounting the projected cash flow impact of the ITCs using a market interest rate, and is accounted for separately. See Note 2, Summary of Significant Accounting Policies. We already saw that. We account for the remainder of the investor payments as a borrowing by recording the proceeds received as a lease pass-through. A portion of the amounts received by the investor is allocated to interest expense using the effective interest rate method. The lease pass-through financing obligation is non-recourse once the associated solar energy systems have been placed in service and the associated customer arrangements have been assigned to the investors. However, we are required to comply with certain financial covenants specified in the contractual agreements, which we had met as of December 31st, 2019. In addition, we are responsible for any warranties, performance guarantees, accounting, and performance reporting. Furthermore, we continue to account for the customer arrangements and any incentive rebates in the consolidated financial statements, regardless of whether the cash is received by us or directly by the investors. As of December 31st, 2019, the future minimum master lease payments to be received from investors for each of the next 5 years and thereafter were as follows: in millions: 2020, 42; 2021, 41; 2022, 33; 2023, 26; 2024, 18; thereafter 450, total 610. For two of the lease pass-through fund arrangements, our subsidiaries have pledged its assets to the investors as security for its obligations under the contractual agreements. Each lease pass-through fund arrangement has a one-time master lease prepayment adjustment mechanism that occurs when the capacity and the placed in service dates of the associated solar energy systems are finalized or on an agreed upon date. As part of this mechanism, the master lease prepayment amount is updated, and we may be obligated to refund a portion of a master lease prepayment or entitled to receive an additional master lease prepayment. Any additional master lease prepayments are recorded as an additional lease pass-through financing obligation, while any master lease prepayment refunds would reduce the lease pass-through financing obligation. You got all that? Note 19, defined contribution plan. We have a 401k savings plan that is intended to qualify as a deferred salary arrangement under Section 401k of the Internal Revenue Code. Under the 401k savings plan, participating employees may elect to contribute up to 100% of their eligible compensation, subject to certain limitations. Participants are fully vested in their contributions We did not make any contributions to the 401k savings plan during the years ended December 31, 2019, 2018, and 2017, other than employee deferrals of eligible compensation. I wonder why. That was 123. Note 20, related party transactions. Related party balances were comprised of the following in millions: December 31st, 2019, December 31st, 2018. Convertible senior notes due to related parties, 3. Our convertible senior notes are not remeasured at fair value. Refer to Note 5, fair value of financial instruments as of December 31, 2019 and 2018. The unpaid principal balance of convertible senior notes due to related parties is $3 million. In March 2017, our CEO purchased from us 95,420 shares of our common stock in a public offering at the public offering price for an aggregate $25 million. Just hit the 6-hour mark. To be fair, I was asleep for an hour of it, or at least not broadcasting for an hour of it. In April 2017, our CEO exercised his right under the indenture to convert all of his zero coupon convertible senior notes due in 2020, which had an aggregate principal of $10 million. As a result, on April 26, 2017, we issued 33,333 shares of our common stock to our CEO in accordance with the specified conversion rate, and we recorded an increase to additional paid-in capital of $10 million. In November 2018, our CEO purchased from us 56,915 shares of our common stock in a private placement at a per-share price equal to the last closing price of our stock prior to the execution of the purchase agreement for an aggregate $20 million. In May 2019, our CEO purchased from us 102,880 shares of our common stock in a public offering at the public offering price for an aggregate of $25 million. Note 21, segment reporting and information about geographic areas. We have 2 operating and reportable segments, 1 automotive and 2 energy generation and storage. The automotive segment includes the design, development, manufacturing, sales, and leasing of electric. Oh, I'm going to do it. Boom. Vehicles as well as sales of automotive regulatory credits. Additionally, the automotive segment is comprised of services and other, which includes non-warranty after-sales vehicle sales, sales of used vehicles, retail merchandise, sales by our acquired subsidiaries to third-party customers, and vehicle insurance revenue. The energy generation and storage segment includes the design, manufacture, installation, sales, and leasing of solar energy generation and energy storage products and related services, and sales of solar energy systems incentives. Our CODM does not evaluate operating segments using asset or liability information. The following table presents revenues and gross profits by reportable segment in millions. Year ended December 31st, 2019, 2018, 2017. Automotive segment revenues 23,047, 19,906, 10,643. Gross profit 3,879, 3,852, 1981. Energy generation and storage segment 1531, 1555, 1116. Gross profit 190, 192, 42. And that's page 124. And just going to check something on my phone real quick. Sorry. I really put a lot of time into this channel, and I really appreciate anybody who's watching this right now. I just want you to know that. Um, so that's 124. The following table represents revenues by geographic area based on the sales location of our products in millions. Year ended December 31st, 2019, 2018, 2017. United States 12653, 14872, 6221. China 2979. Hello to anybody watching from China. Also, hello to anybody watching from the US. 1757, 2027. Hello to anybody watching from Netherlands. 1590, 965, 331. Hello to anybody watching from Norway. 1201, 813, 823. Hello to anybody watching from other. 6155, 3054, 2357. Total 24578, 21461. Were impacted by the price adjustments we made to our vehicle offerings during 2019. Refer to Note 2, Summary of Significant Accounting Policies for details. The following table presents long-lived assets by geographic area in millions. December 31st, 2019, December 31st, 2018, United States 15644, 16741, international 890, 860, total 16534, 17601. Note 22, restructuring and other. During the year ended December 31, 2019, we carried out certain restructuring actions in order to reduce costs and improve efficiency. As a result, we recognized $50 million of costs primarily related to employee termination expenses and losses from closing certain stores impacting both segments. We recognized $47 million in impairment related to the IPR&D intangible asset as we abandoned further development efforts. Refer to Note 4, goodwill and intangible assets for details, and $15 million for the related equipment within the energy generation and storage segment. We also incurred a loss of $37 million for closing operations in certain facilities. On the statement of cash flows, the amounts were presented in the captions in which such amounts have been recorded. Absent the impairment charges, the employee termination expenses were substantially paid by December 31st, 2019, while the remaining amounts were non-cash. During the year ended December 31st, 2018, we carried out certain restructuring actions in order to reduce costs and improve efficiency, and recognized $37 million of employee termination expenses and estimated losses from subleasing a certain facility. The employee termination cash expenses of $27 million were substantially paid. Expenses, materially all of which were non-cash, from restructuring the energy generation and storage segment, which comprised of disposals of, I think that's a typo too, which was comprised of disposals of certain tangible assets, the shortening of the useful life of a trade name intangible asset, and a contract termination penalty. In addition, we concluded that a small portion of the IPR&D asset is not commercially feasible. Consequently, we recognized an impairment loss of $13 million. We recognized settlement and legal expenses of $30 million in the year ended December 31, 2018 for the settlement with the SEC relating to a take-private proposal for Tesla. These expenses were substantially paid by the end of 2018. And I might try to see if we can go live. We just did 125. And let me just see. When this was. Let me add a little bit of flare. Let's see. I think you'll like this if you're watching right now. Well, you won't be watching yet. But I think you'll like this. Let's see. Oh. Sorry for the delay. I'm just trying to find an image I can put up that'll make this a little bit more fun. So there's that, and then there's 200. Let's see if we can you see that? Let's see if we can. We'll do that, and one more. I'm not sure what it's telling me. I have unsaved changes. I hope I don't. I'll add one more. Let's see if this works. So that one doesn't work. I was going to add one more. This could be it. There we go. It's ridiculous. So 734, which is, just look at what that means. Oh. I want to do one other thing. Change the thumbnail. So let me see if I can do that. Not sure where I got the thumbnail for this thing. What is this? Let's see. No. 1 second. Yep. How do I add text? No. ever do this. And probably got to make that a little bigger. Maybe like 300. Looks decent. If I just want to move this thing around, how do I do that? Just want. Okay. Should be good. Let's create a thumbnail. Screenshot and documents 2022-19. Let's see if I can actually upload that. The thumbnails are important, otherwise nobody will show up. Although part of it got cut off. So I will crop it. Nope. Okay, this may end up being a waste of time. Actually, it already has been. Come on. Macs are great sometimes, but not when you want to do anything quickly. If you don't know how to do it, they can be very non-intuitive. Like right now. File. Ah. Okay, I just cropped the image a little bit so that it'll actually show up. Man, this is terrible. Okay, I cannot waste any more time. I know I've been saying that, but I'm not sure what else to do. Okay. Got the new image. I'm going to save it. In documents. Try that. You'll be seeing this if you've clicked on this video. All right, that's close enough. Okay, going public. Oh. And the chat doesn't work. That's not good. Let me turn it back on. Live chat. Enable. Just testing. So to anyone watching, the title is pretty accurate. We've been going all night, although we had a nap. And we're now on page 126 of the 10K. I'm assuming people will be clicking in and then probably leaving, which is fine. But I figure I'd just do it live. Just for fun. So here we go. And hello to anybody who's in here. Note 23, quarterly results of operations unaudited. I should probably say when we went live. Six 21 59 went live. Okay. All right, note 23, quarterly results of operations unaudited. The following table presents selected quarterly results of operations data for the years ended December 31st, 2019 and 2018 in millions except per share amounts. 3 months ended March 31, June 30th, September 30th, December 31st, 2019. Total revenues 4541, 6350, 6303, 7384. Gross profits 566, 921, 1191, 1391. Net loss income attributable to common stockholders negative 702, negative 408, 143, 105. Net loss income per share of common stock attributable to common stockholders basic negative 410, negative 231, 80, 58. Net loss income per share of common stock attributable to common stockholders diluted negative 410, negative 231, 78, 56. 2018, they say 2019 total revenues 3409, 4002, 6824, 7226. Gross profit 456, 619, 1524, 1443. Net loss income attributable to common stockholders 709, negative 718, 311, 140. Net loss income per share of common stock attributable to common stockholders basic negative 419, negative 422, 182, 81. Net loss income per share of common stock attributable to common stockholders diluted negative 419, negative 422, 175, 78. And we are done with page 126. I think it will heat up once we get to 129. Item 9, changes in and disagreements with accountants on accounting and financial disclosure, none. Controls and procedures. Evaluation of disclosure controls and procedures. Our management, with the participation of our Chief Executive Officer and our Chief Financial Officer, evaluated the effectiveness of our disclosure controls and procedures pursuant to Rule 13A15 under the Securities Exchange Act of 1934 as amended. The Exchange Act, in designing and evaluating the disclosure controls and procedures, our management recognizes that any controls and procedures, no matter how well designed and operated, can provide only reasonable assurance of achieving the desired control objectives. In addition, the design of disclosure controls and procedures must reflect the fact that there are resource constraints and that our management is required to apply its judgment in evaluating the benefits of possible controls and procedures relative to their costs. Based on this evaluation, our Chief Executive Officer and our Chief Financial Officer conclude that as of December 31st, 2019, our disclosure controls and procedures were designed at a reasonable assurance level and were effective to provide reasonable assurance that the information we are required to disclose in reports that we file or submit under the Exchange Act is recorded, processed, summarized, and reported within the time period specified in the Securities and Exchange Commission rules and forms, and that such information is accumulated and communicated to our management, including our Chief Executive Officer and our Chief Financial Officer, as appropriate to allow timely decisions regarding required disclosures. Welcome to anybody who's joining. Hello, hello. If you're here. Another interesting day for Tesla stock. Management's report on internal control over financial reporting. Our management is responsible for establishing and maintaining adequate internal control over financial reporting. Internal control over financial reporting is a process designed by or under the supervision of our Chief Executive Officer and Chief Financial Officer to provide reasonable assurance regarding the reliability of financial reporting and the preparation of financial statements for external purposes in accordance with generally accepted accounting principles, and includes those policies and procedures that, one, pertain to the maintenance of records that in reasonable detail accurately and fairly reflect the transactions and dispositions of our assets. Two, provide reasonable assurance that transactions are recorded as necessary to permit preparation of financial statements in accordance with generally accepted accounting principles, and that our receipts and expenditures, I finally figured out how to work this thing, are being made only in accordance with authorizations of our management and directors. And three, provide reasonable assurance regarding prevention or timely detection of unauthorized acquisition, use, or disposition of our assets that could have a material effect on the financial statements. Under the supervision and with the participation of our management, including our Chief Executive Officer and Chief Financial Officer, we conduct an evaluation of the effectiveness of our internal control over financial reporting based on criteria established in Internal Control Integrated Framework 2013, issued by the Committee of Sponsoring Organizations of the Treadway Commission, COSO. Our management concluded that our internal control over financial reporting was effective as of December 31st, 2019. Our independent registered public accounting firm, PricewaterhouseCoopers LLP, has audited the effectiveness of our internal control over financial reporting as of December 31st, 2019, as stated in the report, which is included herein. Limitations on effectiveness. By the way, if anybody has any questions about the stock this morning, put them in the comments. Hey, Royal. Let me another interesting day for if any questions or comments, leave a message. Yeah, very interesting. Going to try to finish this up here. We've been going pretty much all night, but just went live. And our independent registered public accounting firm, PricewaterhouseCoopers, more people will come in. LLP, we just went live, has audited the effectiveness of our internal control over financial reporting as of December 31, 2019, as stated in the report, which is included herein. Limitations on the effectiveness of controls Because of inherent limitations, internal control over financial reporting may not prevent or detect misstatements and projections of any evaluation of effectiveness to future periods. Or procedures may deteriorate. And page 127 is now in the books. Keeping track of that up here at the top. So we're on page 128, and I had page 128, 129 in my mind since I started very early on because I knew that things got a lot easier here. So we're in the home stretch, everyone. We are definitely in the home stretch. Changes in internal control over financial reporting. There was no change in our internal control over financial reporting that occurred during the fourth fiscal quarter of the year ended December 31st, 2019, which is materially affected or is reasonably likely to materially affect our internal control over financial reporting. Item 9B, other information, none. And page 128 is in the books. There are a total of 156 pages, and we started on page 1, or page 0. Part 3, Item 10, Directors, Executive Officers, and Corporate Governance, the information required by this item. By the way, thank you so much for watching. I can't believe anybody's watching this. This is a cool community, and I'm really appreciative of anybody who's interested in this. I know it's a little crazy, but and I know a lot of people don't like it. But if you sort of get it and you're interested and or you're watching or you're just entertained by this, I really appreciate every single viewer and every single person in the community. So thank you. It means a lot. And welcome and good morning. The information required by this item 10 of Form 10K will be included in our 2020 proxy statement to be filed with the Securities and Exchange Commission in connection with the solicitation of proxies for our 2020 annual meeting of stockholders and is incorporated herein by reference. The 2020 proxy statement will be filed with the Securities and Exchange Commission within 120 days at the end of the fiscal year to which this report relates. Item 11, executive compensation. The information required by this item 11 of Form 10K will be included in our 2020 proxy statement and is incorporated herein by reference. Item 12, security ownership of certain beneficial owners and management and related stockholder matters. The information required by this item 12 of Form 10K will be included in our 2020 proxy statement and is incorporated herein by reference. Item 13, certain relationships and related transactions and director independence. The information required by this item 13 of Form 10K will be included in our 2020 proxy statement and is incorporated herein by reference. Item 14, principal accountant fees and services. The information required by this item 14 of Form 10K will be included in our 2020 proxy statement and is incorporated herein by reference. Item 15, exhibits and financial statements. In financial statement schedules 1, financial statements, see Index to consolidated financial statements in Part 2, Item 8 of this report. 2, all financial statement schedules have been omitted since the required information was not applicable or was not present in amount sufficient to require submission of the schedules, or because the information required is scheduled in the consolidated financial statements or the accompanying notes. 3, the exhibits listed in the following Index to exhibits are filed or incorporated by reference as part of this report. And page 129 is in the books. Although we still have a lot of pages, we have about 27 left. Index to exhibits, exhibit number, exhibit description, incorporated by reference, form, file number, exhibit, filing date, filed herewith. I might just go down the columns. 31, 32, 33, 41, 42, 43, 44, 45, 46, 47, 48. Amended and restated certificate of incorporation of the registrant, certificate of amendment to the amended and restated certificate of incorporation of the registrant, amended and restated bylaws of the registrant, specimen common stock certificate of the registrant, Fifth Amended and Restated Investors' Rights Agreement dated as of August 31, 2009 between registrant and certain holders of registrant's capital stock named therein. Amendment to Fifth Amended and Restated Investors' Rights Agreement dated as of May 20th, 2010 between registrant and certain holders of the registrant's capital stock named therein. Amendment to Fifth Amended and Restated Investors' Rights Agreement between registrant Toyota Motor Corporation and certain holders of the registrant's capital stock named therein. Amendment to Fifth Amendment Amended and Restated Investors' Rights Agreement dated as of June 14th, 2010 between registrant and certain holders of the registrant's capital stock named therein. Amendment to Fifth Amended and Restated Investors' Rights Agreement dated as of November 2nd, 2010 between registrant and certain holders of the registrant's capital stock named therein. Waiver to Fifth Amended and Restated Investors' Rights Amendment dated as of May 22nd, 2011 between registrant and certain holders of the registrant's capital stock named therein. Amendment to Fifth Amended and Restated Investors' Rights Agreement dated as of May 30th, 2011 between registrant and certain holders of the registrant's capital stock named herein. This part may actually be not as easy as I thought. 10K, 10K, 8K, 10K, S1, S1A, 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 8K, S1A, 8K. 001 34756 001 34756 001 34756 001 34756 333 164 593 333 164 593 333 164 593 333 164 593 001 34756 333 174466 001 34756 3.1 3.2 3.2 4.1 4.2 4.2a 4.2b 4.2c 4.1 4.2e 4.1 March 1st, 2017, March 1st, 2017, February 1st, 2017, March 1st, 2017, January 29th, 2010, May 27th, 2010, May 27th, 2010, June 15th, 2010, November 4th, 2010, June 2nd, 2011, June 1st, 2011. So page 130 is in the books. These pages actually might take a long time. So on average, these have been taking me about 5 minutes. So we've been going 6 hours, 37 minutes. So we'll see if we can finish this by 6 hours, 42 minutes, or actually 6 hours, 43. Next page, if your filing date filed herewith, 4/9, 4/10, 4/11, 4/12, 4/13, 4/14, 4/15, 4/16, 4/17, 4/18, 4/19. Sixth Amendment to Fifth Amended and Restated Investors' Rights Agreement dated as of May 15, 2013 among the registrant, the Elon Musk Revocable Trust dated July 22, 2003 and certain other holders of the capital stock of the registrant named therein. Waiver to Fifth Amended and Restated Investors' Rights Agreement dated as of May 14, 2013 between the registrant and certain holders of capital stock of the registrant named therein. Waiver to Fifth Amended and Restated Investors' Rights Agreement dated as of August 13, 2015 between the registrant and certain holders of the capital stock of the registrant named therein. Waiver of Fifth Amended and Restated Investors' Rights Agreement dated as of May 18, 2016 between the registrant and certain holders of the capital stock of the registrant named therein. Waiver to Fifth Amended and Restated Investors' Rights Agreement dated as of March 15, 2017 between the registrant and certain holders of the capital stock of the registrant named therein. Waiver to Fifth Amended and Restated Investors' Rights Agreement dated as of May 1st, 2019 between the registrant and certain holders of the capital stock of the registrant named therein. Indenture dated as of May 22nd, 2013 by and between the registrant and U.S. Bank National Association. Third supplemental indenture dated as of March 5th, 2014 by and between the registrant and U.S. Bank National Association. Form 4.25% convertible senior note due March 1st, 2021, included in Exhibit 4.19. 4 supplemental indenture dated as of March 22nd, 2017, by and between the registrant and U.S. Bank National Association. Form 2.375% convertible senior note due March 15th, 2022, included in Exhibit 4.21. 8K, 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 8K. 00134756001347560013476 0013476 41 42 41 41 41 41 41 44 44 42 42 May 20th, 2013, May 20th, 2013, August 9th, 19th, 2015, May 24th, 2016, March 17th, 2017, May 3rd, 2019, May 22nd, 2013, March 5th, 2014, March 5th, 2014, March 22nd, 2017, March 22nd, 2017. And let's just see. So that was page 131, which is now in the books. Out of 156. Good morning, Nick. Let's see how many more there are of these. This is page 132. Oh, man. Oh, these are going to be... Oh, these are going to be painful. Basically all the way up to 153. It shouldn't be too bad. This part will be a little bit more boring, honestly, than the other parts. Not that I want to encourage people to leave. If you're having fun, you should stay, but this part will definitely be more boring than what we've read. These are just the exhibits. Exhibit number, exhibit description, incorporated by reference, form, file number, exhibit, filing date, filed herewith, 420, 421, 422, 423, 424, 425, 426, 427, 428, 429, 430. Indenture dated as of August 18th, 2017, by and among the registrant Solar City and U.S. Bank National Association as trustee, form 5.3% senior note due August 15th, 2025. Indenture dated as of September 30th, 2014, between Solar City and Wells Fargo Bank National Association. First supplemental indenture dated as of November 21st, 2016, between Solar City and Wells Fargo Bank National Association as trustee to the indenture dated as of September 30th, 2014, between Solar City and Wells Fargo Bank National Association as trustee. Indenture dated as of December 7th, 2015, between Solar City and Wells Fargo National Association. First supplemental indenture dated as of November 21st, 2016, between Solar City and Wells Fargo Bank National Association as trustee to the indenture dated December 7th, 2015, between Solar City and Wells Fargo Bank National Association as trustee. Indenture as of October 15th, 2014, between Solar City and U.S. Bank National Association as trustee. Fifth supplemental indenture dated as of May 7, 2019, by and between registrant and U.S. National Bank, U.S. Bank National Association, related to 2% convertible senior notes due May 15th, 2024. Form of 2% convertible senior notes due May 15th, 2024, including Exhibit 4.27. Fourth supplemental indenture dated as of October 15th, 2014, by and between Solar City and the trustee related to Solar City's 4% Solar Bonds Series 2014-47. Eighth supplemental indenture dated as of January 29, 2015, by and between Solar City and the trustee related to Solar City's 4% Solar City Bonds Series 2015-47. 8K, 8K, 8K1, 8K, 8K1, 8K, S3, ASR1, 8K, 8K, 8K1, 8K1, 0013476, 0013476, 0013578, 0013476, 0013578, 0013476, 333-199-321, 0013756, 0013756, 0013758, 0013758, 4142, 4142, 4143, 4142, 4345, 45. August 23rd, 2017, August 23rd, 2017, October 6th, 2014, November 21st, 2016, December 7th, 2015, November 21st, 2016, October 15th, 2014, May 8th, 2019, May 8th, 2019, October 15th, 2014, January 29th, 2015, and page 132 is now in the record books. If you're keeping track at home. A lot of exhibits, yeah. And I've been doing about 5 minutes a page, or roughly, or under that. So right here, I should finish this by 6:51. Hopefully, more quickly than that. Also, I don't know if you can scroll back, but we've did a lot more than just the exhibits. Exhibit number, exhibit description, incorporated by reference, form, file number. Also, does anybody know why the stock is up today? Pre-market, exhibit, filing date, filed herewith. 431, 432, 433, 434, 435, 436, 437, 438, 439, 440. Ninth supplemental indenture dated as of March 9, 2015 by and between Solar City and the trustee related to Solar City's 4% solar bond series 2015-55. 10th supplemental indenture dated as of March 9th, 2015 by and between Solar City and the trustee related to Solar City's 5% solar bonds series 2015-610. 11th supplemental indenture dated as of March 9th, 2015 by and between Solar City and the trustee related to Solar City's 5.75% solar bonds series 2015-715. 14th supplemental indenture dated as of March 19th, 2015 by and between Solar City and the trustee related to Solar City's 3.6 solar bond series 2015 C35. 15th supplemental indenture dated as of March 19th, 2015 by and between Solar City and the trustee related to Solar City's 4.7% solar bonds series 2015 C4-10. 16 supplemental indenture dated as of March 19th, 2015 by and between Solar City and the trustee related to Solar City's 5.45% solar bonds series 2015 C5-15. 19th supplemental indenture dated as of March 26, 2015 by and between Solar City and the trustee related to Solar City's 3.6% solar bond series 2015 C85. 20th supplemental indenture dated as of March 26, 2015 by and between Solar City and the trustee related to Solar City's 4.7% solar bond series 2015 C910. 21st supplemental indenture dated as of March 26, 2015 by and between Solar City and the trustee related to Solar City's 5.45% solar bond series 2015 C1015. 25th supplemental indenture dated as of April 2nd, 2015 by and between Solar City and the trustee related to Solar City's 3.6% solar bond series 2015 C13-5. AK1, 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 AK1. 001355758, 001355758, 001355758, 001355758, 001355758, 001355758, 001355758, 001355758, 001355758, 001355758. You guys really don't have to listen to this. This is crazy, but it's good to finish it. And thanks for watching if you are. 42, 43, 44, 44, 45, 46, 44, 45, 46, 44. March 9th, 2015, March 9th, 2015, March 9th, 2015, March 19th, 2015, March 19th, 2015, March 19th, 2015, March 26th, 2015, March 26th, 2015, March 26th, 2015, April 2nd, 2015. And if you're keeping track or following along, there's a link in the description. We just finished page 133, moving on to page 134, and there's 156 total pages. The last page, I think, is a signature page. Yeah, I saw that, the price targets. It's funny that they wait until after the stock went up to raise their price targets. Exhibit number, exhibit description, incorporated by reference, form, file number, exhibit, filing date, filed herewith, 441, 442, 443, 444, 445, 446, 447, 448, 449, 450. 26 supplemental indenture dated as of April 2nd, 2015, by and between Solar City and the trustee related to Solar City's 4.7 solar bonds, Series 2015 C1410. 29th supplemental indenture dated as of April 9th, 2015, by and between Solar City and the trustee related to Solar City's 3.6 solar bonds, Series 2015 C185. 30th supplemental indenture dated as of April 9th, 2015, by and between Solar City and the trustee related to Solar City's 4.7% solar bonds, Series 2015 C1910. 31st supplemental indenture dated as of April 9th, 2015, by and between Solar City and the trustee related to Solar City's 5.45% solar bonds, Series 2015 C2015. What's up, everyone? Thanks so much for being here. Another interesting day. 34 supplemental indenture dated as of April 14, 2015, by and between Solar City and the trustee related to Solar City's 3.6 solar bonds, Series 2015 C23-5. The 35th supplemental indenture dated as of April 14, 2015, by and between Solar City and the trustee related to Solar City's 4.7% solar bonds, Series 2015 C2410. It's going to take a long time. 36 supplemental indenture dated as of April 14, 2015, by and between Solar City and the trustee related to Solar City's 5.45% solar bonds, Series 2015 C2515. 38 supplemental indenture dated as of April 21st, 2015, by and between Solar City and the trustee related to Solar City's 4.7% solar bonds, Series 2015 C2710. 39th supplemental indenture dated as of April 21st, 2015, by and between Solar City and the trustee related to Solar City's 5.45% solar bonds, Series 2015 C2815. 42nd supplemental indenture dated as of April 27, 2015, by and between Solar City and the trustee related to Solar City's 3.6% solar bonds, Series 2015 C31-5. Home stretch, boys. Home stretch, everybody. I know we have women that listen to this too. 8K1, 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 8K1. 001357580, 001357580, 001357580, 001357580, 001357580, 001357580, 001357580, 001357580, 001357580, 001357580, 4544 4546 14 2015, April 21st, 2015, April 21st, 2015, April 27th, 2015. And if you're following along at home or reading along, we just finished page 134. And this one I'm going to actually time myself to see, so I can give you, everybody watching, an estimate of how much longer this will take. Hopefully you're doing other things. This is ridiculous, but we got this far. Might as well finish it. And I hope you're having a great day. Exhibit number, exhibit description, incorporated by reference, form, file number, exhibit, filing date, filed herewith, 451, 452, 453, 454, 455, 456, 457, 458, 459, 460. 43rd supplemental indenture dated as of April 27, 2015 by and between Solar City and the trustee related to Solar City's 4.7% solar bonds series 2015 C3210. 44th supplemental indenture dated as of April 27, 2015 by and between Solar City and the trustee related to Solar City's 5.45% solar bonds series 2015 C3315. 47th supplemental indenture dated as of May 1st, 2015 by and between Solar City and the trustee related to Solar City's 4% solar bond series 2015 11.5. 48 supplemental indenture dated as of May 1st, 2015 by and between Solar City and the trustee related to Solar City's 5% solar bond series 2015 12.10. 49th supplemental indenture dated as of May 1st, 2015 by and between Solar City and the trustee related to Solar City's 5.75% solar bond series 2015 13.15. 51st supplemental indenture dated as of May 11, 2015 by and between Solar City and the trustee related to Solar City's 3.6% solar bonds series 2015 C35.5. 52nd supplemental indenture dated as of May 11, 2015 by and between Solar City and the trustee related to Solar City's 4.7% solar bonds series 2015 C3610. 53rd supplemental indenture dated as of May 11, 2015 by and between Solar City and the trustee related to Solar City's 5.45% solar bonds series 2015 C3715. 56th supplemental indenture dated as of May 18, 2015 by and between Solar City and the trustee related to Solar City's 3.6% solar bonds series 2015 C39.5. 57th supplemental indenture dated as of May 18, 2015 by and between Solar City and the trustee related to Solar City's 4.7% solar bonds series 2015 C4010. AK1, 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 AK1. 0013578, 0013578, 0013578, 0013578, 0013578, 0013578, 0013578, 0013578, 0013578, 0013578, 4.5, 4.6, 44, 45, 46, 43, 44, 45, 43, 44. April 27, 2015, April 27, 2015, May 1st, 2015, May 1st, 2015, May 1st, 2015, May 11, 2015, May 11, 2015, May 11, 2015, May 18, 2015, May 18th, 2015. And that's page 135 in the record books. And that took about 3 minutes, roughly. So we have 20 pages left, 21 pages left. So it could take another hour. And that actually works nicely because the goal was to do this before the market opened. So hopefully we'll get there. Exhibit number, exhibit description, incorporated by reference, form, file number, exhibit, filing date, filed herewith. 461, 462, 463, 464, 465, 466, 467, 468, 469, 47. 58 supplemental indenture dated as of May 18, 2015 by and between Solar City and the trustee related to Solar City's 5.45% solar bonds series 2015 C4115. 60th supplemental indenture dated as of May 26, 2015 by and between Solar City and the trustee related to Solar City's 3.6% solar bonds series 2015 C435. 61st supplemental indenture dated as of May 26, 2015 by and between Solar City and the trustee related to Solar City's 4.7% solar bonds series 2015 C4410. 62nd supplemental indenture dated as of May 26, 2015 by and between Solar City and the trustee related to Solar City's 5.45% solar bonds series 2015 C4515. 65th supplemental indenture dated as of June 8th, 2015 by and between Solar City and the trustee related to Solar City's 3.6% solar bonds series 2015 C47.5. 67th supplemental indenture dated as of June June 8th, 2015, by and between Solar City and the trustee related to Solar City's 5.45% solar bond, Series 2015, C4915, 70th supplemental indenture dated as of June 16, 2015, by and between Solar City and the trustee related to Solar City's 4.7% solar bond, Series 2015, C52-10, 71st supplemental indenture dated as of June 16th, 2015, by and between Solar City and the trustee related to Solar City's 5.45% solar bonds, Series 2015 C53-15, 74 supplemental indenture dated as of June 22nd, 2015, by and between Solar City and the trustee related to Solar City's 4.7% solar bonds, Series 2015 C56-10, 75th supplemental indenture. People are dropping out. That makes a little more sense. Data as of June 22nd, 2015, by and between Solar City and the trustee related to Solar City's 5.45% solar bonds, Series 2015 C5715, 8K1, 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 8K1. 0013578, 0013578, 0013578, 0013578, 0013578, 0013578, 0013578, 0013578, 0013578, 0013578, 0013578, 45, 43, 44, 45, 43, 45, 44, 45, 44, 45. May 18, 2015, May 26, 2015, May 26, 2015, May 26, 2015, June 10, 2015, June 10, 2015, June 16, 2015, June 16, 2015, June 23, 2015, June 23, 2015. And that is 136 in the books, which means there's only 20 pages left. In 1 hour, I have an appointment. We'll definitely go to the appointment. Let me look up Tesla stock real quick for anybody who's interested. Not that this post is about that. So it's pre-market looking up another 7%. So page 137, exhibit number, exhibit description, incorporated by reference, form, file number, exhibit, filing date, filed herewith, 471, 472, 473, 474, 475, 476, 477, 478, 479, 480. 79 supplemental indenture dated as of June 29, 2015, by and between Solar City and the trustee related to Solar City's 3.6% solar bond, Series 2015 C65. 80th supplemental indenture dated as of June 29, 2015, by and between Solar City and the trustee related to Solar City's 4.7% solar bond, Series 2015 C6110. 81st supplemental indenture dated as of June 29, 2015, by and between Solar City and the trustee related to Solar City's 5.45% solar bonds, Series 2015 C6215. 84 supplemental indenture dated as of July 14th, 2015, by and between Solar City and the trustee related to Solar City's 3.6% solar bonds, Series 2015 C65-5. 86 supplemental indenture dated as of July 14, 2015, by and between Solar City and the trustee related to Solar City's 5.45% solar bond, Series 2015 C6715. 89 supplemental indenture dated as of July 20th, 2015, by and between Solar City and the trustee related to Solar City's 5.45% solar bond, Series 2015 C6715. I think I already read that one. 89 supplemental indenture dated as of July 20th, 2015, by and between Solar City and the trustee related to Solar City's 3.6% solar bonds, Series 2015 C75. 90th supplemental indenture dated as of July 20th, 2015, by and between Solar City and the trustee related to Solar City's 4.7% solar bonds, Series 2015 C7110. 91st supplemental indenture dated as of July 20, 2015 by and between Solar City and the trustee related to Solar City's 5.45% solar bonds, Series 2015 C7215. 94th supplemental indenture dated as of July 31st, 2015 by and between Solar City and the trustee related to Solar City's 4% solar bonds, Series 2015 19.5. 95th supplemental indenture dated as of July 31st, 2015 by and between Solar City and the trustee related to Solar City's 5% solar bonds, Series 2015 2010. AK1, 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 AK1. 013578. No. 013578, 013578, 013578, 013578, 013578, 013578, 644, 4644, 45, 46, 4445. Thank you for the likes. June 29, 2015, June 29, 2015, June 29, 2015, July 14, 2015, July 14, 2015, July 21st, 2015, July 21st, 2015, July 21st, 2015, July 31st, 2015, July 31st, 2015, page 137 in the record books. Exhibit number, exhibit description, incorporated by reference, form, file number, exhibit, filing date, filed herewith, 481, 482, 483, 484, 485, 486, 487, 488, 489. 96 supplemental indenture dated as of July 31st, 2015 by between Solar City and the trustee related to Solar City's 5.75% solar bond, Series 2015 2115. 99 supplemental indenture dated as of August 3rd, 2015 by and between Solar City and the trustee related to Solar City's 3.6% solar bond, Series 2015 C75-5. 105th supplemental indenture dated as of August 10, 2015 by and between Solar City and the trustee related to Solar City's 4.7% solar bond, Series 2015 C81-10. 109th supplemental indenture dated as of August 17th, 2015 by and between Solar City and the trustee related to Solar City's 3.6% solar bond, Series 2015 C85-5. 111 supplemental indenture dated as of August 17, 2015 by and between Solar City and the trustee related to Solar City's 5.45% solar bonds, Series 2015 C87-15. 114 supplemental indenture dated as of August 24, 2015 by and between Solar City and the trustee related to Solar City's 3.6% solar bonds, Series 2015 C90-5. 116th supplemental indenture dated as of August 24, 2015 by and between Solar City and the trustee related to Solar City's 5.45% solar bonds, Series 2015 C92-15 between Solar City and the trustee related to Solar City's 3.6% solar bonds, Series 2015 C95-5. 121st supplemental indenture dated as of August 31st, 2015 by and between Solar City and the trustee related to Solar City's 5.45% solar bonds, Series 2015 C97-15. AK1, 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 AK1. 001357580, 001357580, 001357580, 001357580, 001357580, 001357580, 001357580, 0013578. Thank you for the like. 464445, 444644464446. July 31st, 2015, August 3rd, 2015, August 10th, 2015, August 17th, 2015, August 17th, 2015, August 24th, 2015, August 24th, 2015, August 31st, 2015, August 31st, 2015. And if you're reading along from home or in the car, we just finished page 138, and now we're at the top of 139. Oh, this is a shorter one. They're getting shorter. Awesome. And this document ends on page 156. Exhibit number, exhibit description, incorporated by reference, form, file number, exhibit, filing date, filed herewith, 490, 491, 492, 493, 494, 495, 496, 497. 127 supplemental indenture dated as of September 14, 2015 by and between Solar City and the trustee related to Solar City's 3.6% solar bonds series 2015 C100-5. 128 supplemental indenture dated as of September 14, 2015 by and between Solar City and the trustee related to Solar City's 4.7% solar bonds series 2015 C10110. 129th supplemental indenture dated as of September 14, 2015 by and between Solar City and the trustee related to Solar City's 5.45% solar bonds series 2015 C10215. Thank you for the like. 132nd supplemental indenture dated as of September 28, 2015 by and between Solar City and the trustee related to Solar City's 3.6% solar bond series 2015 C1055. 133rd supplemental indenture dated as of September 28, 2015 by and between Solar City and the trustee related to Solar City's 4.7% solar bond series 2015 10610. 134 supplemental indenture dated as of September 28, 2015 by and between Solar City and the trustee related to Solar City's 5.45% solar bond series 2015 C10715. 137 supplemental indenture dated as of October 13, 2015 by and between Solar City and the trustee related to Solar City's 3.6% solar bond series 2015 C110.5. Will Tesla hit 1,000 today? It could. 138th supplemental. This feels like the day that it went to 968.99. But I think we're starting from a higher base today. So maybe. Solar City's 3.6% solar bond series 2015 C110.5. What do you think? I'm not sure. I really don't know. 138th supplemental indenture dated as of October 13th, 2015 by and between Solar City and the trustee related to Solar City's 4.7% solar bond series 2015 C11110. All I know, for anybody who's watched any of the videos, that weirdly, I'm not saying I don't think there's any connection. I'm not saying there is at all. But every time I post a video, the Tesla stock goes up. Just quit and make a summary video, please. What's up, man? Good seeing you here. AK1. Check the news. There's a bunch of upgrades for Tesla. Some behind the curve analysts upgraded today too. Still reading. Yes, sir. Good to see you again. AK1, almost done. AK1. 0135758, 0135758, 0135758, 0135758, 0135758, 0135758, 0135758, 0135758. 44, 45, 46, 44, 45, 46, 44, 45. September 15, 2015, September 15, 2015, September 15, 2015, September 29, 2015, September 29, 2015, September 29, 2015, October 13, 2015, October 13, 2015. And if you're reading along from home, page 139 is in the books. And we're on 140. We've moved into the 40s. The last page is 156, and these things look like they're getting a little bit shorter. So these should move a little bit faster. Also, and yeah, this isn't even a Tesla channel. It's just that people ask so many questions. People are so interested in Tesla that it's one of the most fascinating stories in the world right now, by a long shot. There's so many interesting angles, to the whole thing. But I'm not going to do Tesla forever, because there are a lot of other good people that cover Tesla, and there's a lot of other stuff to do. This was the most entertaining thing I could think of to do right now. So that just shows you how many ideas I have left for Tesla, because ultimately you do have to keep people interested and entertained. I forget if I started with this one. I'll just start from the beginning. Exhibit number, exhibit description, incorporated by reference, form, file number, exhibit, filing date, filed herewith, 498, 499, 410, 4101, 4102, 4103, 4104, 4105. 142nd supplemental indenture dated as of October 30th, 2015, by and between Solar City and the trustee related to Solar City's 4% solar bond series 2015-24/5. 143rd supplemental indenture dated as of October 30th, 2015, by and between Solar City and the trustee related to Solar City's 5% solar bond series 2015-25-10. 4th supplemental indenture. And no, I'm not trying to pump the stock, by the way. It's just literally just look at the meme video that I have out, and you'll see what I'm talking about. It's pretty funny. There is no connection. I just think it's funny. Dated as of October 30th, 2015, by and between Solar City and the trustee related to Solar City's 5.75% solar bond series 2015-26-15. 147 supplemental indenture dated as of November 4th, 2015, by and between Solar City and the trustee related to Solar City's 3.6% solar bond series 2015 C1155. 148 supplemental indenture dated as of November 4th, 2015, by and between Solar City and the trustee related to Solar City's 4.7% solar bond series 2015 116-10. 153rd supplemental indenture dated as of November 6, 2015, by and between Solar City and the trustee related to Solar City's 4.7% solar bond series 2015 C121-10. 154th supplemental indenture dated as of November 16, 2015, by and between Solar City and the trustee related to Solar City's 5.45% solar bond series 2015 C122-15. I can't believe people are here watching this. Why are you watching this? I'm curious. Let me know. 158 supplemental indenture dated as of November 30th, 2015, by and between Solar City and the trustee related to Solar City's 4.7% solar bond series 2015 C126-10. AK1, 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 AK1. 001357580. 001357580. 001357580. 001357580. 001357580. 001357580. 001357580. 44454644. 45454645. October 30th, 2015, October 30th, 2015, October 30th, 2015, November 4th, 2015, November 4th, 2015, November 17th, 2015, November 17th, 2015, November 30th, 2015. And page 140 is in the books. Oh, man. So about 15 more pages. Let's see how this looks. Oh, good. We're into a new phase. So, man. God. Basically, it goes until 155. 155 is the new page. 155 is the new target. It's a long way from here. Got to finish within the hour. I want to finish by 9:30. Time to move on. This bit is dying a little bit. Exhibit number, exhibit description, incorporated by reference, form, file number, exhibit, filing date, filed herewith, 4106, 4107, 4058, 4109, 4110, 4111, 4112, 4113, 159th supplemental indenture, laryngitis versus pain. Yeah, Peach Crow, exactly. Who said laryngitis versus page 155. 100%. 159 supplemental indenture dated as of November 30th, 2015, by and between Solar City and the trustee related to Solar City's 5.45% solar bond series 2015 C12715. 162nd supplemental indenture dated as of December 4th, 2015, by and between Solar City and the trustee related to Solar City's 3.6% solar bond series 2015 C135. 163rd supplement till indenture dated as of December 14, 2015, by and between Solar City and the trustee related to Solar City's 4.7% solar bond series 2015 C13110. 164th supplemental indenture dated as of December 14, 2015, by and between Solar City and the trustee related to Solar City's 5.45% bonds series 2015 C13215. 160. Thanks, man. 7th supplemental indenture dated as of December 28, 2015, by and between Solar City and the trustee related to Solar City's 3.6% solar bonds, series 2015 C1355. All right, good luck. Thank you. C1355. Enjoy. 168 supplemental indenture dated as of December 28, 2015, by and between Solar City and the trustee related to Solar City's 4.7% solar bond series 2015 C13610. 169 supplemental indenture dated as of December 28, 2015, by and between Solar City and the trustee related to Solar City's 5.45% solar bond series 2015 C137. 172nd supplemental indenture dated as of January 29, 2016, by and between Solar City and trustee related to Solar City's 4% solar bonds series 2016-35. By the way, if you're listening, can you like this video? I don't even think it really even matters that much, but it does mean something. And I don't know, YouTube probably likes it. And also, this was like 100 times harder than I thought it was going to be. This is hopefully worth at least a like. You don't even have to subscribe. AK1, thank you. AK1. AK1, 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 AK1. 00135758001357580 00135758001357580 Thank you for the like. 4644454644454644. November 30th, 2015. December 14th, 2015, December 14th, 2015, December 14th, 2015, December 28th, 2015, December 28th, 2015, December 28th, 2015, January 29th, 2016, and 141 is in the books. Okay, we're entering a new world. Solar City bonds are gone in a little bit, which is good news. It's been going for a while. 141 in the books. Exhibit number, exhibit description, incorporated by reference. Filed herewith. Exhibit number, exhibit description, form, file number, exhibit, filing date. 4114, 4115, 4116, 4117, 4118, 419, 101, 102, 103, 104, 105, 106, 107, 108. 173rd supplemental indenture dated as of January 29, 2016, by and between Solar City and the trustee related to Solar City's 5% solar bonds, series 2016 410. 174 supplemental indenture dated as of January 29, 2016, by and between Solar City and the trustee related to Solar City's 5.75 solar bonds, series 2016 515. 177 supplemental indenture dated as of February 26, 2016, by and between Solar City, the trustee related to Solar City's 5.25% solar bond series 2016-85. This looks like the 16 by and between Solar City and the trustee related to Solar City's 5.25% solar bond series 2016-10-5. 181st supplemental indenture dated as of June 10th, 2016, by and between Solar City and the trustee related to Solar City's 5.25% solar bonds, series 2016-12-5. Description of registrant securities, form of indemnification agreement between the registrant and its directors and officers. 2003 equity incentive plan, form of stock option agreement under 2003 equity incentive plan amended and restated. 2010 equity incentive plan, form of stock option agreement under 2010 equity incentive plan, form of restricted stock unit award agreement under 2010 equity incentive plan amended and restated. 2010 employee stock purchase plan effective as of February 1st, 2017. 2019 equity incentive plan. How much will Tesla stock go up today? Well, somebody said earlier, asked if it could go above 1,000. It could. I mean, it could be like the day on Tuesday after earnings that it went to 968.99, but today it's starting from a higher base. It's kind of hard to figure out what's going on with it. I don't know. What do you think? What do you think? Also, don't forget to like if you haven't. This is like 100 times harder than I thought it would be. And I'm not even asking anybody to subscribe. Or I guess I sort of am. There's an image somewhere. But anyway, yeah, if you like it, it would be awesome if you liked the video. AK1, 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 S1A, S1A, S1, 10K, 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 S8. 001357558, 001357558, 001357558, 001357558, 001357558, 333 164 593, 333 164 593, 333 164 593, 00134 756, 00134 756, 00134 756, 00134 756, 333 23279. 45, 46, 44, 43, 43, 10, 1, 10, 2, 10, 3, 10, 4, 10, 6, 10, 7, 10, 8, 4, 2. January 29th, 2016, 1st, 2017, March 1st, 2017, March 1st, 2017, June 12th, 2019. And I'm going to take some of these things off because they're just getting a little bit ridiculous. And I guess people already know some of this stuff. Maybe I'll just make this smaller. All right, so we're done with page 142, which means we have about 14 pages left. And these are looking sort of long, but that's okay. So if you're following along from home. We just started at the top of page 143. So starting from the top of page 143, 10, 9, 10, 10, 10, 11, 10, 12, 10, 13, 10, 14, 10, 15, 10, 16, 10, 17, 10, 18, 10, 19, 10, 20, 10, 21, 10, 22, 10, 23, 10, 24. Form of stock option agreement under 2019 equity incentive plan. Form of restricted stock unit award agreement under 2019 equity incentive plan. Employee stock purchase plan effective as of June 12, 2019, 2007 Solar City stock plan and form of agreements used there under 2012 Solar City equity incentive plan and form of agreements used there under 2010 ZET Solar equity incentive plan and form of agreements used there under offer letter between registrant and Elon Musk dated October 13th, 2008. Performance stock option agreement between registrant and Elon Musk dated January 21st, 2018. Indemnification agreement dated as of February 27, 2014 by and between the registrant and JP Morgan Securities. Form of call option confirmation relating to 0.25 convertible senior notes due March 1st, 2019. Form of call option confirmation related to 1.25% convertible, senior notes due March 1st, 2021. Form of warrant confirmation related to 0.25 convertible senior notes due March 1st, 2019. Form of warrant confirmation related to 1.25% convertible notes due March 1st, 2021. Form of call option confirmation relating to 2.375 convertible notes due March 15th, 2022. Form of warrant confirmation relating to 2.375% convertible notes due March 15th, 2022. Form of call option confirmation related to 2% convertible senior notes due May 15th, 2024. S8, 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 S11, S11, S81, S1, Def 14A, 8K, 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 333, 232.079, 333, 232.079, 333, 232.079, 333, 184, 317, 333, 184, 317, 333, 192, 996, 333, 164, 593, 0134756. 0134756, 0134756, 0134756, 0134756, 0134756, 0134756, 0134756, 0134756, 0134756, 4344, 45, 102, 103, 45, 109, Appendix A, 101, 102, 103, 104, 105, 101, 102, 101. June 12, 2019. Oh, we're into 19. June 12, 2019, June 12, 2019, October 5th, 2012, October 5th, 2012, December 20th, 2013, Jan 29th, 2010, February 8th, 2018, March 5th, 2014, 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 March 22nd, 2017, March 22nd, 2017, May 3rd, 2019, and 143. Everybody. And the stock is still looking up pre-market, and the goal is to finish this before 9:30, which is why I'm trying to go as soon as I can. And thank you for liking this, because this is like 100 times harder than I thought. I thought this would take 2 days ago. I thought this would take like 3 or 4 hours and maybe 5 hours, and it's 2 days later, and here we are. The document goes to page 156, and we're on 144 right now, so it's pretty slow going. Probably around 5 minutes a page, roughly. Just check in on the world for a second. 1025, 1026, 1027, 1028, 1029, 1030, 1031, 1032, 1033, 1034, 1035. Form of warrant confirmation relating to 2% convertible senior notes. Due May 15th, 2024. Supply agreement between Panasonic Corporation and the registrant dated October 15, 2011. Amendment number 1 to supply agreement between Panasonic Corporation and the registrant dated October 29, 2013. Agreement between Panasonic Corporation and the registrant dated July 31st, 2014. General terms and conditions between Panasonic Corporation and the registrant dated October 1st, 2014. Letter agreement dated as of February 24th, 2015 regarding addition of co-party general terms and conditions, production pricing agreement, and investment letter agreement between Panasonic Corporation and the registrant. Amendment to Gigafactory. General terms dated March 1st, 2016, by and among the registrant Panasonic Corporation and Panasonic Energy Corporation of North America. Production pricing agreement between Panasonic Corporation and the registrant dated October 1st, 2014. Investment letter agreement between Panasonic Corporation and the registrant dated October 1st, 2014. Amendment to Gigafactory documents dated April 5th, 2016 by and among the registrant Panasonic Corporation of North America, and Panasonic Energy Corporation of North America. 2019 pricing agreement. 2170 cells with respect to 2014 Gigafactory agreements executed September 20th, 2019 by and among the registrant Tesla Motors Netherlands BV, Panasonic Corporation, and Panasonic Corporation of North America on behalf of its division, Panasonic Energy Corporation of North America. 8K, 10K, 10K, 10Q, 8K, 10K, 8K, 10Q, 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 10Q. 0013476. This one's negative 0013476. That's probably a mistake. 0013476, 0013476, 0013476, 0013476, 0013476, 0013476, 0013476, 0013476, 102, 105, 103, 5A, 101, 102, 102, 5A, 101, 103, 104, 102, 105. May 3rd, 2019, February 27, 2012, February 26, 2014, November 7th, 2014, October 11th, 2016, February 24th, 2016, October 11th, 2016, November 7th, 2014, November 7th, 2014, May 10th, 2016, October 29th, 2019. 144 is in the books, and I guess I got to hurry up if we're going to finish by 9:30, which I don't know. Maybe we won't do. Well, this is a short one. 1036, 1037, 1038, 1039, 1040. 2019 pricing agreement. Japan cells with respect to 2011 supply agreement executed September 20th, 2019 by and among the registrant Tesla Motors Netherlands BV, Panasonic Corporation, and Sanyo Electrico Ltd. Amended restated factory lease executed as of March 26th. 10-9 by and between Tesla Inc. and Panasonic Energy North America, division of Panasonic Corporation of North America as tenant. Lease amendment executed September 20th, 2019 by and among the registrant Panasonic Corporation of North America on behalf of its division Panasonic Energy of North America. With respect to the amended and restated factory lease executed as of March 26, 2019. ABL credit agreement dated as of June 10, 2015 by and among the registrant Tesla Motors Netherlands BV. Certain of the registrants and Tesla Motors Netherlands BV's direct or indirect subsidiaries from time to time party hereto as borrowers, Wells Fargo Bank, National Association as documentation agent, JP Morgan Chase Bank, NA, Goldman Sachs Bank, USA, Morgan Stanley Senior Funding Inc., and Bank of America NA as syndication agents to lenders from time to time. Party here too, and Deutsche Bank AG New York branches, administrative agent, and collateral agent. By the way, anybody listening, can you rewind back like a couple hours ago to see what was going on, or can you only see the live video, what's happening now? because I'll publish this and put it up. But right now, can you go back and see, or do you have to wait? I'm curious if anybody's listening and feels like responding. First Amendment dated as of November 3rd, 2015 to 2 as borrowers and the documentation agent, syndication agents, administrative agent, collateral agent, and lenders from time to time party thereto. 10Q, 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 8K, 10Q, 001347560, 001347556, 001347556, 001347556, 001347556, 106, 103, 107, 101, 101, October 29, 2019, July 29, 2019, October 29, 2019, June 12, 2015, November 5th, 2015. It's going to be really close as to whether or not we finish before 9:30. Exhibit number, and we just finished page 145, so we're down to the last 10 pages, which I honestly didn't think we'd get here. This is crazy. Okay, cool. You can rewind. Appreciate the response. It's interesting. 1041, 1042, 1043, 1044, 1045, 1046. Second Amendment dated as of December 31, 2015 to ABO. Credit agreement dated as of June 10, 2015. Bind among the registrant. Thanks for answering that. Tesla Motors, Netherlands BV. Certain of the registrants in Tesla Motors, Netherlands BV direct or indirect subsidiaries from time to time party thereto as borrowers, and the documentation agent, syndication agents, administrative agent, collateral agent, and lenders from time party thereto. Third Amendment dated as of February 9, 2016 to ABL credit agreement dated as of June 10, 2015. Bind among the registrant Tesla Motors Netherlands BV, certain of the registrants and Tesla Motors Netherlands BV's direct or indirect subsidiaries from time to time party thereto as borrowers, and the documentation agent, syndication agents, administrative agent, collateral agent, and lenders from time to time party thereto. Fourth Amendment to credit agreement dated as of July 31st, 2016, by and among the registrant Tesla Motors, Netherlands BV, and the lenders party thereto, and Deutsche Bank AG, New York branches, administrative agent, and collateral agent. Fifth Amendment to credit agreement dated as of December 15th, 2016, among the registrant Tesla Motors, Netherlands BV, the lenders party thereto, and Deutsche Bank AG, New York branches, administrative agent, and collateral agent. Sixth Amendment to credit agreement dated as of June 19, 2017. Among the registrant. I apologize. Tesla Motors, Netherlands BV, and the lenders party thereto, and Deutsche Bank AG, the New York branch, administrative agent, collateral agent. Seventh Amendment to ABL credit agreement dated as of August 11, 2017, by and among the registrant Tesla Motors, Netherlands BV, Deutsche Bank AG, the New York branch, as administrative agent and collateral agent, and the other agents party thereto. 10K, 10K, 8K, 8K, 10Q, 8K, 001347560, 001347560, 001347560, 001347560, 001347560, Exhibit 1028B, 1028C, 101, 101, 101, 102. February 24th, 2016, February 24th, 2016, August 1st, 2016, December 20th, 2016, August 4th, 2017, August 23rd, 2017. Oh man, these look small, but they're, so we just killed, not killed, but 146 is now in the books. It's amazing that people are watching this. Wherever you are, this is incredible. Ten 4-7, 10-4-8, 10-4-9, 10-5-0, 10-5-1. Eighth Amendment to ABL credit agreement. dated as of March 12, 2018, by and among the registrant Tesla Motors, Netherlands BV, Deutsche Bank AG, New York branch as administrative agent and collateral agent, and the other agents, parties thereto. Party thereto, ninth amendment to the ABL credit agreement dated as of May 3rd, 2018, by and among the registered Tesla Motors. It's very unprofessional. I'm sorry. Netherlands BV, Deutsche Bank AG, New York branches, administrative agent and collateral agent, and the other agents party thereto. 10th Amendment to the ABL credit agreement dated as of December 10, 2018, by and among the registrant Tesla Motors, Netherlands BV, Deutsche Bank AG, New York branches, administrative agent and collateral agent, and the other agents party thereto. Amendment and restatement in respect of ABL credit agreement dated as March 6, 2019, by and among certain of the registrants in Tesla Motors Netherlands BV's direct or indirect subsidiaries from time to time, party thereto as borrowers, Wells Fargo Bank, National Association as documentation agent, JP Morgan Chase Bank, NA, Goldman Sachs Bank USA, Morgan Stanley Senior Funding Inc., and Bank of America NA as syndication agents, the lenders from time to time party thereto, and Deutsche Bank AG, New York branch as administrative agent, collateral agent. 11th Amendment to credit agreement dated as of February 1st, 2019, in respect of the ABL credit agreement dated as of June 10th, 2015, among Tesla Inc., Tesla Motors, Netherlands BV, and the lenders from time to time party thereto. Deutsche Bank AG, New York branch as administrative agent and collateral agent, and his collateral agent and the other agent parties thereto. I know the people watching, you may love this. You may also think it's silly, but I don't think this has ever been done before, so it should be maybe in the Guinness Book of World Records, but either way, it's historic. If you look at YouTube, I don't think anybody's read a 10K all the way through before, so you're witnessing history. 10Q, 10Q, 10K, S4A, 10Q, 001-34756, 001-34756, 001-34756, 333-229-749, 001-34756, 10-2, 10-3, 10-4-1, 10-6-8, 10-1, May 7, 2018, May 7, 2018, February 19, 2019, April 3rd, 2019, April 29th, 2019, and 147 is in the books. Let's see where we have to get to in order to... Oh, man. 155. It's going to be tight. So let's see, 2 minutes per thing. That's 5 plus 2, 7. Yeah, I don't think we're going to make it before 9:30. Let's see where Tesla stock is. Up 7.09%. Exhibit number, exhibit description, incorporated by reference, form, file number, exhibit, filing date, filed herewith, 1052, 1053, 1054, 1055, 1056. Agreement for tax payment and incentives dated as of May 7th, 2015, by and between Tesla Motors, Inc. and the state of Nevada, acting by and through the Nevada Governor's Office of Economic Development, amended and restated loan and security agreement dated as of August 17, 2017, by and among Tesla 2014 Warehouse SPV, LLC, Tesla Finance LLC, and the lenders and group agents from time to time party thereto, and Deutsche Bank AG, New York branch's administrative agent. Amendment number 1 to amended and restated loan and security agreement dated as of October 18, 2017, by and among Tesla 2014 Warehouse SPV, LLC, Tesla Finance LLC, and the lenders and group agents from time to time party thereto, Deutsche Bank AG, New York branch as administrative agent, and Deutsche Bank Trust Company Americas as paying agent. Amendment number 2 to amended and restated loan and security agreement dated as of March 23rd, 2018, by and among Tesla 2014 Warehouse SPV LLC, Tesla Finance LLC, and the lenders and group agents from time to time. Party thereto, Deutsche Bank AG, New York branch as administrative agent, Deutsche Bank Trust Company Americas as paying agent. Amendment number 3 to amend a restated loan and security agreement dated as of May 4th, 2018, by and among Tesla 2014 Warehouse SPV LLC, Tesla Finance LLC, and the lenders and group agents from time to time. Party thereto, Deutsche Bank AG, New York branch administrative agent, and Deutsche Bank Trust Company Americas as paying agent. 10Q, 10Q, 10K, 10Q, 10Q. 001247560, 001247560, 001247560, 001247560, 001247556, 10-1, 10-3, 10-4, 10-4, 10-1, August 7, 2015, November 3rd, 2017, February 23rd, 2018, May 7th, 2018, and 148, if you're following along at home, is in the books. And we're now moving to the top of page 149, and when we get to 150, that is going to be amazing because, been waiting for that for a long time. Exhibit number, exhibit description, incorporated by reference, form, file number, exhibit, filing date, filed herewith, 1057, 1058, 1059, 1060, 1061. Amendment number 4 to amend and restated loan and security agreement dated as of August 16, 2018, by and among Tesla 2014 Warehouse SPV LLC, Tesla Finance LLC, the lenders and group agents from time to time. Party thereto, Deutsche Bank AG, New York branch administrative agent, and Deutsche Bank Trust Company Americas as paying agent. Amendment number 5 to amended and restated loan and security agreement executed on December 28, 2018, by and among Tesla 2014 Warehouse SPV LLC, Tesla Finance LLC, and the lenders and group agents from time to time. Party thereto, Deutsche Bank AG, New York branch as administrative agent, and Deutsche Bank Trust Company Americas as paying agent. Amendment number 6 to amended and restated loan and security agreement dated as of August 16, 2018, by and among Tesla 2014 Warehouse SPV LLC, Deutsche Bank Trust Company Americas, New York branch as administrative agent, and the lenders and group agents from time to time. Party thereto. Loan and security agreement dated as of August 17, 2017, by and among LML Warehouse SPV LLC, Tesla Finance LLC, and the lenders and group agents from time to time. Party thereto, and Deutsche Bank AG, New York branch as administrative agent. Amendment number 1 to loan and security agreement dated as of October 18th, 2017, by and among LML Warehouse SPV, Tesla Finance LLC, and the lenders and group agents from time to time. Party thereto, Deutsche Bank AG, New York branch administrative agent, Deutsche Bank Trust Company Americas as paying agent. 10Q, 10K, 10Q, 10Q, 10K, 0134756, 0134756, 0134756, 0134756, 0134756, 103, 1048, 101, 104, 146, November 2nd, 2018, February 19, 2019, October 29, 2022, November 3rd, 2017, November 23rd, 2018. And if you're following along at home, we just got through page 149. Just barely. Exhibit number, exhibit description, incorporated by reference, form, file number, exhibit, filing date, or on page 150, filed herewith. Ten 1063, 1064, 1065, 1066. Amendment number 2 to loan and security agreement dated as of March 23rd, 2018, by and among LML Warehouse SPV LLC, Tesla Finance LLC, the lenders and group agents from time to time. Party thereto, Deutsche Bank AG and New York branch administrative agent, Deutsche Bank Trust Company Americas as paying agent. Amendment number 3 to loan and security agreement dated as of May 4th, 2018, by and among LML Warehouse SPV LLC and the lenders and group agents from time to time. Party thereto, and Deutsche Bank AG, New York branch's administrative agent. Amendment number 4 to loan and security agreement dated as of August 16th, 2018, by and among LML Warehouse SPV LLC and lenders The lenders and group agents from time to time party thereto in Deutsche Bank AG, New York branch as administrative agent. Payoff and termination letter executed on December 28, 2018, and among LML Warehouse SPV. The lenders and group agents from time to time party thereto in Deutsche Bank AG, New York branch as administrative agent relating to loan and security agreement. Loan and security agreement executed on December 28, 2018 by among LML 2018 Warehouse SPV and testifies. Sorry. LLC, the lenders and group agents from time to time party thereto. Deutsche Bank Trust Company Americas is paying agent, and Deutsche Bank AG New York branch is administrative agent. 10Q, 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 10K, 10K, 001347560, 001347556, 001347556, 001347556, 001347556, 10.5, 10.2, 10.4, 10.5, 4, 10.5, 5. May 7, 2018, November 2nd, 2018, November 2nd, 2018, February 19, 2019, February 19th, 2019. So it's going to be close. We'll probably not make 9:30, but maybe. Let's see where Google is, or Tesla. Huh. Up. So we're into the 150s, into 151. Oh, it doesn't get easier. It gets a little easier at 155. So we absolutely can do it. It's 2 minutes per page minimum, so 4 times 2 is 8. Yeah, we could do it. Exhibit number 1067, 1068, 1069, 1070, 1070. Exhibit number, exhibit description, form, file number, exhibit, filing date, filed herewith, incorporated by reference 1070, 1071. Letter of consent dated as of June 14, 2019, by and among LML 2018 Warehouse SPV, Deutsche Bank AG New York branch as administrative agent and the group agents party thereto in respect of the loan security agreement dated as of August 17, 2017, is amended from time to time by and among LML Warehouse SPV, Tesla Finance LLC, and the lenders group and agents administrative agent from time to time party thereto. Amendment number 1 to loan and security agreement dated as of August 16th, 2019, by and among LML 2018 Warehouse SPV LLC, Deutsche Bank Trust Company Americas is paying agent, and Deutsche Bank AG New York branch is administrative agent, and the lenders and group agents from time to time party thereto. Amendment number 2 to loan and security agreement dated as of December 13, 2019, by and among LML 2018 Warehouse SPV LLC, Deutsche Bank Trust Company Americas is paying agent, and Deutsche Bank AG New York branch administrative agent, and the lenders and group agents from time to time party thereto. Sounds funny. Purchase agreement dated as of August 11, 2017, by and among the registrants Solar City, Goldman Sachs and Co. LLC, and Morgan Stanley and Co. LLC as representatives. Several initial purchasers named therein. Amended and restated agreement for Research and Development Alliance on Tri-X Module Technology effective as of September 2nd, 2014, by and between the Research Foundation for the State University of New York on behalf of the College of Nanoscale Science Engineering of the State University of New York at Silivo, 10Q, 10Q, 8K, 10Q1, 001, 34756, 0134756, 0134756, 0135758, 10-1, 10-2, 10-1, 10-16, July 29, 2019, October 29, 2019, August 23rd, 2017, November 6, 2014. And now we're done with page 151 at 9:22, 3:54. Oh, it goes to 55. Man. It's going to be so close. Exhibit number, exhibit description, incorporated by reference, form, file number, exhibit, filing date, filed with 1072, 1073, 1074, 1075, 1076. First Amendment to amended and restated agreement for research and development alliance on Tri-X module technology effective as of October 31st, 2014, by and between the Research Foundation for the State University of New York on behalf of the College of Nanoscale Science and Engineering of the State University of New York. Sorry, excuse me. Second Amendment to amended and restated agreement for research and development alliance on Tri-X module technology effective as of December 15, 2014, by and between the Research Foundation for the State University of New York on behalf of the College of Nanoscale Science and Engineering of the State University of New York and Solivo. Third Amendment to amended and restated agreement for research and development alliance on Tri-X module technology effective as of February 12, 2015, by and between the Research Foundation for the State University of New York on behalf of the College of Nanoscale Science and Engineering of the State University of New York, Solivo. Inc. Fourth Amendment to amended and restated agreement for research and development alliance on Tri-X module technology effective as of March 30th, 2015, by and between the Research Foundation for the State University of New York on behalf of the College of Nanoscale Science and Engineering of the State University of New York and Solivo, Inc. Fifth Amendment to amended and restated agreement for research and development alliance on Tri-X module technology effective as of June 30th, 2015, by and between the Research Foundation for the State University of New York on behalf of the College of Nanoscale Science and Engineering of the State University of New York and Solivo, LLC. 10K1, 10K1, 10Q1, 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 0135758, 0135758, 0135758, 0135758, 0135758, 1016A, 1016B, 1016C, 1016D, 1016E, February 24th, 2015, February 4th, 2015, May 6th, 2015, May 6th, 2015, July 30th, 2015. Exhibit number, exhibit description, incorporated by reference, form, file number, exhibit, filing date, filed herewith, 10/7/10, 10/7/8, 10/7/9, 10/8/0, 10/8/1. Sixth Amendment to amended and restated agreement for research and development alliance on Tri-X module technology effective as of September 1st, 2015, by and between the Research Foundation for the State University of New York on behalf of the College of Nanoscale Science and Engineering of the State University of New York and Solivo, LLC. Seventh Amendment to amended and restated agreement for research and development alliance on Tri-X module technology effective as of October 29th, 2015. By between the Research Foundation for the State University of New York on behalf of the College of Nanoscale Science and Engineering of the State University of New York and Solivo. Eighth Amendment to amended and restated agreement for research and development alliance on Tri-X mobile technology effective as of October 26, 2015, by and between the Research Foundation for the State University of New York on behalf of the College of Nanoscale Science and Engineering, State University of New York, Solivo, LLC. Ninth Amendment to amended and restated agreement for research and development alliance on Tri-X module technology effective as of December 9, 2015, by and between the Research Foundation for the State of University of New York and on behalf of the College of Nanoscale Sciences and Engineering of the State University of New York and Solivo, LLC. 10th Amendment to amend and restate agreement for research and development alliance on Tri-X mobile technology effective as of March 31st, 2017, by and between the Research Foundation for the State University of New York on behalf of the Colleges of Nanoscale Science and Engineering for the State University of New York and Solivo, LLC. 10Q1, 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 10K1, 10Q. 0135758, 0135758, 0135758, 0135758, 0134756, 1016F, 1016G, 1016H, 1016I, 108. October 30, 2015, October 30, 2015, October 30, 2015, February 10th, 2016, May 10th, 2017. I think forgot to include 152 before when we finished it. I hope I did. I'll go back and look at the video. If I didn't, I'll change it. We should be on the last page by 9:30. Exhibit number 10. Exhibit number, exhibit description, form file number, exhibit filing date, filed herewith, incorporated by reference. 1082, 1083, 1084, 1085, 1086. Grant contract for state-owned construction land use right dated as of October 17th, 2018 by and between Shanghai Planning Co. and Land Resource Administration Bureau's grantor and Tesla Shanghai Co. Ltd. is guarantee English translation. I actually want to see that. Facility agreement dated as of September 26, 2019 by and between China Merchants Bank Co. Ltd. Beijing branch and Tesla Automobile. Beijing Co. English translation statement. Letter to China Merchants Bank Ltd. Beijing branch from Tesla Automobile Beijing Co. Ltd. dated as of September 26, 2019. English translation. Fixed asset syndication loan agreement dated as of December 18th, 2019 by and among Tesla Shanghai Co., China Construction Bank Corporation, China Shanghai Pilot Free Trade Zone Special Area Branch, our Agricultural Bank of China Shanghai, Changning Sub-Branch, Shanghai Pudong Development Bank Co., Ltd., Shanghai Branch and Industrial and Commercial Bank of China Limited, China Shanghai Pilot Free Trade Zone Special Area Branch, English translation. Fixed asset syndication loan agreement and supplemental agreement dated as of December 18, 2019 by and among Tesla Shanghai Co. Ltd., China Construction Bank Corporation, China Shanghai Pilot Free Trade Zone Special Areas Branch, Agricultural Bank of China Shanghai, Changning Sub-Branch, Shanghai Pudong Development Bank Co. Ltd., Shanghai Branch and Industrial and Commercial Bank of China Limited, China Shanghai Pilot Free Trade Zone Special Area Branch, English translation. It's 9:30, so didn't quite make it. I guess did Tesla not open or something, or well, there we go. So it opened up. Crazy. I think I just finished that. English translation. Somebody fact check me if that's not right. 10Q, 10Q, 10Q. 001347560, 001347560, 001347560, 102, 103, 104. July 29, 2019, October 29, 2019, October 29, 2019, XX. Second to last page. Ten eight seven 21 1 23 1 31 1 31 2 32 1 101 management contractor compensatory planner arrangement. Cross confidential treatment has been requested for portions of this exhibit. Cross portions of this exhibit have been redacted in compliance with Regulation SK Items 601B10. 1 indicates a filing of Solar City. Do we do the exhibit number, exhibit description, incorporated by reference, form, file number, exhibit filing date, filed herewith, and we did 154, and before that we were on page 153. This one should be pretty easy. Syndication revolving loan agreement dated as of December 18, 2019 by and among Tesla Shanghai Co. Ltd., China Construction Bank Corporation, China Shanghai Pilot Free Trade Zone Special Area Branch, Agricultural Bank of China Shanghai, Changqing Sub-Branch, Shanghai Pudong Development Bank Co. and Shanghai Branch and Industrial and Commercial Bank of China Limited, China Shanghai Pilot Free Trade Zone Special Area Branch, English translation. List of subsidiaries of the registrant. Consent of PricewaterhouseCoopers LLP, independent registered public accounting firm. Rule 13A, 14A, 15D, 14A, certification of principal executive officer. 13A, 14A, 15D, 14A, certification of principal executive officer. Section 1350, certifications. Inline XBRL instance document. Inline XBRL taxonomy extension schema document. Inline taxonomy extension calculation link-based document. Inline tech XBRL taxonomy extension definition link-based document. Inline XBRL taxonomy extension label link-based document. So we had label definition calculation. Inline XBRL taxonomy extension presentation link-based document. Cover page interactive data file formatted as inline XBRL with applicable taxonomy extension information contained in exhibits 101. And then we've got X X X X X X X X X X X X. See how many people are here. Wow, 7 people. Hi everyone. Why are you watching this? It's awesome. Item 16, summary, none. There's no summary. See, that was the problem. If there was a summary, I could have just read it. I could have moved right to here and this would have taken a few minutes. And let's see what Tesla's doing. Down a little bit. Up, but down from where it was. I hope you guys will consider liking this video. It took a long time. I'm not saying it's good, but it did take a huge amount of effort. So that was page 155. Now we're on the signatures page, which is the very last page. Signatures. Pursuant to the requirements of Section 13 or 15D of the Securities Exchange Act of 1934, the registrant has duly caused this report to be signed on its behalf by the undersigned. Thereunto duly authorized. Date February 13, 2020. Tesla Inc. Signed Elon Musk, Chief Executive Officer, Principal Executive Officer. Pursuant to the requirements of the Securities Exchange Act of 1934, this report has been signed below by the following persons on behalf of the signature, title, date. Signed Elon Musk, Chief Executive Officer and Director, Principal Executive Officer, February 13th, 2020. Yes, light at the end of the tunnel indeed. Signed Zachary J. Kirkhorn, Chief Financial Officer, Principal Financial Officer, February 13th, 2020. Signed Vaibhav Taneja, Chief Accounting Officer, Principal Accounting Officer, February 13th, 2020. Signed Robin Denholm, Director, February 13th, 2020. Signed Ira Ehrenpreis, I'm probably butchering that name, I'm sorry, Ira, Director, February 13th, 2020. Signed Lawrence J. Ellison, Director, February 13th, 2020. Signed Antonio J. Gracias, Director, February 13th, 2020. Signed Stephen T. Jurvetson, Director, February 13th, 2020. Signed James Murdoch, Director, February 13th, 2020. Signed Kimball Musk, Elon's brother, Director, February 13th, 2020. And before, cheers, and before I do the last one, each of these people had names underneath their names, so I have to make sure I read that too. I forgot. Elon Musk, Zachary J. Kirkhorn, Vaibhav Taneja, Robin Denholm, Ira Ehrenpreis, Lawrence J. Ellison, Antonio J. Gracias. I can't believe you guys are watching. Thank you for watching. Stephen T. Jurvetson, James Murdoch, Kimball Musk. And signed Kathleen Wilson Thompson, Director, February 13th, 2020. Kathleen Wilson Thompson, 156. Oh, and the most important thing that I wanted to say about